because we're not. I mean, I guess this doesn't make too much of it, but I mean, the Bitcoin we're selling is from our own inventory, right? We're not just linked to an exchange and just pulling it from a third party. It's actually our inventory. So, I think something like that. So the elder fraud, a holding period where people can cool down, reevaluate the transaction, get a refund if they discover fraud within that time period. But this 90-day refund stuff is just untenable. And we are doing things right now too, which are sort of suggested but not really mandated. We're using technology to scan the wallet that they provide to make sure it hasn't been used in fraudulent activity in the past. Obviously, we're doing all the OFAC sanctions screening, and then all the KYC AML. But most of the operators that we all would be aware of are doing something similar in that regard. So that's sort of standard practice.
Yeah. And, you mentioned Bitcoin being irreversible. The caveat to that being that law enforcement has seized private keys from criminals in the past. And that's kind of formed the basis of the strategic Bitcoin reserve. Mm-hmm. But how common do you think that is, that they actually get the criminals' wallets at some point? Or is that
we're not aware of any of that happening for our customers. I think that, obviously there's a big cost to doing the chain analysis to recover $300, $500. That's,
yeah.
So I don't know how feasible that is. But I mean, you bring up an interesting point, which I've always found a little odd, right? That, we're recovering these stolen funds, but we're not returning them to the people they were stolen from, right? So that's an interesting dilemma.
There needs to be some due process around that to make sure it's equitable. Mm-hmm. The most recent one, actually, the fraud victims were in China. Mm-hmm. And so the dispute is with the Chinese government, where the U.S. government has seized the Bitcoin, and the Chinese government is saying, hey, give us the Bitcoin. Not because they're going to give it back to the victims, mm-hmm. I think, but because they want the Bitcoin. Yep. So it's going to become increasingly complex geopolitics, these Bitcoin wallets and the criminals that are using them.
Yeah, absolutely.
So what do you think that the industry's at this point, is it saturated? Is it still in growth mode? How do you see the prospects of it outside of kind of the regulatory headwinds?
Yeah. I mean, in the United States, it's I would say fairly well saturated. We have, I think, I'm not up to date on the current data, but roughly 24,000 or plus or minus ATMs active across all 50, well, probably not in New York, but most states. And so the United States, at least for us, and I think for a lot of our competition, it's sort of like putting new machines in is just kind of moving your money from your right pocket to your left. So, of course, we're only operating in 40 states, so we have growth ahead of us. If we can find the right location to put a new machine in there, we still are growing organically into these new states, new locations. But I think in total in the U.S., it's pretty top heavy right now. Overseas and internationally, we're seeing a lot of growth. Australia, our partners there are growing phenomenal. We're the top ATM operator in Australia. They're rolling out our payment gateway as well, and they're growing as fast as we can send them ATMs. We just got a license in the UAE before the war started, so we're eager to go and start operations there. We'll be the first licensed and approved kiosk operator in the UAE. That's licensed from the central bank, and we're very excited about that market. And I think there's still lots of opportunity in Europe, Asia, Latin America, et cetera. So we're working on that international push as far as where our growth is going to be, and then our other verticals in the wallet and the payment gateway.
And how do you think about like horizontal growth opportunities? Have y'all explored creating a wallet or having a web, brokerage or exchange?
Yeah, our software is, proprietary to us. So it's an on-ramp, off-ramp, custody, non-custody, you name it, right? So yes, we launched a wallet that's live in all 50 states here in the United States. That's like the typical easy button, right? You connect via ACH, smash by your Bitcoin, it's held in custody for you. We also have another wallet that's called Byte Vault, and Byte Vault is fully non-custodial. You hold all your own keys, and so we're training and educating people that once you've hit balances in through the on-ramp through Byte Wallet that you want to secure with your own keys to transfer it to Byte Vault. The Byte Vault also becomes sort of the buddy or companion wallet for the kiosk, because those are all basically like peer-to-peer transactions. And so you have to have your own wallet to function with an ATM. On the payment gateway side, we wrote that software years ago. We beta tested with all sorts of different retailers. So we've had it run in restaurants. We've had it run in gas stations. We did the first gas transaction over Lightning at a mobile station here in Sarasota, Florida, a couple years back. That was really exciting. And so we've also done cars, real estate, et cetera. And what we've decided to focus on is the high dollar value lifestyle type purchases, where you want to take some portion of your growth in Bitcoin and convert it to a home or a boat or a luxury vehicle. So that sort of lifestyle enhancing purchase that would be a significant volume. And our reasoning behind that is that because there's no de minimis tax exemption yet, and because because Visa and Cash App and Stripe and everybody's getting into the retail transactions with crypto, we thought that our niche should be on-chain direct Bitcoin purchases for assets that are life-changing for you.
Right. Yeah, that makes sense. And then on lending, we hear a lot about new lending products. Mm-hmm. Is that something y'all are exploring, or is it kind of just a different adjacent service?
Yeah, it is. It is something we're exploring. Actually, we've got meetings coming up in the near future about that, and we've thought about incorporating lending into the payment gateway, so that at the point in time that you are saying, okay, I'm going to buy that house with Bitcoin, you could instead toggle the switch to a loan and post collateral and get the loan to make the purchase. So we're working on those. We're talking to capital providers for that kind of lending. And then also the traditional Bitcoin-backed loans that everybody's familiar with, that would be introduced into our wallet infrastructure.
Do you have any heist stories for us with Brinks or other service providers?
We do.
Yeah.
I won't name the name of the company, so it's okay. If it's Brinks or Garter or Loomis, I can't tell you. But no, we've actually caught them stealing cash out of our ATM, and we have video cameras inside. We have cameras on the customer. We have cameras in the vault too, watching the cash, and so we've seen that happen. We have had, if you're familiar, like the typical company, right, has an ATM that's bought out of China that's plastic. Our ATMs sit on a 1/4-inch steel vault that is folded and formed and welded here in Bradenton, Florida. And then
if you're not at the table, you're on the damn menu. I think we're pretty spoiled right now. We may find out very soon what it's like to be on the other side, and I don't think we're gonna like it very much.
I've got questions lined up for these gentlemen, but first I want to ask them about maybe the bigger question, which is that when we think about Bitcoin, it's decentralized, it's permissionless. The ethos of Bitcoin is very independent. some would even say libertarian, and they think it's Bitcoin versus the state. So what are we doing up here on a panel, kind of getting into the weeds on what DC is doing? How do you push back on that cynicism and that nihilism about today's politics? So we'll start with Stephen. And feel free to introduce yourself.
Yeah, Stephen Pollock, Signal Ridge Partners. We're a consulting firm, works with Bitcoin businesses. Before that, I was at Bitcoin Pulse Institute for a while. And before that, I ran campaigns, state, local, national, all over the country in issue advocacy. So to tee that up, why should we not be cynical? Great one to start with here, Pierre. So I would say I think I am cynical, first of all, and that's why we should be involved. The reason we should be involved in national politics, or we should worry about what's happening with Bitcoin on Capitol Hill, and this is a conversation I've had with tons of people outside of corporate Bitcoin, hardcore Bitcoiners, everyone across the spectrum there. The reality is that if you're not at the table, you're on the damn menu. And so I think we're pretty spoiled right now. I think we're fortunate. And there's some people here in this room, in the room next to us adjoining, that I think we have to thank for that. However, I think and we can get in this later, we may find out very soon what it's like to be on the other side. And I don't think we're gonna like it very much.
Good afternoon, everybody. Steve Baum, Managing Director at CBiz. I head up the crypto division at CBiz. We're the 7th largest accounting and audit firm in the country. I focus primarily on helping companies get to the public markets that have digital asset businesses. So the question, I'm not in politics, right? So I'm more on the compliance side. But when you talk about the kind of last 15 years of Bitcoin, we look at revolutions, right? And how do revolutions start? And whether it's this technology, blockchain technology, or how the internet started, it's always people pushing for the next level of innovation. And I think when that began, you had this libertarian view of Bitcoin as this free money and something that would be outside the government's control. But then over the last 15 years, I think that the technology became so strong that people started to realize that this type of tech actually is so innovative to be used in financial institutions that it had to have some sort of oversight by government. And that shift has pushed people out of the industry, but also has brought a lot of new faces in. So I think overall it's a good thing, because this technology is going to get broader as we kind of see it evolve over the next decade or so.
Paul Tarantino with Byte Federal. We are a Bitcoin-centered fintech platform. We have 2 different divisions. One that is our retail on-ramp through our kiosk network, so Cash for Bitcoin. And then our other, which is payment processing. We just launched the very first US-regulated casino transaction in Vegas with Circa. So we are funding bets in the casino with Bitcoin. To answer your question, I'm probably the least political person on this panel, but I have also been impacted by it directly with our business. So we definitely have some opinions. But I got into Bitcoin because I believed it was a tool to really fix a lot of the problems that we saw with this combination of the political and financial mechanisms of the world. So Bitcoin, from that libertarian perspective, was for us a way to solve or heal what we long perceived as a lot of deep problems within those 2 systems. So the adoption of Bitcoin at the larger scale, both Wall Street and government, is a double-edged sword, because you do come, or we came to this with these sort of idealistic goals in mind, and the political process is obviously a negotiation that will continue for some time. And so I think that we sort of struggle with that internally. We want it to be done right, and that fight to get a proper policy crafted it has been challenging and difficult, I think, for all of us to achieve.
Excellent answers. I'll give my own answer, which was my experience with Bitcoin mining in Texas, where we saw legislators who were opposed to Bitcoin mining And by a process of engagement and education, they actually change their views. And so as much of the cynicism there is out there about politics, I actually came away with that almost idealistic. Maybe I was in ideal circumstances to have that experience. But now, Stephen, we saw the Genius Act for stablecoins kind of sail through, seemingly, because they want to finance the deficit. So let's get back to cynicism. But it seems like the Clarity Act is kind of stuck in some mud here. The odds online are saying 50-50. Depends which website you check. What's the sentiment like in DC around the Clarity Act, and why should we care?
Yeah, big question. First of all, legislation, clarity, ARMA, whatever. I don't know. I don't know what's going to happen. I don't think anybody knows. Maybe somebody out there, if you know what's going to happen, I'd love for you to raise your hand. But I love that it's a coin flip on Kalshi right now. And I think that what I'm more interested in, obviously it'd be great to get something done. I think we have 5 weeks is what they're saying, right? And I think the question behind that is really about the House and the 82-18 odds that we're seeing on the House flipping, because I think where we're at is we're on the cusp. Some would say we're almost there. Some would say we may be there soon, and some would say that we're now, which I would probably say we're there now in the midst of crisis as an industry. As far as, Bitcoin's down. I'm not talking about that. I'm talking about the political realities. And I think we also have a massive opportunity. And so if you don't mind, unpack that a little bit. The crisis is that, well, first of all, we have Senator Lummis, who's been phenomenal. Senators like Senator Blackburn, Tennessee, let's go. They're about to be gone. And I don't know if any other senators really could have pulled off what they have with clarity, with market structure, because they've been there a long time. They have seasoned staff, and they've sort of danced through the hula hoops to still give this a chance. It's still at 50-50, which is unbelievable, because it really doesn't feel like it should be a 50-50. It feels like it, and so they're going to be gone soon. And I don't think there's any heir apparent. There's people who, we have fans in the Senate and in Congress, but I don't know if we'll ever have another Senator Lummis. I mean, maybe. I hope so, but we may not.
She's a one of a kind.
She's one of a kind, and so that's about to be over with. We're going to lose the House, apparently, right? It's 80% odds the Republicans lose the House, and I say we because the Republicans have been the ones who are supporting us and dragging us all of this forward. And so, we've got a massive opportunity that's about to be, the window's about to be closed. And on the other side of that, you're going to have a Maxine Waters on the House Financial Services Committee, dragging everybody in front of the committee and embarrassing them on national television. So yeah, it's a little bit of a crisis, but I think the opportunity here is that there's still a 20% odds that the Republicans keep the House. And I think that there's a lot that we can do. There's a lot that has been done. Are you guys familiar with there's this thing we used to have. I'm from Southwest Missouri, like 30 minutes away at this small high school. This guy grew up, went to school there. His name was Brad Pitt. And we had this thing we called the Brad Pitt rule, which is basically if you ask someone out on a date and she makes up some reason or says some reason she can't do it, and you're like, I don't know. You're like, well, if you were Brad Pitt, would she say the same thing? And if the answer is no, then she's just not that into you anymore, or not into you at all, right? And I think what we need to realize is, as an industry, we're no longer Brad Pitt. If we ever were, we're not now. And AI is Brad Pitt. And our mining companies are going to AI, and our Bitcoin Policy Institute, which I was at for 4 years, their new summit's about AI, and I think it's fantastic. I think it's smart. It makes sense. But I think we need to realize we're no longer Brad Pitt. And so if you're not Brad Pitt, what do you need to do? You need to figure out how to impress this girl. And so I think at the midterms, we have an opportunity to impress her. And I don't think we're doing enough yet, but we can talk about it more. I don't want to dominate the time, but I think there's some, Nick Begich, for instance, is a fantastic advocate for us in the House, and I think we need to do more to support him. Anyone in this room, anyone out there who hasn't maxed out, them, their wife, their dog, probably needs to do so. And I doubt that we're doing those sorts of things. And anyway, yeah.
He's representing Alaska, is that right?
Yeah, he's in Alaska. Yeah, but he's essentially solely responsible for ARMA.
Yeah. Oh well, tell us what ARMA is, and kind of what the impact of that legislation would be for the reserve.
Well, yeah, I mean, U.S. government buying a lot of Bitcoin and holding on to it for 20 years is, that'd be phenomenal. I think it's the top of my list. I think it should be the top of most of our list. I think it's a stretch, but I think it's great. So, I think Lund, we have advocates in the House side that we need to take care of, and I'm not sure that we're doing it.
Yeah. Now, Paul, let's shift gears to Bitcoin ATMs, not the at-the-market offerings, but the automated teller machines, the hardware. This administration has been pushing back on issues around fraud. Our vice president himself is in charge of this anti-fraud task force. I've seen headlines of fraud busts abroad, like in Thailand or Cambodia, where these call centers are defrauding people, sometimes using Bitcoin ATMs. And so can you kind of get into kind of what the landscape is there and what the legislative and regulatory pitfalls are and what is kind of legitimate in terms of making sure that we go after the bad guys?
Yeah, sure. Thank you. The Bitcoin ATM space, a lot of people may not be aware of this, is been under a misinformation attack that I think is pretty akin to what you went through with mining. I'm not going to sit here and fool anybody that we do have some bad operators in the space, but there are a number of us which we consider best-in-class operators that go way above and beyond what's required by law to legally operate, because we want to stop fraud before it takes place at our ATMs. But the state legislators specifically have been led down a path that the Bitcoin ATM companies themselves are the fraudsters. That's simply not the case. As you mentioned, the vast majority of this high dollar fraud starts in the telecom and voice over IP industry, where you could get a phone number for $100 and very light due diligence. They have a protocol in place called the STRC protocol where they're ranking these calls on legitimacy, but the fact of the matter is that the highest rated calls make up 48% of the fraud. So they just don't do enough. And the FCC's filed about $208 million in fines and collected $7,000, so way to go. That being said, that architecture of fraud does not just affect ATMs. There was well over 200 and something billion of fraud last year just in the banking system, all starting from those calls. The ATM industry is about 247 million last year. So we're a very small drop in the bucket of total online fraud. And if you look at this fraud, it's not just hitting the banks, it's also Zelle, PayPal, gift cards, credit card fraud, ACH, wires, you name it. It's across the system, and it's growing at about a pace of about 25% a year because of the AI. So the attack on the Bitcoin ATM industry in specific is really misguided because they don't take the time to understand that not all operators are created equal. We have a number of protocols in place inside our terminal that are sorting out and confusing people that are being coached, so we can find out if they're not reading our terms of service, if they're not properly addressing the fraud questionnaires that we have built into our terminal. And everybody over 60 is getting a live phone call from a trained US customer support staff to specifically verify that they're doing this transaction for their own investment purposes and that they're not being coached or being sent to the ATM in order to make a payment to somebody. That's all on top of full KYC, BSA compliance, AML, SARS, CTRs, on-chain analytics, verifying your wallet, tracking your money after you've bought it. All of this is to say that the ATM bans that are taking place across the United States right now, we have Minnesota is banned, Tennessee is banned, and Tennessee actually made it illegal to actually even own a machine if it's off, right? You can't even have it on your premise even if it's turned off. You can go to jail for that now. And then, we have a bunch of pseudo bans where they've restricted the operational profitability to the point that it just was not profitable to operate. So we have been, like you, through the mining debacle, have been trying to educate lawmakers. We've combined with 2 other operators in the space. We just had a great call with Durbin's staff. We're trying to make sure that they understand there's a right way to do this business so they can preserve access for the 26 million and underbanked Americans that need it. This is the group that's underserved, that suffers most from inflation. That's the primary customer for the ATM industry, and we want to preserve access. So that's crucial that we get in front of these people and we have time to educate them. They're passing laws without understanding the way the network works. They're passing laws without understanding all the protocols that are in place voluntarily in order to prevent fraud. And frankly, we have a much lower rate of fraud taking place on the ATMs because of our protocols than any other part of the financial ecosystem.
All right. So I will continue not answering my phone calls because it's fraud.
52.8 billion calls, robocalls last year in the US.
That's crazy. I feel like half of them went to my phone. Steve, all right, let's kind of go on to a rosier topic. Although with the Bitcoin price doing what it is, it's not that rosier. I put on my red tie today because we're down. Fair value accounting. So it used to be the case that you could only write Bitcoin down on your balance sheet. Now you can write it up, hypothetically, in the future. So that was removing a major obstacle for corporate Bitcoin adoption. What now do you see as kind of the obstacles you're encountering with your practice, or is everything kind of streamlined compared to other assets?
Look, I mean, we'll talk a little bit about accounting, and I could talk about the ATMs, or I could talk about the Clarity Act as well. Obviously, the ASU that got passed a few years ago allows you to now mark to market digital assets, all digital assets, including Bitcoin. That was a big change because the financial reporting that you saw public companies, specifically 10Ks, 10Qs, didn't represent the true value of those assets because you would have to drive them down to cost and you wouldn't be able to remark them if the price recovered. It doesn't have that big of an impact overall because most investment vehicles require fair value accounting regardless. So it really didn't have a huge impact except if you were really just a public company that wanted to report digital asset holdings. So we see that change now, simplifies the accounting, but does it really change much? I don't necessarily think so. It just gives a little bit of a better picture of the fair value of those coins. Now, some of the bigger topics probably are around revenue recognition. If you're, taking Bitcoin, doing different strategies, whether it's covered call strategies or if you're mining Bitcoin, they're still dealing with how do we report this properly from a rev rec perspective. And I think there's a lot of diversity in practice that continues to be there with digital asset transactions that generate revenue or income streams. It's an area we see typically that the SEC is pretty involved in, as well as the PCAOB, which is the oversight committee for public accounting firms.
All right. Now we're running short on time, so I'm going to try to kind of provide a wrap-up question. Stephen, how should people really get engaged? We've got these midterms coming up. The primaries were very interesting in their results. We could lose the House. What do you think the Bitcoin community should be doing more of and less of as they engage with politics?
Sure. I think simple. Double down, triple down on your winners. So Nick Begich, like I said before, Zach Nunn, max out to these guys. Call up the NRCC. Say, hey, put me in, coach. As an industry, or you individually, we should call the NRCC and say, what can we do to help? And then, engage, grassroots, ground and pound. Top down's not going to work. We're going to have to, really roll up our sleeves and do what many have done before us and learn what it's like to really engage, like at a local, state level, congressional district level in the upcoming midterms.
Yeah, and that's something I've seen in Texas is that we've got the Texas Blockchain Council, which has been really effective in engaging at the state level. So I'd also encourage people to find their tribe, find the people around them that are working on these issues. And Paul, do you think the Bitcoin ATM kind of outlook is that going to be an opportunity to orange pill more politicians, or at this point is it really just damage control?
It's a little bit of both. I mean, the educational process through the meetings that we're having with the state lawmakers has really lit the light bulb for a lot of people, right? It's sort of split. It's those that are not taking the time to understand, and then the others that really dig into our fraud protocols that instantly a light goes off, and we commonly hear, how come I haven't heard of this before? And then they want to share it. So we are having traction in regards to that educational process, both stopping further damage, and also they're now starting to think like, I can re-implement new legislation in the future that addresses this in a way that's pro-consumer and pro-business and eliminates fraud. So I do think we're having a good impact. I'll just leave you all with this. If you're interested, you can go to bytefederal.com/fraud-prevention. You can see the architecture of scams that affects the entire financial industry and exactly what we're doing to prevent it. You can also find a petition there that you can sign to preserve access to Bitcoin ATMs for people that so desire it. So yeah, I guess I'll leave it there.
Great. Well, thank you to our panelists, and thank you to the Bitcoin for Corporations team for organizing this symposium. So yeah, well, also, I want to make a shout out for the Bitcoin for Corporations show. We've got a podcast and YouTube that everyone should go check out and subscribe, including some conversation with Paul on this topic. So thank you all, and have a great afternoon.
Thanks, Pierre.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for Corporations, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
This is a bottom formation that's happening. Bitcoin's not going to die. I think it is. Well, maybe you're in the wrong room. We're going to go over, briefly the Bitcoin thesis, but in general, I want to zoom out, take a look at the market conditions. Everyone that's a Bitcoin holder, it obviously has been a tough 12 months. But the question I want to pose to everyone today is, has the thesis changed? What does the market look like? And where do we go from here? Okay, so I won't spend too much time on this slide. This is pretty basic, and I imagine 95% of the people in this room understand this. But if you don't, or you have more questions, or your conviction in this, in these fundamental principles is wavering, then happy to chat after the talk, but I won't spend too much time on it. So, I just kind of wanted to put some numbers to what we're seeing here. I almost titled the talk, "Bitcoin is Dead, Long Live Bitcoin." I tweeted that about a week ago, and it led to some confusion among the Japanese audience. And so, I decided to, not go with that provocative title. But, to rewind, I guess, I work at Metaplanet. We're the third largest Bitcoin treasury company. We hold about 40,000 Bitcoin, so about 20 basis points of the Bitcoin network, give or take. And the journey started for us about 2 years ago. April of 2024, so a bit more than 2 years. And the company was just, a small hotel company with a 14 million market cap. Today, despite the extreme volatility of Bitcoin and even more extreme volatility of the common stocks of companies holding Bitcoin, we're about a $1.8 billion company and change, and we have about 2.5 billion of Bitcoin. So it's really been a transformational 2 years for us, and I'll explain how we made that happen. So this chart, what are we looking at? This is the 200-week moving average for Bitcoin. So no fancy analytics here, simple moving average. Warren Buffett buys assets under the 200-week moving average. A lot of people, regardless of the asset class, will put something on their watch list. If it's under the 200-week moving average, it's maybe a decent time to start accumulating a position. And so the bottom here, this is the quantiles of the 200-week moving average and Bitcoin's price relative to it. Right, so we're in about the sixth percentile in all of Bitcoin's history relative to the 200-week. Could Bitcoin go lower? Absolutely. Who knows where the bottom is? But this is a bottom formation that's happening. Bitcoin's not going to die. If you think it is, well, maybe you're in the wrong room. But this is what the bottom looks like. I can tell you that sentiment in 2022 and all of the other bear markets felt just like this, with a different flavor and different kind of talking points. So here's kind of another one of these charts, right? The magic of Bitcoin is we can see the supply with 100% transparency. And so it's like, how valuable would the data set be if you could see every gold bar in the entire world, when it changed hands, to who it changed hands to, at what price? It would be a $1 trillion data set. That'd be really extremely valuable to any capital allocator. With Bitcoin, we actually have the data, right? And so we can look at all of the coins in the network, when they last moved, when were they acquired, at what price. Is there some noise in that? Yeah, there is, right? If you change wallets or upgrade your cold storage, or an exchange shuffles some UTXOs around, it changes. But net, this is a pretty useful kind of signal of, okay, what's the aggregate market profile look like? You can kind of see the previous bear markets, right? So the current amount of the Bitcoin network that's in a loss is right now about equivalent to March of 2020, when we wicked to $3,000, right? So Bitcoin's at 60K. The bears are ever confident, 50K, 40K, 30K, 20K, it's over, zero. But this is how it is every bear market. I think for those around in 2022, the calls were deafening for 12, 10, 8, 5, $3,000. We bottomed at 15, right? There was seemingly no catalyst for Bitcoin to ever go up again, and it did. And so we'll check out why. So again, this is kind of for people familiar with the on-chain world and this kind of emergent class of analytics. This is one of these really popular frameworks. It's called, this is a long-term holder supply. And how do you quantify a long-term holder? It's give or take, there's a statistical analysis component to this, but give or take, if a coin doesn't move for about 6 months, then we put them in the long-term holder bucket, because the probability that those coins move is much, much less statistically than a coin that just moved 10 minutes ago. A coin that moved 10 minutes ago is very likely to move again. A coin that's been hodled for 6 months, 1 year, 2 years, 5 years is not likely to move. So right now, what do we see? we see about 82% of the network in long-term holder hands, right? And these are the people buying at 60 2 years ago, at 120 last year. These are everywhere in between. This is the amount of the network in the hands of really the believers. Maybe it's me and you, or maybe it's, maybe you're not a believer of Bitcoin, but the people buying this right now and holding it are the people that deeply, deeply believe in Bitcoin. So, an interesting pattern has emerged here, right? In a bull market, what you often hear, especially on X and Twitter with all the noise, is supply squeeze. Supply squeeze. Bitcoin's going up. Why? It's a scarce asset, more demand than supply. It's a supply squeeze. But actually, that's a little bit of an inverted truth. In a bull market, you can see that there's actually a distribution, right? So the people that were stacking Bitcoin at $3,000, at $15,000, they take a little slice off at the top, right? What's happening now? It's the opposite. So right now, actually, you hear it, it's deafening at the peaks. Right now, there's no reason for Bitcoin to ever go up again. But what do we have forming? A supply squeeze, right? And so eventually, all of the willing sellers, all of the forced sellers, all of the people that are saying, okay, it's over forever, just take their ball and go home, right? They sold. And who's buying? It's the convicted long-term holders, right? And so eventually, just like you saw in 2022, through the depths of the bear, what do you see? Relentless accumulation, right? And then into the bull, there's a bit of a distribution. This is how Bitcoin's maturing, and it does it in these big, long 3 to 4 year macro cycles. So there's a lot of noise in between. But fundamentally, why will Bitcoin ever go up again? Well, the ETFs are selling, and Sailor's going to get liquidated, and Quantum's going to send Bitcoin to zero, and there's all these different narratives going on, and it's deafening, right? There's no reason for Bitcoin to ever go up again. This is the reason. It's just a fundamental supply-demand imbalance, and every day it's building. So with that said, I kind of set the stage on kind of big picture views. I wanted to talk a little bit about Metaplanet. We are a Bitcoin treasury company, but I think people think we are only a Bitcoin treasury company. We're only a box of Bitcoin. And frankly, I don't think there's there's anything wrong with that, because I'm extremely bullish the underlying asset. So I'm happy to be sitting on a huge pile of Bitcoin, but Metaplanet is more than that, and I would like to share with you why. So as of the current last quarter, Metaplanet has 250,000 retail shareholders in Japan. So that's about 1 out of every 600 people in the entire country, men, woman, child, elderly, is a shareholder of our company. And to be transparent and frank with you, and I'm sure many of you know, the Bitcoin and our common stock from June of 2025 has been in a pretty tough downtrend, right? In the face of that, what's happening? Bitcoin adoption through Metaplanet is soaring. Why? Well, Japan's a bit interesting. It's a conservative culture. Mt. Gox happened, and it was sort of this like corporate culture shock, PTSD, right? And so Bitcoin and the crypto digital asset space more broadly was sort of viewed for a long, long time as untouchable, right? And Metaplanet came in 2024 and really broke that taboo. And it's one of the things that the individual, the retail shareholders, for the first time, had a way to express their view of the world in something that was familiar, right? And so, not to get too much in the weeds, but everybody in Japan has a securities account. If you want to log into a crypto exchange and buy Bitcoin, never mind all the tax considerations, there's physical paperwork, it takes weeks, the bid-ask spreads are very wide. There's not nearly the amount of adoption for crypto digital asset native onboarding versus brokerage account financial securities, right? And so why are we seeing this? I mean, frankly, the exchanges in Japan, the Bitcoin trading volume, really dried up at the same time that Metaplanet exploded, right? And so people, for the first time, had a way to express their view of the world in something they're already familiar with, a brokerage account. So what's next for Metaplanet? Why are we not just a big bag of Bitcoin? That's what the skeptics say, is we're just a holding company that does nothing else. Well, what's the grand vision for us? How can we capitalize on this dynamic? 250,000 retail shareholders and growing. And to put it in context, it's one of like the top 30, 40 companies in all of Japan, right? And so there's a real movement, there's a real magic in the air, despite the drawdown. And I think you saw this in a similar way in kind of the previous cycle in 2022 with MicroStrategy, right? It was only the believers left. It was only the believers in Bitcoin, the fundamental hodlers and drivers of this adoption curve were the only ones left at the end of the ghastly bear market. So what's next for Metaplanet? Well, our vision is really to be a full stack financial platform globally, but based in Japan. And so, we have a huge collateral base, but there's so much more to do. And so we're really, really focused on how do we make Bitcoin as a collateral foundation for equity, for credit, for debt. It could be through a perpetual preferred, but it also could be through private notes, Bitcoin-backed lending, various structured products, other securities. The reality is a lot of the world can't handle, touch, interact with native spot commodity Bitcoin. And I want to preface that by saying everybody should buy Bitcoin and send it to cold storage, and there's nothing that can replicate that self-sovereignty. But if you talk to Capital Group or if you talk to trillion-dollar asset managers, they cannot buy spot Bitcoin in cold storage and send it to their ledger. It's just the reality. So, there's 95% of the capital in the world can't actually interact with a commodity. They need a security, they need something that they know and that has the regulatory backdrop behind it. So what does Metaplanet do? About a week ago, we acquired Cboe Securities. It's a small online digital native bond brokerage firm in Japan with a Type 1 license. So upon closing, that will be renamed to Metaplanet Securities. And the vision is to onboard our retail audience into a full stack Bitcoin native financial platform. Not crypto, but Bitcoin focused, Bitcoin at the core. And so the securities is just one piece of the puzzle for us. I mean, really, we see the Treasury driving the value of the company, but synergistically, securities, asset management, lending, these are all things that we're studying and working on intensely. And so what's the total addressable market for us, or not even for Metaplanet, but for Bitcoin in general in the capital markets? And Japan is particularly relevant because there's a huge fixed income market, there's a huge amount of cash savings earning nothing, right? And so just to give some context, the junk bond market in Japan does not exist, right? And so when we're looking at junk fixed income paper to try to study what could be possible, there literally isn't one. 6% fixed income in Japan is like the junkiest junk bond you could possibly ever dream of. And so there's a gap in this market, and we think we have a way to fulfill some of that demand. And so, I think just to kind of step back a little, right now Bitcoin sentiment is totally in the gutter. We are deeply convicted, and we are rallying over in the East hundreds of thousands of diehard believers of Bitcoin through Metaplanet. And our goal is to onboard all of Japan, as many as we can, into the asset and build a foundation on Bitcoin for the long term. And so in due course, we will find a bottom. Bitcoin will do what it always does and rip the faces off all of the bears. And at that point in time, when Bitcoin doesn't die for the 15th time in a row, we will be positioned. Our goal is to be a full stack financial platform domiciled in Japan, operating at a global scale. And our goal on a long time frame is to accumulate 1% of the network. And so we have some work to do. We have our work cut out for us, but we think Japan is a really unique market, and we think we have a quasi-monopoly in that market. And so I think that is, so this is just our shareholder meeting about a year ago. And so this is on a Monday morning. For context, this is an extraordinary general meeting. So you have annual meetings for shareholders. You have extraordinary meetings when you need to amend the articles of incorporation or authorize, new classes of shares, et cetera. This is an extraordinary general meeting. And so for people that, we have a lot of TradFi members of our team that have been in the capital markets in Japan for a long, long time. This doesn't happen for any company, even the mega caps. And so there's something in the air here, and I think we've really, we've caught in a bottle, lightning in a bottle with the captive latent, Bitcoin native energy. So with all that said, I think I'm gonna wrap it up. I apologize for jumping around a little bit, but thank you for all being here. It really means a lot. Thank you for the BFC team, and thanks for tuning in. This is a bottom formation that's happening. Bitcoin's not going to die. I think it is. Well, maybe you're in the wrong room. We're going to go over, briefly the Bitcoin thesis, but in general, I want to zoom out, take a look at the market conditions. Everyone that's a Bitcoin holder, it obviously has been a tough 12 months. But the question I want to pose to everyone today is, has the thesis changed? What does the market look like? And where do we go from here? Okay, so I won't spend too much time on this slide. This is pretty basic, and I imagine 95% of the people in this room understand this. But if you don't, or you have more questions, or your conviction in this, in these fundamental principles is wavering, then happy to chat after the talk, but I won't spend too much time on it. So, I just kind of wanted to put some numbers to what we're seeing here. I almost titled the talk, "Bitcoin is Dead, Long Live Bitcoin." I tweeted that about a week ago, and it led to some confusion among the Japanese audience. And so, I decided to, not go with that provocative title. But, to rewind, I guess, I work at Metaplanet. We're the third largest Bitcoin treasury company. We hold about 40,000 Bitcoin, so about 20 basis points of the Bitcoin network, give or take. And the journey started for us about 2 years ago, April of 2024, so a bit more than 2 years. And the company was just, a small hotel company with a 14 million market cap. Today, despite the extreme volatility of Bitcoin and even more extreme volatility of the common stocks of companies holding Bitcoin, we're about a $1.8 billion company and change, and we have about $2.5 billion of Bitcoin. So it's really been a transformational 2 years for us, and I'll explain how we made that happen. So this chart, what are we looking at? This is the 200-week moving average for Bitcoin. So no fancy analytics here, simple moving average. Warren Buffett buys assets under the 200-week moving average. A lot of people, regardless of the asset class, will put something on their watch list. If it's under the 200-week moving average, it's maybe a decent time to start accumulating a position. And so the bottom here, this is the quantiles of the 200-week moving average and Bitcoin's price relative to it. Right, so we're in about the sixth percentile in all of Bitcoin's history relative to the 200-week. Could Bitcoin go lower? Absolutely. Who knows where the bottom is? But this is a bottom formation that's happening. Bitcoin's not going to die. If you think it is, well, maybe you're in the wrong room. But this is what the bottom looks like. I can tell you that sentiment in 2022 and all of the other bear markets felt just like this, with a different flavor and different kind of talking points. So here's kind of another one of these charts, right? The magic of Bitcoin is we can see the supply with 100% transparency. And so it's like, how valuable would the data set be if you could see every gold bar in the entire world, when it changed hands, to who it changed hands to, at what price? It would be a $1 trillion data set. That'd be really extremely valuable to any capital allocator. With Bitcoin, we actually have the data, right? And so we can look at all of the coins in the network, when they last moved, when were they acquired, at what price. Is there some noise in that? Yeah, there is, right? If you change wallets or upgrade your cold storage, or an exchange shuffles some UTXOs around, it changes. But net, this is a pretty useful kind of signal of, okay, what's the aggregate market profile look like? You can kind of see the previous bear markets, right? So the current amount of the Bitcoin network that's in a loss is right now about equivalent to March of 2020, when we wicked to $3,000. Right? So Bitcoin's at 60K. The bears are ever confident, 50K, 40K, 30K, 20K, it's over, zero. But this is how it is every bear market. I think for those around in 2022, the calls were deafening for 12, 10, 8, 5, $3,000. We bottomed at 15, right? There was seemingly no catalyst for Bitcoin to ever go up again, and it did. And so we'll check out why. So again, this is kind of for people familiar with the on-chain world and this kind of emergent class of analytics. This is one of these, really popular, frameworks. It's called, this is a long-term holder supply. And how do you quantify a long-term holder? It's give or take. There's a statistical analysis component to this, but give or take, if a coin doesn't move for about 6 months, then we put them in the long-term holder bucket, because the probability that those coins move is much, much less statistically than a coin that just moved 10 minutes ago. A coin that moved 10 minutes ago is very likely to move again. A coin that's been hodled for 6 months, 1 year, 2 years, 5 years is not likely to move. So right now, what do we see? We see about 82% of the network in long-term holder hands, right? And these are the people buying at 60 2 years ago, at 120 last year. These are everywhere in between. This is the amount of the network in the hands of really the believers. Maybe it's me and you, or maybe it's, maybe you're not a believer of Bitcoin, but the people buying this right now and holding it are the people that deeply, deeply believe in Bitcoin. So, an interesting pattern has emerged here, right? In a bull market, what you often hear, especially on X and Twitter with all the noise, is supply squeeze. Supply squeeze. Bitcoin's going up. Why? It's a scarce asset, more demand than supply. It's a supply squeeze. But actually, that's a little bit of an inverted truth. In a bull market, you can see that there's actually a distribution, right? So the people that were stacking Bitcoin at $3,000, at $15,000, they take a little slice off at the top, right? What's happening now? It's the opposite. So right now, actually, you hear it, it's deafening at the peaks. Right now, there's no reason for Bitcoin to ever go up again. But what do we have forming? A supply squeeze, right? And so eventually, all of the willing sellers, all of the forced sellers, all of the people that are saying, okay, it's over forever, just take their ball and go home, right? They sold. And who's buying? It's the convicted long-term holders, right? And so eventually, just like you saw in 2022, through the depths of the bear, what do you see? Relentless accumulation, right? And then into the bull, there's a bit of a distribution. This is how Bitcoin's maturing, and it does it in these big, long 3 to 4 year macro cycles. So there's a lot of noise in between. But fundamentally, why will Bitcoin ever go up again? Well, the ETFs are selling, and Sailor's going to get liquidated, and Quantum's going to send Bitcoin to zero, and there's all these different narratives going on, and it's deafening, right? There's no reason for Bitcoin to ever go up again. This is the reason. It's just a fundamental supply-demand imbalance, and every day it's building. So with that said, I kind of set the stage on kind of big picture views. I wanted to talk a little bit about Metaplanet. We are a Bitcoin treasury company, but I think people think we are only a Bitcoin treasury company. We're only a box of Bitcoin. And frankly, I don't think there's there's anything wrong with that, because I'm extremely bullish the underlying asset. So I'm happy to be sitting on a huge pile of Bitcoin, but Metaplanet is more than that, and I would like to share with you why. So as of the current last quarter, Metaplanet has 250,000 retail shareholders in Japan. So that's about 1 out of every 600 people in the entire country, men, woman, child, elderly, is a shareholder of our company. And to be transparent and frank with you, and I'm sure many of you know, the Bitcoin and our common stock from June of 2025 has been in a pretty tough downtrend, right? In the face of that, what's happening? Bitcoin adoption through Metaplanet is soaring. Why? Well, Japan's a bit interesting. It's a conservative culture. Mt. Gox happened, and it was sort of this like corporate culture shock, PTSD, right? And so Bitcoin and the crypto digital asset space more broadly was sort of viewed for a long, long time as untouchable, right? And Metaplanet came in 2024 and really broke that taboo. And it's one of the things that the individual, the retail shareholders, for the first time, had a way to express their view of the world in something that was familiar, right? And so, not to get too much in the weeds, but everybody in Japan has a securities account. If you want to log into a crypto exchange and buy Bitcoin, never mind all the tax considerations, there's physical paperwork, it takes weeks, the bid-ask spreads are very wide. There's not nearly the amount of adoption for crypto digital asset native onboarding versus brokerage account financial securities, right? And so why are we seeing this? I mean, frankly, the exchanges in Japan, the Bitcoin trading volume, really dried up at the same time that Metaplanet exploded, right? And so people, for the first time, had a way to express their view of the world in something they're already familiar with, a brokerage account. So what's next for Metaplanet? Why are we not just a big bag of Bitcoin? That's what the skeptics say, is we're just a holding company that does nothing else. Well, what's the grand vision for us? How can we capitalize on this dynamic? 250,000 retail shareholders and growing. And to put it in context, it's one of like the top 30, 40 companies in all of Japan, right? And so there's a real movement, there's a real magic in the air, despite the drawdown. And I think you saw this in a similar way in kind of the previous cycle in 2022 with MicroStrategy, right? It was only the believers left. It was only the believers in Bitcoin, the fundamental hodlers and drivers of this adoption curve were the only ones left at the end of the ghastly bear market. So what's next for Metaplanet? Well, our vision is really to be a full stack financial platform globally, but based in Japan. And so, we have a huge collateral base, but there's so much more to do. And so we're really, really focused on how do we make Bitcoin as a collateral foundation for equity, for credit, for debt. It could be through a perpetual preferred, but it also could be through private notes, Bitcoin-backed lending, various structured products, other securities. The reality is a lot of the world can't handle, touch, interact with native spot commodity Bitcoin. And I want to preface that by saying everybody should buy Bitcoin and send it to cold storage, and there's nothing that can replicate that self-sovereignty. But if you talk to Capital Group or if you talk to trillion-dollar asset managers, they cannot buy spot Bitcoin in cold storage and send it to their ledger. It's just the reality. So, there's 95% of the capital in the world can't actually interact with a commodity. They need a security. They need something that they know and that has the regulatory backdrop behind it. So what does Metaplanet do? About a week ago, we acquired Cboe Securities. It's a small online digital native bond brokerage firm in Japan with a Type 1 license. So upon closing, that will be renamed to Metaplanet Securities. And the vision is to onboard our retail audience into a full stack Bitcoin native financial platform. Not crypto, but Bitcoin focused, Bitcoin at the core. And so the securities is just one piece of the puzzle for us. I mean, really, we see the Treasury driving the value of the company, but synergistically, securities, asset management, lending, these are all things that we're studying and working on intensely. And so what's the total addressable market for us, or not even for Metaplanet, but for Bitcoin in general in the capital markets? And Japan is particularly relevant because there's a huge fixed income market. There's a huge amount of cash savings earning nothing, right? And so just to give some context, the junk bond market in Japan does not exist, right? And so when we're looking at junk fixed income paper to try to study what could be possible, there literally isn't one. 6% fixed income in Japan is like the junkiest junk bond you could possibly ever dream of. And so there's a gap in this market, and we think we have a way to fulfill some of that demand. And so, I think just to kind of step back a little, right now Bitcoin sentiment is totally in the gutter. We are deeply convicted, and we are rallying over in the East hundreds of thousands of diehard believers of Bitcoin through Metaplanet. And our goal is to onboard all of Japan, as many as we can, into the asset and build a foundation on Bitcoin for the long term. And so in due course, we will find a bottom. Bitcoin will do what it always does and rip the faces off all of the bears. And at that point in time, when Bitcoin doesn't die for the 15th time in a row, we will be positioned. Our goal is to be a full stack financial platform domiciled in Japan, operating at a global scale. And our goal on a long time frame is to accumulate 1% of the network. And so we have some work to do. We have our work cut out for us, but we think Japan is a really unique market, and we think we have a quasi monopoly in that market. And so I think that is so this is just our shareholder meeting about a year ago. And so this is on a Monday morning. For context, this is an extraordinary general meeting. So you have annual meetings for shareholders. You have extraordinary meetings when you need to amend the articles of incorporation or authorize, new classes of shares, et cetera. This is an extraordinary general meeting. And so for people that, we have a lot of TradFi members of our team that have been in the capital markets in Japan for a long, long time. This doesn't happen for any company, even the mega caps. And so there's something in the air here, and I think we've really, we've caught in a bottle, lightning in a bottle with the captive latent, Bitcoin native energy. So with all that said, I think I'm gonna wrap it up. I apologize for jumping around a little bit, but thank you for all being here. It really means a lot. Thank you for the BFC team, and thanks for tuning in.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
I think what they do is they wake up every day saying, how can I make my Bitcoin more productive while preserving the underlying properties as to why I bought it in the first place?
So I think the core thesis of this panel is going to be around how to generate value from Bitcoin on the balance sheet without exposing yourself to some kind of existential risk, right? And the main sources of risk historically have been sort of smart contract, bridging risk, deploying assets on chain, as well as the sort of rehypothecation risk that a lot of firms encountered last cycle with sort of the lending chains that existed in the market structure. So maybe just to start with Hunter, thinking about CFOs and how they approach drawdowns, right? They're obviously CFOs are very risk averse, but they still want to access working capital, and they want to avoid triggering capital gains. They want to avoid, having an event where they have to sell the Bitcoin at the lows. So what is the best way for them to think about modeling kind of the volatility risk, what LTV ratios and things like that? And I know that your company is focused on advising and helping firms access that working capital. So,
yeah, I mean, I think the first thing I'd touch on is really for all of us in the ecosystem, it's important to build the utility of Bitcoin to help attract more capital into the ecosystem. And so I think providers of, all sort of across the spectrum are important. And I was giving a talk in the UK recently and did a little bit of research, and I think it just exemplifies some of the power that I think Bitcoin can have even at a suppressed price. And that pre-pandemic in the UK, businesses, small businesses and medium-sized, were getting approved for loans at around a 70 to 80% rate. Post-pandemic, it's now down to a 30 to 40% rate. So as a business, if you can't even get capital off your revenues, off the strength of your business, how are you going to be resilient? How are you going to grow? And I think Bitcoin on the balance sheet creates that opportunity as an asset class that provides greater flexibility. And so we lend against it and do help sort of, provide advice in a credit partnership to how to think about it. So it can be a yield generator, it can be a liquidity provider. And then Joshua, to get back to your question, in terms of how do you think about protecting it, I think about it as a framework. I think LTV is your friend. And so you can start at a lower LTV, get comfortable with it, understand how it behaves, how you would manage it. Second tier for me is really what are your reserves? What is the other assets you could bring to bear to sort of protect your position, and how would you manage it? And that would go along with a proactive strategy about when you would do that and how much you would do. And the third is what are you looking for in terms of terms and conditions related to the loan agreement? Because I think lenders like Arch and Salt and others have very different terms than what are on chain. Many of them are very advantageous, no rehypothecation, very clear in terms of what they're going to do with the collateral, and then also look for other downside protection. How can you take some of the risk out of the volatility of the loan that you might have?
That's great. And Himanshu, at Arch Lending, we know that you have a sensitivity to kind of rehypothecation. And you've taken a different approach to a lot of lenders in the previous cycle, which relied very heavily on rehypothecation. How do you think about the product set that you offer companies in the space?
For sure. I think rehypothecation as a concept really died out after the last cycle, and most lenders today are very comfortable going out to market with non-rehypothecating products. Really, the risk is the counterparty risk there. If you are rehypothecating and you have counterparty risk or duration risk in the Bitcoin that's being lent out or being used to generate yield, when your borrower wants to get the loan done, they want to prepay it or they want to close it out, that Bitcoin may not be there. And I'm not even going to speak about the counterparty risk that introduces, that's introduced by introducing the concept. So we've taken a staunch approach to not do it. However, I think there are opportunities now with structured products, with options to introduce some of the benefits of what people would perceive from rehypothecation, which is frankly a lower rate. We've done that. So we have structured products that we work with different treasuries on, where you can do either a collar or a put protected option or a yield enhancement, which does kind of mimic those structures, but doesn't introduce external counterparty risk and protects you as a borrower, where you don't have liquidation, you don't have margin calls, and your rate gets significantly discounted as a result. I think back then when people were lending out at 14, 15%, rehypothecation was attractive. I think today, if you're a Treasury borrowing, you're going to be in the single digits and you're going to be quite comfortable with the rate. So even with no rehypothecation, there's a very attractive rate to be had. But if you do want some structured products, we can have a discussion on what that means to you, how involved do you want to be, are you a financial end user or not, and then we can see how that goes moving forward.
Hunter, do you have anything to add?
No, I think the fact that there's a lot more traditional capital understanding Bitcoin as an asset class, as Himanshu said, the rates are coming down. And I think that's going to allow lenders to provide more options and innovative products, one, that are both simpler, and two, provide, solve the problems that businesses have.
Yeah, I think one big difference between that, the last cycle and now is how capital markets have evolved. In the past, it was retail capital from deposits being lent out, all duration mismatched, and if you had a bank run situation, you'd be in big trouble. Today, there's a number of different structures. Most lenders today have capital facilities at scale. We did our first tokenized CLO earlier this year, which basically was an on-chain securitization of a facility. And I think like we've seen other lenders do that as well, where we actually have duration matched capital at scale at decent rates and accessing traditional finance to fund those facilities, which lets us grow in a much more sustainable manner.
I want to touch a little bit on structured products just generally in crypto. So there have been a number of notable launches. I think Blackrock just announced a new ETF that is effectively a Bitcoin overriding strategy. Neos has had one in the market for at least I think a year, with about $1 billion in assets. There is a big focus on using derivatives and options to generate yield. Can you guys talk a little bit about what you're seeing in the market there?
Sure. I think from a lending perspective, and you know this because we work with you on this, the idea really is that you want to reduce risk and you want to increase the yield on the Bitcoin that's there, so that you have a rate that's attractive enough for you to go deploy into something else and be accretive from that use case. So what we offer is callers, where you can have a put and a call that's sold at a premium. And as long as Bitcoin stays in that range, you don't have margin call risk or liquidation risk, and the option premiums actually pay down the interest rate, so it's quite attractive from that perspective. Now, the other side of that is just placing one side of that trade, where you either have a put or a call. And if you have just a put, it protects you from liquidations. It does come at a slight premium. If you have a call, that enhances the yield and gives you a bit of a benefit. Now, I know there's a number of other structures as well. There's covered call strategies that people apply. I know Bitfires just did something with Nakamoto where they're doing a covered call strategy on their Bitcoin. I think our goal as lenders and people providing services to Bitcoin treasuries should be to give them a menu of options and let them kind of choose based on their risk parameters and their goals. A bigger balance sheet may have a smaller hurdle rate that they're targeting versus a smaller balance sheet that's looking to grow. Like, for example, we have a product called the Bitcoin Accumulator, which is a structured product to help grow the balance sheet for treasuries. So there's different use cases, and I'm sure you have some stuff you want to talk about there too.
Yeah, I mean, I guess the thing I would say is it's exciting to see different products come out, both from ETFs, what Strive and Strategy are doing. But at the end of the day, I think if you own spot, and the more we can do to encourage individuals and companies to own spot, you get additional capabilities that go along with it, and how you can leverage it in terms of speed of action. And I think it's important to continue to build the plumbing. We were talking a little bit before we came on about how do we enable that, because then collectively, again, going back to, we've all got to build more value to bring more capital into the space and show that you can use it for your advantage, whether it's liquidity, whether it is yield, but really help businesses be more resilient and more stable. Because I think if we think in the age of AI, that we're going to have a lot more smaller and medium-sized businesses that are going to need these financial tools, and they can be less sophisticated and simpler, or they can be more sophisticated depending on the knowledge and the appetite, but it's important to build the menu.
That's great. And switching gears a little bit to the more technological aspect of things, Jay, do you want to talk a little bit about what you're doing at VerifiedX, in particular, avoiding some of the kind of smart contract risk that's kind of inherent in deploying Bitcoin on chain to generate yield?
Yeah, no, thanks for the question. So let's put tech aside for a second. I think that to date, we've been largely faced with the issue of, choosing between utility and security, and we don't have to make that trade-off anymore. right? You know, we've done a really great job as an industry of financializing Bitcoin. What we haven't done as good of a job of is creating utility with it, right? So I think from our standpoint, our thesis is let's bring Bitcoin into the at the protocol level. Let's activate a consensus with features where we can reduce rehypothecation, we can reduce counterparty risk, bridges smart contract vulnerabilities, perfect the underlying rights of ownership, and maintain native redemption liquidity, right? I don't think institutions wake up every day thinking about how do I squeeze an extra 2% out of my Bitcoin. I think what they do is they wake up every day saying, how can I make my Bitcoin more productive while preserving the underlying properties as to why I bought it in the first place? So, for us, it's the first iteration of acquiring Bitcoin. The second iteration was how do I custody Bitcoin? The next iteration, in our opinion, is how do I turn Bitcoin into programmable financial infrastructure?
That's great. And you guys recently launched sort of like a privacy layer around moving your VBTC product. Can you talk a little bit about that? Like, that is obviously an important feature of most institutional markets where there is a customer confidentiality and privacy around transactions. How have you guys been building around that?
Yeah, so it's really interesting. Privacy is a narrative that we're hearing a lot about today in the marketplace. It's a little controversial at times. How do you effectuate a privacy transaction but maintain compliance at the same time, right? I think that confidentiality is a business requirement and compliance is a regulatory requirement. So for us, we embedded in our consensus a Planck-based system with zero knowledge proofs, with Merkle notes, but all that technical jargon aside, what happens is you have viewing keys and whitelisting that allow you to share that with the appropriate counterparties for a purview of transaction history and real-time auditability, right? So I think that we're living in a world now where privacy is certainly important in order to shield treasury management movements and trading strategies to maintain that competitive edge, but also at the same time to maintain a level of compliance. So, I think confidentiality and privacy, compliance, can coexist at the same time for sure.
Thanks. We live in a world where AI is kind of top of everyone's minds these days. And, obviously institutional grade service providers like yourselves, right, have a lot of sophistication around risk management, compliance, collateral management, and things like that. Can you talk about how some of the tooling around these things has evolved inside your companies when you're dealing with these Bitcoin-backed loans?
Sure. I think we made a conscious decision to build our platform from a technology-first fashion, not an operational-first fashion. So we have thousands of clients that we serve, but it doesn't require a human in the loop at any point in the system. So it's everything from onboarding, KYC, KYB, trust onboarding, whatever, all the way up to margin calls, liquidations. It's fully automated, which lets us, with a very small team, serve a large number of clients, whether you're borrowing $5,000 as retail or $50 million as an institution. And it just goes to say that I think a lot of lenders in the past, and maybe some today as well that are more on the institutional side, do serve a large number of clients, but it's very operationally heavy. So we made that decision. It's helped us grow. We built our own ledgering, which really was a conscious decision that let us do different kinds of loans. I think if you build on top of someone else's ledger, which a lot of companies do, it restricts you to the suite of offerings that they have. We have now 7 different loan offerings, which work because we have our own ledger. And I think that's been a very good decision that we made. Moving forward, we're going to plug into more venues for trading, obviously. We already do that with some, but we'll continue to do it further. And as we offer new products around yield and stuff, we'll have more integrations there. But everything always is technology first, with a human element that adds to the comfort and gives you a client representative that's always there for you. But it's a system that rules it all.
I don't think this industry has a problem being technology first. I think, it's all when nothing existed when we started, and so have built a very sort of customer-centric platform to really enable the technology. I think it's one of the things that the companies are doing well, and why the public markets are interested in funding the loans, because of the technology that allows the liquidation and the management of the loans at a very essentially risk-free manner. I think the utility of interoperability is exciting in terms of a little bit what Jay was saying about sort of custody at different partners, where we have a lending as a service offering that we're working with people, so custody can stay on different platforms, service the customers there, have the level of privacy, have the level of protection, but help the utility, people get more utility out of the Bitcoin without having to move in. And I think we'll see more of that happening as both the market grows geographically as well as in size.
Any thoughts, Jay?
Yeah, I think I agree completely. And I think that, by doing so, we're going to help be additive and even help restore, the true scarcity properties of Bitcoin and largely on-chain price discovery.
All right. Maybe more of a quick one for all of you. What is the single biggest kind of operational or structural bottleneck for companies who want to switch from a passive, cold storage strategy to something more active?
Well, I think it's education. The first step, and I think at least I can speak to both of our companies, we require assets in qualified custody. And in the past, you often had cold storage, or you often had a non-custodial setup because you could access DeFi rails with it. You can do that now with a qualified custody offering, whether it's BitGo or Anchorage or some of the other custodians out there. So we can bring the level of safety, the bankruptcy remote treatment, the insurance that you get from qualified custody into your operational flows today, and then you can access platforms like ours. You can access DeFi if you want to, and you can access different structures while keeping your Bitcoin safe in custody. And I think that's a new avenue that wasn't quite there in the past. I find that most treasuries starting today do hold qualified custody, so I don't think that's really a bottleneck, at least not one that I've experienced. But really, it's the education. I think most treasuries don't know what they can do. The whole treasury market is very new, right? Outside of the few big ones, most of them are very new. They've launched in the past year. They've just gotten past the first era of buying the Bitcoin that they have, and now they're trying to find the utility. So I think the biggest bottleneck really is education. And I spend all my time educating people on what you can do with it, giving them the options. And once they have the options, they can make an educated guess or an educated decision on what makes sense for their business and for their goals.
Yeah, I mean, I would amplify the education and also helping people understand the benefits of the strategy, right? We're in a world where both as an individuals and businesses, the tactics of being capital efficient, being tax efficient, and operating with speed in terms of the asset is unprecedented in terms of what larger companies and high net worth individuals has been doing for centuries. And I think you just have to get out there and try it. And I would argue that at a depressed price, now's a great time to sort of experiment and learn. But that's the big thing. I do a lot of work with small and medium-sized businesses from a sort of education and teaching perspective. And they are experts on what they're operating in, not experts on the balance sheet. And so there's a simplification and ease of onboarding that will be required to help them understand how to take advantage of it more. And I think that will be a real enabler, especially as all the plumbing and the piping gets put together and there's a better offering out there.
Yeah, I was just going to say that, this comes down to responsible optionality, right? We have to move from a passive store of value on the balance sheet to a productive asset on the balance sheet. And I think that comes with, a variety of different potential features. Again, not changing the underlying properties of what made Bitcoin Bitcoin. So I think it goes a little bit beyond education. I think that we actually have to put features into the market, connect the plumbing, and actually, give allocators options that they can plug into and utilize today.
That's great. All right. Thank you all.
Thanks, Josh.
Thank you.
Thank you.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
The European institutional investor base is massive, obviously, but also very fixed income focused. European fixed income is very much a fixed income culture. You got all the massive pension funds, all heavily weighted towards fixed income instruments. Kind of hard to get yield right now. I mean, I was in high yield credit for a long time, and high yield credit is basically very low yields these days. So I think that in itself is a big opportunity set.
Think about the scale of AI. How is AI going to use this? People just think that AI is just going to use it to pay. But what is AI? What do robots need? What do people need on a global network? A true extension of the internet. AI wants to use it for validation, authentication, accessing data, and they need to have it happen at the blink of an eye. In other words, money, which is trust, especially for agents and robots, needs to move at the speed of intelligence. You're not going to get that with Visa and MasterCard, but you're going to get that by being able to send, 1/1000th to 1/10,000th of a penny working sats with the blink of an eye to validate. And effectively, the Bitcoin address that they can validate that they have becomes the agent's agentic soul.
But again, Bitcoin can and will only ever be that safe haven in those types of environments if Bitcoin is viewed by the masses, by traders, as a currency. And unfortunately, we've kind of, as Bitcoiners, shot ourselves in the foot a little bit by calling Bitcoin digital gold, a digital store of value, rather than calling it what it truly is, the most perfect form of money that humanity has ever conceived.
Bitcoin is different. Like, Bitcoin has a fundamentally different value proposition. So I think this idea that it's a leveraged tech play is wrong. Let's start with the price action. That's like the elephant in the room. Let's go one by one. What do you guys think is some theories around Bitcoin's underperformance compared to, say, equities and gold over the last 6 to 12 months? Let's start with you and just go down.
Yeah, hi everybody, I'm Henry. I guess I didn't end up on the panel, but I'm from Silicon Valley Bank. I think the main kind of takeaway for me is it's always the question of liquidity. Where is liquidity going? Where is liquidity coming from? And today, all of liquidity is going to AI, and we're starting to see more and more of these mega IPOs happen, which means that there's an unlock actually of liquidity for people who are tech curious. So for me, we're at this point where we've seen liquidity move from higher risk assets into AI, where people think that their capital might be safe, or it might actually have some kind of underlying value. And now, as some of these unlocks start to happen with IPOs, and some of these AI companies are starting to potentially top out, you'll actually see a movement of liquidity from those to higher risk assets or longer tail assets, including Bitcoin.
There's a lot of shiny things out there right now, and it's moved liquidity. I mean, I'll give an easy answer, right? Warren Buffett famously said, "When people are fearful, be greedy." So this is not investment advice, but that's certainly my my ethos right now.
Hi, Greg Barras here from Kraken. Look, I think from my perspective, anyway, Mike's acting a little weird, but I think that when I look at asset pricing, I think about it kind of relative to both the real and nominal yield curve. So what you've seen over the last 2 to 4 weeks is you've had inflation expectations completely drop. When you look at 1-year forward inflation swaps, they're down by 95 basis points. At the same time, nominal 2 years have continued to rise. So you've had this kind of flattening of the real yield curve. So in the near term, you have this higher real yields, which kind of weighs on the interest differential aspect of any kind of risk asset or currency. But the market is starting to price in potential demand destruction due to kind of this oil supply shock. So, I think when I look at asset prices in general, and maybe Bitcoin more specifically, that lens for me personally is somewhat helpful.
Yeah, the only other thing I'd say is, probably going off you, Gregory, it's just the macro picture in general, like the uncertainty around the conflict in the Middle East, the whipsawing. Is there a peace deal? Is there not? There's still a lot of uncertainty, and as you said, inflation expectations are rising. We got a new Fed chair coming in, Kevin Warsh. He had an interesting speech last week, kind of talking about how he's going to change some of the things internally at the Federal Reserve. Do you think that Kevin Warsh, being the new Fed chair, is impacting risk assets, anything of the speech or the potential of a new Fed chair kind of changing monetary policy?
Yeah, I don't know necessarily how much it was Warsh himself. Look, ultimately, his main response to every single question was, we're setting up a task force for that. So he himself, and also he didn't put a dot out there, right? So of the 19 dots, there was only, or the 19 members of the committee, there was only 18 dots because he decided not to put a dot out there. But I think it was the hawkish bias of the dots, right? So essentially you went from having a median of 1.5 rate cuts to essentially flat for the rest of the year. But I think what wound up happening was the market said, okay, if we're going to have more hawkish monetary policy, it's actually going to lead to more demand destruction, coupled with the fact that the oil price shock is more of a tax on the consumer. So you've had the initial, to your point, inflation expectations skyrocketed, but over the last 21 days or so, they've come down by like 100 basis points. So it's been this kind of like massive whipsaw where if you assume that you're going to have like more hawkish monetary policy and ultimately demand destruction in the economy, you have higher real yields, but that's because the rate expectations on the nominal curve have not caught up to the expectations on the inflation side.
I also think you have something to do with uncertainty here, right? Markets, generally speaking, hate uncertainty, and we've kind of lived in this bubble of uncertainty over the last year and a half. So when you look at risk assets outside of the AI bubble, I keep going back to that, you're seeing that reflect in price action. And I think once we start to have more certainty in the market, once we start to have more direction, and if we can actually start pricing what might happen with more certainty, you could see an evolution of the kind of the next wave of risk assets.
One of the trends over the last couple of years was there was the launch of the ETFs, and then the share of circulating supply of Bitcoin held by institutions and funds have ballooned over the last, say, 4 years. It went from basically nothing to now almost 20% of the circulating supply of Bitcoin is held with institutions or funds. Do you think that's influenced Bitcoin's trading behavior at all?
I think it's the same buyer. I think people have just moved money off of chain. So people who are buying IBIT in their brokerage accounts, most of those folks, at least that I speak to on a day-to-day basis, are the same people who used to hold their wealth on chain. And so I think that you're seeing this rotation happen of, yes, more people are buying in their brokerage accounts. Yes, there's more access, but I don't think that necessarily changes who the end buyer is outside of large swaths of institution coming in and saying, okay, we're going to allocate 5% of our balance sheet to it.
Yeah, I'd echo, right? The institutions aren't exactly in yet, but we run an exchange, right? And most of our volume is with traditional, boring banks. They're not.
Hey, we're not boring.
But they're almost there, right? And we built a digital business circa 2018 in response to these clients that were asking for it, right? And so they are trading. They're doing hundreds of millions, maybe $1 billion a day, right? Versus a franchise for us that spans 70, 80 billion, so small, but has been meaningfully increasing every year, every quarter, and that's just the trend we see with the clients, with volumes, with the counterparties we're dealing with. So it's clearly one way.
I actually think the more interesting metric will be over the course of the next 2 years when we see more and more commercial banks offer the custody assets, what that turns into in terms of who's holding Bitcoin on their balance sheet. Is it the traditional fintech company that's now holding Bitcoin on their balance sheet because they have access to USDC rails in their commercial banking account? I think that could actually be the catalyst of what happens for the next cycle outside of quote unquote institutions buying. It's going to be the individual institutions on the fintech side, not just the asset managers.
Interesting. So you think the trend of, say, stablecoin adoption that's exploded will actually lead to more Bitcoin demand?
Yeah, I mean, think about what a commercial bank is, right? Commercial bank is, okay, great, you give me your fiat today, I'm going to custody that, I'm going to keep that safe, and you can go out and do your operational activity. If all of a sudden those clients have access to stablecoin rails and then therefore have access to swaps into the large assets on chain, then there's this whole other metric of demand that people are not even measuring today.
Interesting. One of the things I hear a lot from more like traditional finance people when they view Bitcoin, they say, "Oh, it's just a leverage tech play." And do you guys hear that in your conversations? And do you view Bitcoin that way?
I mean, I hate to repeat myself, but I would look more at the steepness of the yield curve, right? I mean, ultimately, you could argue that a steeper yield curve is better for equities, which then leads to a correlation with Bitcoin. But I don't think that's necessarily like correlation being causation. I think to the extent that you have lower real rates in the short end and you have higher long-term rates, which would denote either some level of global growth and or some kind of potential monetary issues, that's probably the best opportunity for Bitcoin to continue to perform well. It does happen that in that environment, tech also does well, but I don't think they're necessarily causing one or the other.
It's more so than that, right? There's also, if you look at the broader industry, there's fundamental use cases. There's real world adoption, right? Stables, the ability to send remittances all over the world, the applications on blockchain. These are real things that are providing real value that you can credit Bitcoin to a large degree as being the catalyst and the support layer for. So there's definitely that aspect that I think is important.
Yeah, I actually started my digital assets journey in 2017 selling structured products to family offices under the thesis that they were not correlated to tech stocks, because back then it wasn't the case. And I think what we're seeing now is it is a leveraged bet, but to your point, Greg, it's a leveraged bet based on liquidity, and it's a leveraged bet based on risk and how consumers and how institutions are willing to lever up their risk.
And also the other thing I'd say is, like, you could argue ever since the war started in Iran, correlations across assets have gotten to one. I mean, oil is becoming increasingly correlated with equities, some of them being positive one, some of them being negative one. But essentially the market is trading on a couple of like major geopolitical themes. So naturally you're getting increased cross correlations across the board.
Yeah, you can make that same argument for access, right? And the ability and ease of trading, right? Hyperliquid has allowed for ease of trading for oil and for other things that typically a retail investor might not have access to outside of derivative products. And now that you do have access to those and people are trading those on an active basis, you're seeing additional correlation.
I think the increased correlation with equities is actually a sign of Bitcoin winning because it's becoming more integrated into the traditional financial system. And then it's having a shared investor base, more institutional investors owning it, looking at it in a whole portfolio, and then having the same risk management strategies, trading strategies with the same flows. And so you see this with like emerging market stocks. A couple of decades ago, you saw that with the hedge fund industry, where they were initially, it was all about the lack of correlation with other, but as they were adopted, as more investors allocated to those sectors, they actually grew in correlations because it's just shared investors doing the same things, looking at the portfolios. And so as Bitcoin becomes more integrated, it's going to be tied more to traditional asset classes. But it's important to know that Bitcoin is different. Like Bitcoin has a fundamentally different value proposition than an equity. You know, equities of a claim on future cash flows. It's valuation multiples, profit margins, earnings growth. Bitcoin has none of that. Bitcoin's driven by its monetary properties and its network effect. It's like a function of how much the fiat's being debased, the openness of capital markets, the credibility of the traditional banking and financial system. You know, that's what drives Bitcoin. So I think this like idea that it's a leveraged tech play, if the correlation's just tied up over the past like year or so, it's wrong. I don't think that's how investors should view it. They should view it as a separate bucket that's hedging against a risk that equity, bonds, cash cannot protect against, which is the credibility of the issuer of the currencies, so the fiat currency debasement. So I think like that will come more and more as more investors learn about Bitcoin. But right now, it's still viewed broadly as a risk asset. But I think that's changing with some of the narratives around Blackrock and these other, the way that the education is occurring. So that should change over time. But with institutional adoption, I think looking ahead at what's a potential tailwind for Bitcoin to kind of pull us out of this bear market. When the ETFs launched, the institutions are coming. That was the narratives. They're coming. But I think we all agreed on our call when we were prepping for this panel that they're not really here yet. It's like extremely, extremely early in terms of the adoption there. You guys all are building in this space, actually providing the infrastructure. So how can we kind of drive that trend more? Where are there gaps in the market that you see? Where does building need to take place? What are you excited about that could really move the needle in terms of getting more capital flowing into this asset?
I'm glad you mentioned infrastructure, right? Like we are an infrastructure provider. We match buyer and seller at the end of the day. But to tie that into macro, right? Macro, I have macro traders next to me, so they'll be able to speak to this a lot better. But macro is everything: inflation, international relations, politics, everything. So you can imagine trading macro themes is quite difficult. And there's a really interesting study that came out this week where an investment firm, they put out a simulation where they asked a bunch of traders to trade based on forward guidance or forward knowledge. It was like, you can trade on Monday, but you had access to Wednesday's Wall Street Journal. It turns out, and they can buy whatever they want, they can apply leverage, they can short. Turns out they did not do so well. I think it was 50% lost money, something like a sixth went completely bust, and the rest made very nominal returns. So not only is trading macro difficult, but even if you have a crystal ball, even if you know what's going to happen, you still don't necessarily do that well, right? And I think the lesson from that is that it's not so much direction or which asset specifically. I think it's more about exposure, the leverage component. And in my mind, exposure is a function of risk, and risk is a function of infrastructure, right? How do you manage risk? Prime brokers, that's literally what a prime broker does, right? Custodians, qualified custodians, exchanges, right? This is the infrastructure that, in my mind, needed to grow and scale and has, to a large degree, that is creating that catalyst, right? And that's why you see qualified custodians. You'll be hearing from Mike Belshie later. That's why you have regulated exchanges like LMAX. That's why you have actual prime brokers, traditional prime brokers that are participating in the asset class. We're working with a lot of them, the traditional names, right? I think that's going to be the one of the most important catalysts.
Yeah, look, building off of that, and by the way, it's from a place called Elm Wealth. It's a really fun exercise. Yeah. It's actually much easier to do the interest rate predictions than to do the equity predictions. But look, what we're doing at Kraken, which is maybe a longer term tale, is the idea of like, at the end of the day, whether you have an asset that's denominated in Bitcoin, Ethereum, fiat, anything, and you want to invest that into any other type of opportunity, whether that's real world opportunities, another crypto opportunity. The example I gave these guys on the prep call was, if you're a Bitcoin holder that wants to hold or invest in a manufacturing plant in some place like Ohio, we're working on figuring out ways to structure those opportunities so that ultimately you really get the convergence of kind of traditional finance and modern finance using our, to your point, infrastructure, our distribution, the clients that we have. And then you really start to look and see that there's no difference between a firm like Kraken and a firm like JP Morgan. It's just that we're doing it in kind of a more modern and sophisticated way.
Yeah, I think my point here is kind of threefold. One is trust. I think trust is completely eroded on chain at the moment, which is part of the reason that these large financial institutions need to come in, commercial banks, prime brokers, exchanges that are trusted so that users can actually feel secure in the assets that they're holding. They don't feel like they're going to get drained. They don't feel like the platform's going to get hacked. They don't feel like their funds are going to get frozen. And I also think it's an access thing, right? So to your point about institutions, yes, institutions were coming when we rolled out the ETF, but really that was access to retail traders or to 401ks or to the individual who's using these brokerage accounts. The access to actual institutions is still actively rolling out. And I think that's where we'll start to see some of the more interesting price fluctuations potentially. And, obviously none of this is financial advice, but when we start thinking about how much capital is sitting stagnant how much capital is not being used on people's balance sheets? What's the yield that's available for overnight sweeps versus other things that you could potentially allocate to? And then the last point is we're seeing a massive amount of VC funding still coming into the industry. Framework just announced a $400 million fund. Han Ventures announced a $1 billion fund. A16Z's $2 billion fund, right? So these are all going to go into additional infrastructure plays that allow for additional access, that allow for more creative ways to put your Bitcoin to use or put your on-chain holdings to use. And I think that will also be a catalyst to allow for just overall sentiment to change in the industry. And part of price action is obviously predicated on sentiment.
Yeah, the only other thing I would say is improving investor access by embedding Bitcoin as collateral with different structured products that fit investors' needs, different cohorts, different investment mandates. I mean, you're seeing that with Strategy, the Treasury companies. But it's not just that, too. I mean, for instance, Battery Finance is another example of a company that are trying to tie real-world credit assets with Bitcoin and dual collateralized loan structures. There's all types of companies building like that, but it's still the early days. And I think Bitcoin as collateral, as pristine collateral being embedded will help drive the adoption of Bitcoin to new heights, to be frank. Now, when I think about looking kind of forward at the macro picture today, there is a lot of uncertainty. What's like one area of the macro picture that you think is important for investors and individuals to pay attention to kind of get a sense of where things might be heading? Like what's a metric or certain policy that you guys think is really important?
You're the macro trader here.
I've already talked about yields, so give me a couple of seconds to think about something else. I mean, look, in terms of policy, obviously everyone here is aware, Clarity Act going through Congress, I think is something that everyone should be thinking about, especially given the fact that, I think it'll be increasingly difficult to get anything done as we get closer to midterms. And, if, there's a divided Congress after November, potentially nothing gets done. So as a kind of a cop-out answer, I'll give you guys that.
It's not a cop-out, right? I think regulation comes up on every panel because it is the single most important driver for adoption in the US, hands down, right? That said, I think we already have a lot of regulation and we have a lot of templates, right? We need clarity to pass for a whole host of reasons, but there are already frameworks that exist that frankly, all clarity will do is just push things a little bit more onshore US, which is important. And if I was a politician, I would be thinking jobs. I'd be thinking about everything that comes with it, which is why it's attractive. But really, right, the train is kind of started, and it's from a US perspective, it's our game to lose, quite frankly.
Yeah, I completely agree with that. You're seeing foundations of protocol companies starting to come onshore again, which I think is great. A great sign of just adoption, generally speaking, and where regulation's heading. My answer is slightly different. I actually think the private credit market is something that's extremely interesting to watch and see how private credit is actually getting rolled out to smaller and smaller consumers or smaller and smaller borrowers. So the folks who are saying, okay, great, you can collateralize $10 million worth of equity instead of it just needing to be $35 million worth of equity or 50 or 100 or whatever it might be for a typical bank to actually underwrite that loan. And that way you have more liquidity flowing through the system at a higher pace and a faster time frame. And I think that's going to be extremely interesting as you're starting to see these companies go from $0 valuations to $60 billion over the course of a 3-year time frame, and you're minting billionaires over the course of a much faster clip than we've ever seen.
Yeah, it's interesting. Mine's pretty simple. I look at the governments and I ask, are they still running massive deficits? Are they still spending recklessly? Because when you look at large, highly indebted governments, historically, when they can't plausibly tax their way out of it or grow their way out of it, they turn to one thing. They inflate the debt away nominally, and then the currencies absorb the damage through lost purchasing power, and then financial repression and capital controls follow suit. That's the macro environment that Bitcoin was designed to thrive in. So with that, I want to thank everybody here. I appreciate all your insights, and thanks for building the infrastructure that helps drive Bitcoin.
Thank you.
Thank you.
Thank you, everyone.
anytime that you launch a new product into the market is going to stress test you. They're going to see how you respond as a company, as a management team. How does the product respond? And we're in the middle of that right now.
Zach, I want to start with you because, Bitcoin is kind of like dog years, where it's like 10 years pass in like 1 year or whatever. But the ETF is kind of like the first OG wrapper launched in 2024. That was like 2.5 years ago, which is crazy. I think that's crazy. But that really kind of brought Bitcoin into Wall Street light, add a lot of validity to the asset class. Why don't you just kind of take us through where we're at now, how you see us moving forward, and just kind of like some of the history of the ETF wrapper?
Yeah, absolutely. So the first filings for Bitcoin ETFs were in 2013, and they didn't come to market until 2024. So 11 years later, a long battle with regulators. Grayscale took the step during that period to sue the SEC. We won that lawsuit. That's why these products came to market. So as the movie title goes, kind of crypto policy and crypto regulatory topics are one battle after another. So we've been through a lot of those battles, and there are more to come. But fortunately, over the hump on the ETFs. We thought that these products would be extremely popular with investors, and I think that has proven to be the case. And the reason is just they're the easy button for Bitcoin investing. There are lots of ways to buy and hold Bitcoin, and there's no wrong way to do that in my view. But if you buy Bitcoin somewhere else, you need to decide, where am I getting that liquidity and what kind of price am I getting the Bitcoin for? How am I holding that? Is that on an exchange? Is it in self-custody? How am I going to do my taxes? How am I going to do the rights of survival if something happens to me, to my family inherits the assets in an effective way? Can I borrow against those assets? In the context of proof of stake networks, how do I stake these assets? So there's lots of things that an investor in digital assets and Bitcoin needs to sort out for themselves. Essentially, the ETFs package all those solutions into a single instrument, and they just make it extremely convenient for investors. Institutional liquidity, custody, and all the normal uses of your brokerage accounts or your tax advantage accounts that you have with other securities, you have this with the ETF. So they're not doing anything complicated. Of course, there's lots of interesting things that Strive and others are doing that go well beyond this concept, but the ETFs are designed just to give you efficient, effective, safe, marginable, et cetera, all these things, Bitcoin exposure. They're a very simple instrument, and they've been very popular for that reason. Bringing us to the present, of course, the Bitcoin ETFs have come a long way. On the Bitcoin side, we've seen an expansion of other types of instruments, things like covered call strategies that build onto this concept. And then, of course, many other altcoins. The SEC now uses something called generic listing standards for crypto ETFs. We don't have to go through the lawsuit and the 11-year process to get other products to market. We have a set of generic standards. And so Grayscale and other issuers are broadening our platform beyond Bitcoin to Ethereum and Solana, et cetera, et cetera, et cetera, long list of other things. So that sort of brings us to the present. I think wildly successful products, a long time coming. I think an excellent way for any investor to build Bitcoin exposure into a portfolio.
Yeah, well, thank you for your service and fighting the good fight on behalf of the community there, suing the feds. Much respect. Yeah, so I mean, it's really interesting, right? So like you mentioned, the success of that launch, kind of what it did for Bitcoin as an asset class, getting more exposure. People can get more exposure to Bitcoin. Kristen, you guys have a very interesting perspective, and we talked about how some emerging markets are for the first time launching their domestic ETF products. Walk us through kind of what you guys are seeing kind of outside the US, if that's going to maybe kickstart a little price action here, more demand for these kind of products worldwide.
Yeah, I'm really happy to share with you guys that as an index provider, we're working with everyone globally, and we're seeing more demand from emerging markets than we ever have before for simple Bitcoin ETFs. And this is just regulatory, right? They've been all wanting to do what the US has been doing, but now their regulatory regimes are opening up. But one of the things that I think is interesting that we were chatting about when you think about Bitcoin, there's no what is the price of Bitcoin? It's more like, what did you exchange Bitcoin for, or what rate did you get? And as an index provider, I have hundreds of Bitcoin indices already up and running. And you're like, why so many? Isn't there just one? But they, of course, have different closing hours, the model that you use to fix it, the data inputs. So I'm hearing from a lot of these emerging market asset managers that they want a domestic Bitcoin index. And what that means is they only want us to use data inputs from their region, and they only want data pairs that might be like, if it's Japan, it would be Bitcoin yen, Bitcoin USDC, and Bitcoin USDT, and that's it. They don't want any other currency pairs to go into that aggregated price. So we're very busy doing these indices right now, but I think that's a strong signal that the rest of the market is coming, and we'll see more pressure or demand on Bitcoin in general.
Yeah, and it's super interesting. I think that's very, encouraging. So, we kind of have like the basic ETF wrappers. I'm a big believer, keep it simple, stupid. Like I'm a big, cold storage guy myself, but arguably the most exciting developments in Bitcoin and finance have been, the preferreds, and obviously a hot topic of conversation now. And Ben, you guys at Strive are clearly on the forefront of this. And I kind of want you to help us peer into your guys' thought process of the financial engineering that goes on at Strive. And I don't use that in like a negative context, but I think you guys have really elevated the wrapper game. And maybe you can kind of just touch on how Bitcoin supercharges your balance sheet, the capital structure, the flexibility you guys have over traditional balance sheet or capital structures.
Yeah, what an interesting week to be having this conversation, huh? Anytime that you launch a new product into the market, that there's going to be a point in time where the market is going to stress test you, right? They're going to test the limits of the product. They're going to test the faith of investors. They're going to see how you respond as a company, as a management team. How does the product respond? And we're in the middle of that right now. So this is a part of this growth process. It's a little interesting because I've never truly considered either of our products through the common equity or through the preferred to be an actual wrapper of Bitcoin. To me, it's a way that we can bring different types of exposures and different type of investment characteristics to investors. So for instance, if you think about the fact that we've got a Bitcoin balance sheet that's got nearly 20,000 Bitcoin on it today, and we've got the amplified exposure, that means that our common equity is going to be highly sensitive to the moves in Bitcoin. So I view it mostly as an enhanced volatility product. That's really attractive to a lot of people that want to take directional bets one way or the other. And what we want is to create the best vehicles for people to express those trades in. So that's what we've done with our common equity. On the other side, there's an acknowledgement that, one, not everybody's found Bitcoin yet. You walk around the streets of New York, you can have the conversation. Most people won't even be able to tell you the issue with the money in their pocket. They've never had the time to stop and think about it. But what we know is that there's always a consistent demand for cash flow. It's a central part of individuals' lives. It's a central part of running a corporation. And so for us to be able to carve off part of the volatility profile of Bitcoin and part of the excess return of Bitcoin and be able to deliver that back to investors in an attractive yield product, I view that as us taking Bitcoin and moving it one step closer to investors where they are today, right? Instead of waiting for them to come to Bitcoin to find out all of the benefits of an asset that you can self-custody, that you can hold, that you can transact with no intermediary in the process, we all know how powerful that is. Most people haven't started the journey. So if we can bring an attractive product out to the masses that provides them day-to-day utility in their life that's made possible by Bitcoin, to me, that is going to help us bring Bitcoin one step closer to them and help them on that journey, to accelerate that journey. Because if the product's good enough for us to issue a product like this into the market, it's probably something that they themselves should want to hold. So that's how we actually see this playing out there in the market, is we have a realization of you have to find the investors where they're at, and that means paying very close attention to what they want. And kind of the trio, if you could really hit the home run in any one of these products, is price stability, right, which is what's being tested right now in the market, high yielding, low volatility, right? Like that's what you're trying to accomplish, and deep liquidity. And when you're trying to do all three, right, that's where the market's got to stress test each one of those. And liquidity right now is the one you're seeing. There's deep liquidity in these products. There has been for a long time. And we think they're just a really unique value proposition that we can make available because we decided to take the step to capitalize our company on Bitcoin, because we can manage the risk as a corporation, right? We can now offer attractive characteristics into the market that it really hasn't seen before.
Well, that's beautifully put. And it's my understanding that, SATA is a daily dividend, first ever daily dividend in U.S. security history. Yeah, well, that's pretty cool. How does that play into like these three legs of the bar stool?
So that was a really big unlock. That's one that we're very proud of. And the reason being, if you think about dividend paying corporations that are out there, only 2% today even pay monthly dividends. You would think in 2026, people would be moving up the frequencies on these because the quarterly dividend really came into play back in 1885. So we still are following a standard practice that was established in the 1800s, which seems crazy. And so being able to unlock daily has a real material impact on how you would expect the security to trade. So if you've got a security that pays one monthly dividend, that means that during that month, there's one date where it's truly economically required to hold the security to get the benefit of the dividend. When we changed over to daily, it means that literally every day that market is open, you've got that day as a record date, that day is a next dividend date, and that date is a payment date. So now it becomes economically beneficial to hold that security every single day and not use it to trade in and out of, right? It could become a landing place for capital. Some people may just find the yields attractive enough that they just want to park, moderate duration capital in there and collect those daily dividends. But you're seeing those dividends hit your account every day, and there's something with investors where that's very comforting, and it's something they've also never seen before. Money markets started getting into that. They had the daily accrual, right? And these are not money market products, but the concept of daily really came out. There was a daily accrual, but it was still paid monthly. And so this is really the first time where you're seeing that benefit in your account every single day. And we think that's a really big unlock. And it's one in capital markets history that was made possible by a Bitcoin company. And I think that's a really cool thing that we can put that feather in our cap, that this is just one more way Bitcoin has changed the financial services industry.
Yeah, no, a huge tip of the cap to you and the Strive team. I did tell you guys pioneers here. So that's amazing. And, Kristen, one of the things I want to really get your perspective on is just, working the indices business. How are you guys thinking about Bitcoin exposure, and what do your clients actually want when push comes to shove?
In terms of how we calculate it or the wrappers?
Both. So I know we talked about, being wrapper agnostic. So it's like, okay, what do they want to see, and how are you guys helping them see that?
Yeah. Well, I actually just want to say, I think it's funny that someone thought this was a controversial panel, because I think having multiple wrappers for access is so healthy for any ecosystem. I work at FTSE Russell. Today is Russell Recon Day. It's the day we reconstitute the whole Russell series. And why that series is so well adopted is because we've got futures, options, a lot of ETFs, mutual funds, like all kinds of wrappers working together. So you have different instruments to hedge with. So I think it's great that we're seeing DATCO companies and ETF companies, perpetuals, futures, all of that on Bitcoin. And then from the indexer's perspective, like I said, it's really interesting that something as simple as Bitcoin, you could be calculating different rates for Bitcoin depending on the wrapper. I'm going to get really technical and boring for 1 second, but for our derivatives clients, they want us to do a time-weighted model. So as you get closer to 4 o'clock or whenever they're rolling, you want the pricing information to mean more. So we do a 15-minute time-weighted look back. For the ETFs, we use a 1-hour simple average look back. So the market makers can make the market between 3 o'clock and 4 o'clock and have a little bit of room to make some money on their own as well. So I just think it's interesting that this one instrument can demand so many different indices or calculations for all the different wrappers, but they work really well in concert together.
Yeah, and it's just a great logical point and explanation, because we're definitely going to get slandered on Twitter because of this title, but it just goes to show, like in real life, people need different sorts of exposure, and that's not a bad thing. And Zach, you kind of alluded this to the beginning, but derivative products very important, crucial underlying plumbing to financial markets, and we're really kind of seeing a big developments of derivatives within Bitcoin. So you spent the better part of 2 decades in macroeconomics. How are you seeing the derivatives market in Bitcoin developing, and what does that mean in terms of deepening Bitcoin capital markets and maybe some opportunities that's going to unlock in the future?
Yeah, I'll offer a couple things. Maybe I'd just address the thing about the panel or the wrappers being controversial in some ways. I'd just like to remind people that central banks hold physical gold as a kind of national store of value asset for worst case scenarios. And most of those central banks keep it in the basement of the New York Fed in downtown Manhattan. So, the wrapper...
Theoretically.
In theory. I've been down there and looked at it myself. So we know that it is there. The institutions like a Grayscale or anybody else is just there to, help people meet their needs. And the wrapper helps people meet their needs, just like the gold in the basement of the New York Fed. And if you want to take your Bitcoin out of the ETF, or take your gold out of the basement of the New York Fed, you're okay to do that, as if the service is not something that you need. The derivatives markets are increasingly very rich. There's been a lot of things going on this front. Of course, I would say the things that are front of mind for me are perpetual futures and the rise of platforms like Hyperliquid, Bitcoin trading on those types of venues, both in perps and spots. All the things that are happening in options market. You have a very kind of strange shape in options market because so many companies are selling calls, covered calls, and a lot of investors are buying puts for protection. So you have a very skewed options market, but just shows the use of these derivatives for all types of different users. And then maybe I'd add prediction markets, or what Hyperliquid would call outcome markets. I think that these will be very popular for retail speculators, in particular on Bitcoin and other things. So a very rich, to Kristen's point, very rich ecosystem of derivatives. It just speaks to how far Bitcoin has come. And going back to the macroeconomics briefly, I mean, this is why I remain so confident about Bitcoin, even in down markets, even here at 58,000, 59,000. The thing that still goes up and to the right all the time is government debt and deficits, and these are the things that drive demand for these assets in the first place. So I just sort of, whenever we're at a down market, I just remind myself the core reason that we're all here, which is that we're taking huge risks with our fiat currency systems, and we need these other assets like Bitcoin to provide a ballast to portfolios, and whether they're buying in an ETF or through a variable rate preferred or through a derivative product, they're all good ways to get access to Bitcoin.
No, certainly here. And guys, in our last minute here, I just kind of want to do a rapid fire down the line, starting with you, Ben. Share with the audience one future, maybe hole in the market that you've seen, financial product or opportunity you're excited about in Bitcoin land.
What I've actually had a lot of discussion around is real estate developers or real estate investors that are finding a lot of value in Bitcoin. And, it fits a lot of the principles that they have in their portfolios today. And as they're watching the real estate market inflate, they're looking for a new home for that capital if they have to rotate it into something else, right? When you see the price of real estate rising and you see the affordability of it going down, right, there's a fundamental disconnect out there. And so I've had a significant amount of conversations with fairly large real estate investors that are looking for a place to park that capital if they sell out of a real estate investment. And a lot of them are finding Bitcoin is the place that they want to put it. So I find that very encouraging.
That is neat. I've actually had a couple of conversations like that too. That was a good call out. Kristen, how about yourself?
We're also building a lot of indices that are Bitcoin, precious metals, also any of the rare earth commodities all pulled together. So I think that's great because it's saying everyone feels like Bitcoin's a core part of some sort of portfolio. It might be an investment as a store of value, or it might be people are starting to think about it like these other precious metals and rare commodities, and they want it all together. So I think that's also a very positive sign.
Zach?
Maybe I'll close by saying I think truly the institutional adoption of Bitcoin ETFs is only right now getting started. When you think of classic institutional investors, pensions, endowments, insurance, sovereign wealth, there's been a couple that have dipped their toe in, but actually it's a still very narrow list. And we interface with all these types of investors, and those discussions, those allocations are all kind of going through that process now, and they see market prices today as a huge opportunity. These types of allocators The last thing that they want to do is make a foray into crypto, and then 50% bottom falls out. They see the drawdown, they see the structural adoption trends and the need for these types of assets and portfolios, and so now you're going to see those allocations, I think, over the course of the next 6 to 9 months or so.
Well, thank you guys for sharing your expertise. Let's give them a big round of applause.
Welcome. This is BFC in NYC, the premier institutional Bitcoin adoption event. We are here with over 300 decision makers from across the industry. We're excited to welcome you, and let's get into it. So the people in the room are what makes today an incredible event. The top companies who are allocating Bitcoin to their balance sheet and leveraging Bitcoin to run their businesses are all in the room, having conversations and making deals happen. All the decision makers from across the Bitcoin ecosystem who have anything to do with corporate adoption, institutional adoption, are in the room here at BFC in NYC. Thanks for coming, and we hope you enjoyed the event. We'll see you in Hong Kong.
Every single company, I think, is going to hold Bitcoin on their balance sheet, where they think about how do I preserve capital, not just for the next quarter, but for the next year, 2 years, 3 years, 5 years.
All right, welcome back to BFC Live. My name is Jake Fenton. I work here on the Bitcoin for Corporations team. I am joined by Sam Callahan, head of BTC strategy at OranjeBTC, and Himanshu Sahay, the CTO and co-founder of Arch Lending. Gentlemen, thanks for joining me today.
Thanks for having us.
Thanks for having me.
Of course. Well, I want to start with some of the Bitcoin operating company news and just some macro stuff. In macro, I want to start with the Clarity Act. It seems like, based on reports that we're getting out of Capitol Hill, that it may be close to the finish line. Whether the Clarity Act does or doesn't pass, Sam, I'm curious to hear, if the Clarity Act passes, what are the consequences for not just Bitcoin treasuries, Bitcoin operating companies, and just the average Bitcoiner and pleb out there? From your perspective, what does this mean for the space?
Well, I think the Clarity Act, it's a potential tailwind for Bitcoin. It's a catalyst. Bitcoin's the most established, most liquid, largest, most secure digital asset. And even though the Clarity Act is more, I'd say, prevalent for broader the crypto space, other cryptocurrencies, stable coins, who can regulate them, who has oversight over them, how do you categorize them? That's kind of really what the Clarity Act is about, just clear rules and regulations for the entire digital asset space. Bitcoin's had regulatory clarity for going on a decade now. It is a commodity, but it will benefit because a lot of institutional investors still, unfortunately, conflate Bitcoin with the rest of the digital asset space. And so they might be hesitant to allocate to the entire space, including Bitcoin, until there's more regulatory clarity, until there's a framework for the market structure around this new asset class. They might be hesitant to allocate to Bitcoin. So if we do get this passed, I think Bitcoin would generally benefit. Now, there is some language that is good for Bitcoin itself. There's language around protecting open source developers. There's some language around self-custody. I'd like to see that language strengthened a little bit, but it's good that there is some protections in place for self-custody. And so it's not completely irrelevant to Bitcoin. There is some language that's good. I'm just for no regulation over bad regulation. So it'll be interesting to see what the language is after the recent markups and kind of debates and whether it'll actually go through or not. But if it doesn't, I don't think Bitcoin necessarily needs it. Bitcoin thrives with or without the Clarity Act. But I think in the short term, if it passes, then the market would see that as a tailwind, and we could potentially see the price respond to that.
Yeah, Himanshu, I'm curious, you come from a totally different angle or perspective in the sector. I'm curious, what does this mean for lending? What does this mean for Arch in particular and the way you guys operate?
It doesn't change too much for our business as it operates, but it does help regulate a lot of people around us. So, for example, it makes someone like Coinbase or when you like Coinbase, a commodities exchange, right? It also, I think, gives our customers and customers in general clear frameworks on segregation and how their property is protected. So it creates clear frameworks around bankruptcy protection. It's a question we get a lot from our clients, and we've made steps along the way to make sure that in any negative scenario, our clients are always protected. Now, this makes everybody in the market have to operate along those parameters. So I think that is quite helpful as well. And then as it relates to intermediaries versus people who sit at the front, like DeFi developers, it treats them a little bit differently now. So intermediaries or centralized businesses that do provide access to DeFi, which a lot of other lenders do, and there have been a lot of conversations on wrapping DeFi into C5 models. They may now actually have to face proper regulatory clarity and face sanctions, risk management, etc., compliance obligations like they normally would um, with their centralized business along with the DeFi wrapper as well. So I think it does change a few things there. I think outside of Bitcoin, um, I would also prefer some stronger drafting around what is the security versus commodity conversation because it does provide certain pathways for SEC to CFTC's like regulation from labeling something as secure, which would be a security as a commodity. So it's interesting to see how it operates on other assets. I think for Bitcoin, absolutely a tailwind. We are seeing some price action improvement as a result as well. Still nowhere close to, I think, a bull market or anything. But yeah, I think it's gone through so many changes in the past several months, and it's still unclear what version actually is going to go through if it ever goes through. So it's unclear what happens still. I'm cautiously optimistic.
Yeah, I'll just add, like, I think kind of what he was getting at there is that it is going to make it easier for these institutions to start to build in the space too. It just gives clearer rules for them. Like he mentioned, the segregation, it obviously goes beyond that. When you think about the institutional adoption that's happening in some of the large banks, for instance, getting into the space, launching Bitcoin products and services and digital asset products and services, tokenization, having a clear framework would allow them the confidence to build, really make investment into the space, which is good for the broader, ecosystem as well in terms of improving investor access, lowering the cost for end users. For instance, like Bitcoin lending would be an example of how this could benefit Bitcoin in the long term to have clear rules. Now, there's some other important parts for Bitcoin, like for instance, I would like to see the strategic Bitcoin reserve get codified into law. I would like to see Bitcoin tax treatment improve for de minimis transactions. Those things aren't in the Clarity Act. They're in different pieces of legislation that are a little younger in the process. And so there's important legislative efforts beyond the Clarity Act that I think actually move the needle more for Bitcoin adoption. But make no mistake that if it passes, I think broadly speaking, it's a good thing for Bitcoin.
Both of you mentioned Clarity Act being a potential tailwind. Let's play devil's advocate here, and let's assume the Clarity Act doesn't pass and it's dead on arrival. Outside of the Clarity Act, what are some of those other tailwinds that you see in the space right now that might be positive for Bitcoin?
So in the past week, we've seen the first actual week of inflows in ETFs. I think we've seen 700 million in inflows. It's still
a tiny fraction compared to the actual outflows that we had of, I think, 13 billion at its peak in the past few weeks. So that's, I think, a bit of a tailwind there. We are seeing some ETF demand. I think it's just a rotation out of crowded AI and semiconductor stocks. We also saw a huge inflow into the IPO for SpaceX. We'll probably see another one for the Anthropic IPO, if and when that happens. So it's more of like a correction. Like it's less mania. It's just like the market attempting to rebuild a little bit. I don't think it's euphoric in any way. But if it does hold this breakout and it's not just short covering any event-driven stuff, and if you don't see another big blowout in the war in the Middle East, we could see a steady climb. I don't think it's going to be a massive jump where we see a 30% month, but I think we will see a bit of a steady climb.
Sam, yeah, curious to hear your thoughts.
Look, in the short term, I think Bitcoin's going to continue to come under pressure because there's more competition for marginal capital. We think about the IPOs, highly anticipated IPOs, and how large they are that are still anticipated towards the end of the year. That's going to compete for capital. You obviously have the AI craze, tech stocks running. Now that's starting to correct, right? Anybody who bought into the SpaceX IPO is now underwater. And that's the kind of what you'd kind of expect to see. So I do think you're going to see a rotation back. But right now, there's more competition for marginal capital for Bitcoin. So it might still struggle. Now, when I think of Bitcoin, I think of it as a long duration asset, and it's very volatile in the short term. I always go back to the fundamentals during corrections like this. Has my thesis changed? Has the reason for holding Bitcoin changed? And what I usually focus on is the fiscal outlook, the amount of government spending, things like that. Recently, the fiscal numbers came out. We're actually on set to have a larger deficit than last year, right? So spending is actually increasing. You have yields rising. You have inflationary pressures rising. You have more geopolitical fragmentation, more capital controls. These are the real tailwinds for Bitcoin long term, and they're only getting more clear. And the traditional financial system is continuing to deteriorate in many ways when you look at its long-term health. And so those are the real tailwinds that I think people should focus on. And during these price corrections, that really go back to the fundamentals of why you would want to hold a decentralized asset that can't be debased, that can't be censored, that provides some diversification against fiat debasement risk, which is what stocks, bonds, other assets that might be in your portfolio, they might not be able to hedge that fiat debasement risk as well as Bitcoin or other hard assets. So, it's probably not the answer you want to hear. Like, what's the short-term catalyst for how do we get out of this bottom? Really, it's just time. It's just a period of accumulation of where Bitcoin moves from weak hands to strong hands with conviction. You're seeing that in the on-chain data with long-term accumulations. There's a lot of bottom signals, sentiments poor, but really the reason to hold Bitcoin has never been stronger or more clear. So those are the things that I look for. If I saw governments starting to act responsibly and stop spending, maybe I'd be a little bit worried about Bitcoin not making a bottom here.
Yeah, I tend to agree. I don't really look at the Bitcoin price. It's more about the long-term monetary scarcity thesis. I do believe that in the short term, it is still trading at the moment as an event-driven liquidity asset, but absolutely in the long term, it's very much still if you believe in the thesis. I mean, there's no better time to get in than now, if you aren't already. But I think it's still very much a long-term reserve asset, in my opinion. I think it's Sam's opinion as well.
You mentioned Sam, you mentioned institutions, capital allocators, IPOs coming up. And then you kind of explained your general thesis on why Bitcoin makes sense to you. I think after working in the space, I've seen that there's a lot of skepticism toward these institutions that hold Bitcoin or some of the infrastructure partners like Arch Lending. I'm curious to hear your thoughts on for the average Bitcoiner that agrees with you on this like large debasement trade, what I'm curious, why wouldn't an institution that's made up of people that also can see the writing on the wall with fiat debasement, why wouldn't they also buy Bitcoin, hold and move their company onto a Bitcoin standard?
Well, I mean, it's a big lift for a lot of companies, especially it seems like the older they are, the larger they are. It takes a lot of convincing to change your treasury strategy and allocate to a new treasury reserve asset that's only been around for, 17, 18 years.
Yeah.
And there's a lot of bureaucracy involved. There's a lot of internal controls that need to get placed. How do you secure the Bitcoin? Operations to set up to allow yourself to even hold it or allocate to it in the first place, let alone convincing your board or committees on the investment thesis of why you'd want to hold it, especially at a time like this when it's down 50%. There's real reputation risks. So there's a lot of like bottlenecks. Now, the actual reasons when you actually dig down to the fundamentals and the, run the numbers, yeah, every single company I think is going to hold Bitcoin on their balance sheet eventually as inflation and debasement become increasingly worrisome and severe, where they think about how do I preserve capital, not just for the next quarter, but for the next year, 2 years, 3 years, 5 years. When you look at the options available to them as a public company, I mean, you have cash and cash equivalents, but obviously they underperform the rate of monetary inflation, which is around 6.5, 7%. So you're losing in real terms, but you want that liquidity. And so you think about what are the alternatives, and this is what Saylor did in 2020, right? And there's regulations in place where they can't necessarily hold like securities. And at the same time, if you buy like the S&P 500 for protection as a company, it's interesting because you're kind of like, if you have competitors in the S&P 500, you're kind of giving them capital. So there's a little bit of incentives there. But you want to hold a commodity then, right? Because it doesn't infringe on any of the 1940 Act, and you won't get reclassified if you hold more than 40% of your balance sheet in securities. Like you want to hold commodities, and then you think, well, I could hold gold, I could hold real estate, but that comes with other headaches and other problems due to their physicality. And then you land on Bitcoin, right? And so I think it would be really reasonable for really every CFO and corporate treasurer to eventually come to Saylor's conclusion. But I think it's going to take time. I think it's going to take, there's still a lot of education that needs to happen. There is still work to be done on the regulatory front. Like we've seen like a whipsaw over the last couple of years where they used to fight against it. Now there's clear accounting rules, but there is still barriers there that need to get brought down before a lot of these companies can feel comfortable allocating to it. So time is the biggest teacher, and debasement will continue to wither away the value of all these other treasury reserve assets. And then education on Bitcoin and Bitcoin just building a stronger track record will do more than anything to get people to finally allocate to it.
Himanshu, curious to hear your thoughts on again, because you offer such a unique perspective. You're really helping these companies expand their operations or bring liquidity to maybe some of the assets that they hold on the balance sheet. Curious to hear your thoughts on next steps for institutions in Bitcoin.
Yeah, I think it's important to differentiate public and private institutions. I think if you're public, you typically operate on a quarter by quarter basis, and you have real risks in having a negative quarter, right? Especially if you have that like two negative quarters in a row, you may have a strong operating business, but if the Bitcoin is going down, which it has in the past 2 quarters, you're going to have a lot of questions, and your management like credibility will be put into question. There's a lot of risk for a business that is public, with a significant number of public shareholders to go on the Bitcoin standard. So I think we'll see a larger number of companies over the next few years maybe allocate a small percentage to Bitcoin. But I think it takes a lot of time before we see a lot of companies operate significantly on the Bitcoin standard. However, on the private side, companies are a lot more nimble, and often founder-led, but they can actually make that decision. And we actually have a much larger number of private companies that borrow from us than public. Obviously, there are a much larger number of private companies that hold Bitcoin. It's easier for them to allocate to Bitcoin if they are in an industry that isn't as regulated as, say, banking. They can allocate much more easily. I was speaking to a chief digital officer at a very large fund that everyone's heard of, and he's been there for 3.5 years. All they've done in the last 3.5 years is set up the infrastructure to be able to hold Bitcoin. They haven't even bought any yet. Just set up the infrastructure to be able to hold Bitcoin. So the speed that we think about with smaller companies, with companies that maybe have chosen to go on the Bitcoin side publicly and have set up the operations like Sam has for that specifically, is very different from a company that has a very different operating business in the traditional world and has shareholders that are frankly focused on something completely different, right? So I think it'll get there. And as we see more monetary debasement, as we see the dollar continue to, I think, or as we see people get clear on the fact that you are losing money to inflation and debasement every year, we'll probably see more, but it's not going to be, I think it's going to be a lot of nothing and a lot of small steps until we get to like a true inflection point. We're still very early, and we'll continue to see small steps along the way as people get there. And I think as we have more utility on the Bitcoin, it's much easier for people to actually operate on that stand. Um, like today, if you're allocating to Bitcoin, you have to have your own strategy that's unique to you. There isn't something off the shelf that you can pick up, and you have to do a lot of work. And like someone like Sam has to operate in every single company to be their Bitcoin strategy officer, right? But I think long term, we'll see more off the shelf solutions for people to actually do more with their Bitcoin. Today, you can borrow against it. There's some places where you can get yield against it, but you have to have someone decide the quality of the tools they're using. And there's not that many options in the market today still. We have some good options, but I think the market will continue to benefit from more varied options in the market.
When it comes to institutions, I think, there's a lot of fair and unfair skepticism, especially some of the treasury companies. Look at like what's happening with Stretch and SETA. Big question out there whether, are they going to get back to par? Is this just a temporary moment, or is this where these products land? The exit of Jack Mallers from 21. It definitely feels like bear market vibes right now. And I know there's a strong sentiment among Bitcoiners, and I see it out there on X, that there shouldn't be Bitcoin companies. Companies shouldn't be holding it on the balance sheet. I'm curious, Sam, I want to hear from you first. What would you say to the skeptic of some of these, or some of the critics of the Bitcoin companies, that say like Bitcoin is just meant for me and you, it's not meant for the institutions?
I've never really understood it, because when I thought about what Bitcoin adoption would look like, Bitcoin being adopted as a new digital money, everyone is going to hold Bitcoin. Every single institution, every single person, every single household needs sound money. So it's going to get adopted at every single level. And so to me, to say like, oh, these companies are acquiring too much Bitcoin, or they're adopting, they shouldn't be adopting Bitcoin. It's quite silly to me. I don't understand it. I don't know. It's like screaming at a river that represents Bitcoin adoption, and they're saying it's moving the wrong way or something. This is just nature. This is how Bitcoin's being adopted. You can scream and say it's not right, or you could try to highlight some of the risks, and that's fair. But to me, this is how naturally it was always going to happen. And Bitcoin companies that have their KPIs based on Bitcoin, and they pay their salaries in Bitcoin, they're really thinking on a Bitcoin standard, and they're using the traditional debt-based system to accumulate more Bitcoin at favorable terms, because as a public company with a large balance sheet, you can get more favorable debt terms that, say, an individual couldn't. And that allows you to basically put on this short fiat, long Bitcoin position in an intelligent way that results in more Bitcoin exposure for your shareholders per share. So, this is, you can also, as a public company, you can build out Bitcoin operational businesses. There's a optionality between how you use the Bitcoin on the balance sheet. There's been different strategies taken by different management teams to make that Bitcoin productive and put that Bitcoin to use to ultimately drive Bitcoin adoption. It also improves investor access. I mean, even OrangeBTC, we just launched our ADR last month. I mean, if you're a US investor and you're bullish on Bitcoin, but you're also bullish on Brazil or Latin America or emerging markets more broadly, if you think about the currency dynamics or you're just bullish on that region, it's been one of the most outperforming sectors over the last couple of years. Now you have a way to get exposure to Bitcoin and a public company in Brazil by buying potentially our ADR if that's of interest to you as an investor. And so it's just about building exposure and improving investor access across the world to Bitcoin-backed securities. And I see it as a bridge, as there's large pools of capital that can't buy spot Bitcoin today. There's restrictions that exist in Brazil, for instance. It's about meeting investors where they are. Bitcoin is still volatile today. That volatility is declining over time. But when you have, as an individual, you have your long duration savings, and then you just put that away. And I'd recommend Bitcoin in cold storage. Remove any kind of counterparty risk. But as a short duration needs, in terms of, hey, I'm saving for my kids' college, and I need this money in 3 months to pay the tuition. You really can't afford to do put it into Bitcoin and have what it did the last 3 months. It would be pretty catastrophic. And you say your kid, no, sorry, you can't go to college anymore because Bitcoin's volatile, but it's still the best money. She's going to be like, what are you talking about?
Yeah.
And so you got to try to find solutions. And that's what Stretch and SATA and these different preferred products are trying to deliver, but backed by Bitcoin or supported by their Bitcoin balance sheets. And we can go into their recent price action and why I think they'll return to par, but I'll stop there to let him share his thoughts over here before I continue with that. But that's kind of how I see the Bitcoin corporate adoption and the critics around it.
Yeah, Himanshu, I'd like to hear from you as well because I do want to jump into digital credit here in a sec. But yeah, Himanshu, I want to just hear your thoughts on the critics of the overall Bitcoin operating business, Bitcoin treasury space. Any thoughts?
I think a lot of the critics today are speaking to the fact that a lot of treasury companies haven't had a plan of what they're going to do after they go on the Bitcoin standard. And I think that's fair. I think very few treasury companies have made the efforts to actually do stuff beyond it. I think digital credit is one very interesting approach there. And I think most treasury companies are seeing the value of that. So we're seeing a few of the European treasuries also operate with similar models, whether it's private like Apple B or something more public like the Smarter Web is looking to do as well now. I think so. It's very clear from even if you speak to Sailor, it's very clear that he has always expected that we will have to sell, or he would have to sell Bitcoin at some point, and I think the market overreacted to that, and that culminated with Bitcoin also sliding quite significantly at that time. So it did have a bit of a depeg. It's not quite a depeg because it's not a hard $100 mechanism. It's a target. It's not a requirement. SATA, on the other hand, is a little different. It does a daily yield. It also buys Stretch under the hood, so it has some buffer there. It's not just Bitcoin backed. And it's almost back at par. I think we're at 98 something on SATA right now. For Stretch, it's definitely come back from its bottom. I think we're at 88 something on Stretch right now. And I do think Stretch comes back, but I think people have to be very clear in understanding that MicroStrategy is going to have to sell Bitcoin at times. I think I had dinner with Taylor recently, and he was explaining the mechanism. I think it was something around if the Bitcoin growth rate is less than 10%, then they're going to sell Bitcoin. If it's over 10%, they're going to sell stock. So it's something along those lines. I'm probably butchering it a little bit, but basically the idea is that it's a mechanism where they have enough for both to sell, and it's a choice on which does get sold. I think the market has to understand that Bitcoin will get sold at some points in the cycle, and that shouldn't affect Bitcoin negatively or Stretch or strategy stock itself. Um, yeah, and I think a lot more treasuries are going to issue these perpetual preferreds, and we'll probably see more utility in the market with these. I think there will be a point, much like the treasury company stocks, where there's probably too many that are similar. So there'll have to be differentiation on them as well, whether that's a securitized layer on top, which smooths out the volatility. So if you have a securitized or like a senior secured structure that you're selling that operates on top of Stretch, and that gets rated better because it's smoothing out all the volatility, that can then be sold to bond markets, for example. They're much, much larger than the markets that are being than traditional public markets, right? So if you can access those, I think we'll see a lot more liquidity and a lot more investor access, because investors at the end of the day are looking for yield that's rated, and that's rated at least AA and above, right? So if you can get that, you can access much, much larger insurance markets and such.
You called out something, which makes me think about the total addressable market of digital credit, and I want to get to that, but I want to backtrack a little bit. Sam, can you just take us through what happened with these digital credit products? It seemed like they're printing money every day. We're at par every day. Sailor or Strategy and Stata, they're buying all the Bitcoin, and all of a sudden it seemed like we have this big unwind. Can you explain to us what happened? And
Yeah, I could do my best.
Yeah.
I think the first thing you have to understand is that these are very, very young instruments and innovative instruments that the market's still trying to wrap their head around. Like Stretch just turned one, I think, or is just about to turn one. And in the financial world, they're babies. They're also innovative. There's nothing that's existed like them. Having a perpetual preferred equity instrument that's backed by Bitcoin or supported by Bitcoin balance sheets. It's a very new type of instrument. So the market's still wrapping its head around it. And I think what we learned was that Strategy, when they paid down some of their convertible debt by using the USD reserve, that the market had viewed that as specifically earmarked to service the dividends, even though that wasn't the case. That's obviously how the market viewed that. So when it got drained down to pay the convertible debt down, the market kind of freaked out a little bit. And that's when Stretch started to trade at a discount to par. And, it was interesting because I think that's actually a good move for them. Maybe they should have tapped the ATM of MSTR to pay down the convert, but it's actually a good thing for the MSTR common shareholders as well as the preferred shareholders to remove some of that senior obligation. That's a hard cash obligation. And if you actually look at the put dates of some of these converts over the next 2 years or so, if the stock price doesn't improve materially and it doesn't get into the money for these converts, they could demand their money back. And so that's actually like a real risk for Strategy over the next couple of years to remove some of that convertible debt. But the way they did that by draining the USD reserve at that time, and then right after Bitcoin puked, it just wasn't really lucky timing for the whole thing. And so now that when it dropped, and then I think at the same time, we learned that there was a lot of leverage being taken on top of Stretch as it kind of, the volatility started to decline. People started to leverage up, people started to carry, they didn't manage risk well. And so you saw the initial drop from this drain of the USD reserve, but then you hit these liquidation thresholds all at the same time. And that's what caused the real spike down to 74. Once it got to like 90 and then it just kind of like trapdoored, that's usually where there's a deleveraging event that happened. But since then, I think Strategy has done all the right moves. they've shown that they want to prioritize their preferred equity shareholders by raising the USD reserve. They're almost back to 2 years of USD coverage. They earmarked their Bitcoin and the USD reserve specifically for the dividends. They announced a stretch buyback program, which is also, I think, a good move. And so they're really showing to the market, and then selling the Bitcoin, I think was completely the right move. They're an operating company with a large liquid asset on their balance sheet. They can do whatever they want. They have complete optionality to do whatever they want if they feel like that action increases shareholder value. And if selling some Bitcoin to raise some cash or to pay back or to buy back a preferred, if any of it is accretive to their shareholders on a Bitcoin per share basis, or puts them in a stronger position and puts their capital structure in a more durable position to be in a position down the road to increase Bitcoin per share at a greater rate for their shareholders, they're thinking long term, then they're going to do that move. And so they bought almost 90,000 Bitcoin in Q1. They bought a little over 80,000 in Q2. And now people are freaking out because they sell a few thousand Bitcoin. Like, you really got to zoom out and look at the big picture of what they're trying to accomplish here. They're trying to build a Bitcoin accumulation machine for the long term. And the best way that they found to raise capital is through these preferred equity products in an accretive way, because it doesn't have a maturity wall. It doesn't have refinancing risk. It doesn't have all these things that, say, a traditional debt instrument has. And so, I think since Stretch has broken down, they've made all the right moves. I think now the market's just trying to, the stress test, it's trying to work its way back towards par. But as a Stretch shareholder, the only thing you should care about is, will they service the dividend? And if it gets back to par, will I have the liquidity to get out of my position? It's still trading, $400 million, I think today. That's MSTR. Hold on, let me go to Stretch. No, it's trading $270 million over the last 30 days. So it has the liquidity for the preferreds. And then they're going to continue servicing the dividends. So they now have serviced over $1 billion of preferred dividends strategy. And now SETA has just hit their 30, I think, daily dividend. And so it just takes time to build a track record. But really, that's all you should care about is, like, will they service the dividend as a Stretch holder? And the answer, I think, is definitely yes over the next at least several years, because they have the reserves built up to do that. And then will it get back to par? And I think that's just a matter of the market absorbing it, market learning more about it, building a track record of servicing the dividends. It all comes with it. And once it gets back to par, I think the liquidity is there, where if an investor does want to get out, they will be able to, especially when you compare it to other preferreds liquidity in the market. I mean, it's night and day. So I think they're young products. They'll recover. They've done all the right moves that they've had to do since the stress test. And I think, probably over the next couple months or so, it'll get back to par.
Are you trying to say that the random anonymous Twitter troll doesn't know financial engineering better than Michael Saylor and Fong Li? Is that what you're inferring?
I mean, there's some times though where I do think to myself, I'm like, because I've had dinner with Saylor, and he really is truly like a special brain. The guy is not a what you see on screen is what he's like in person too. He never stops. He's always thinking about Bitcoin. It's just amazing talking to him. And I always just think of the critics. I'm like, is this guy smarter than Saylor? It's like, no, like not a chance. And so I think it's important to question. It's important to debate. Saylor and Strategy, I think they should get a lot of credit for building a brand new business model in public, learning in public, pivoting in public, being extremely transparent. They're never going to make mistakes. But it's important that they learn from those mistakes and pivot. And so I think that's what you've been seeing over the last year or two as they build out this new digital credit, financing franchise that they're developing here. And so they should get a lot of credit for that. But a lot of these critics, you really go through it and like, have you run the numbers? Have you actually read the filings? Have you done the deep dive? You know, it's okay to have reservations and to point out risks and trade-offs and to question some things, but you really want to at least do the basic homework and run the numbers yourselves before you open your mouth publicly about a subject.
Yeah, I stopped tweeting my criticism of Sailor on my Anon account a while ago. Okay. One more question, just kind of about the larger Bitcoin company space. The exit of Jack Mallers from 21. I'm really curious. I don't want to speculate, as to like what happened. We're gonna, what they say is what happened. But I really want to hear what this means for the larger space. Is it a signal of like a trend that we're going to see, or is this just Jack going back to Strike to focus on his baby?
I can speak to this a little bit. I think it's the latter. A lot of the 21 initial approach was centered around like the star team and the capital behind it. They didn't do much with it, but the expectation always was that they'll roll up into Strike and then that'll be one big company. And also with Electron. Again, it's all speculation. I haven't spoken to Jack about this, but Strike has been doing a lot on their side as well. You know, they're our competitor, they do a lot as well, and it's a very demanding business to run, I'm sure. I think rolling that into 21 with him leading both would probably have not been the right approach for 21 or for Strike, especially given a lot of Strike's marketing and go-to-market efforts are centered around Jack. With 21, in the announcement for his exit, they said that they're going to go on with their approach on adding lending, etc. So it looks like they're going to be competitive with Strike now, which probably means that it wasn't like a very happy exit. However, it remains to be seen whether they have the operational capabilities to build those things. Now they will obviously join up with Electron, it looks like, so it might be a two-way merger. They do have a strong Bitcoin balance sheet. So it remains to be seen what approach they take. They haven't done anything with their Bitcoin yet. So I think it's still very early. I wouldn't call this a trend in any capacity. There hasn't been another merger like this where there's been a strong or like there's been a large Bitcoin treasury looking to acquire a financial business underneath. So I think we will probably see more consolidation in the treasury space, with companies looking to acquire operating businesses. We're seeing treasuries specifically launch to acquire operating businesses as well. There's a few new treasuries coming out over the next few months and years that are going to do that. So I think it's not a trend. It's just a very unique circumstance. The timing is certainly very interesting. Why now versus a few months ago? But it's all speculation on why now versus
No, I agree. I think you will probably see some more consolidation, some more acquisitions of operating companies, and you have treasury companies that are trading at significant discounts, which could be attractive for another treasury company to come in and acquire some of the assets at a discount. But in terms of the specific news, I'm a big fan of Jack's. He's been a great Bitcoin advocate, entrepreneur for many, many years, and I think he's a good person. And so I hope everything works out. He's just going to keep building Strike and do great things for Bitcoin from here. I just think in general, like three-party mergers, the odds of this actually happening were low from the very get-go. I mean, it's very difficult when you have an energy business, mining business, Electron Energy, you have 21 Capital, and you have Strike. How do you value? You have to agree on how do you value each of the companies, who has control, and the governance. You have different business models. It's very, very complicated. Even you saw Nakamoto, they were doing a merger, and even, they had the same owners in the companies, and it took almost a year to even get that across the finish line. Now we're talking about three companies trying to merge. It's just complicated. So these things fall apart all the time. And so I don't think there was any kind of like drama necessarily. I think in general, maybe negotiations just kind of broke down. Maybe Jack just wanted to focus on strikes, simplify his life a little bit. It's also there's real um, demand on an individual when they're running a public company, right? In terms of what you can and can't say publicly. Jack's always been a really authentic guy, likes to say exactly what's on his mind all the time. Maybe that factored in a little bit. Like I think from the video you saw, he kind of spoke a little bit about that. And like I just want the Jack Mahlers that feels happy and driving Bitcoin adoption and education and building Bitcoin financial services. So happy that he's just going to still focus on Strike and keep building. But I also have a lot of confidence in Hafa Seguri, who's taken over as CEO of 21. Electron Energy is they run about 5% of Bitcoin's hash rate. I think you might see it turn into more of like a public Bitcoin mining company, and they'll probably develop other Bitcoin strategies. They have a giant Bitcoin balance sheet there.
Yeah.
A lot of question marks about what's going to develop from there, but I think you're going to hear a lot from them over the coming few quarters here. So I'm excited. I'm excited to see what Strike builds from here. I think everything's going to work out. I don't think it's like some big sign of bear market or something fall apart. I think these deals fall apart all the time, but there was just a lot of spotlight on it just because of the names involved and the companies involved and everything like that.
I think one argument to be also to be made here is I think if you ask someone a year ago, do you need to be acquired by a public company to have the capital markets expertise or the capital markets access to be able to serve a large number of clients and a large amount of lending activity? And in the past, maybe the answer was yes. Today, I don't think that's true anymore because capital markets in the last few months have evolved quite significantly where you can actually access a ton of debt as a private company. So you could have said that, hey, you need to be part of a public company to get to the next billion or the next 5 billion, but you don't really anymore. Strike did raise a $2 billion line with Tether. A number of other companies, including us, have very large lines with different capital partners as well in different structures. So maybe you don't need to be from Strike's perspective, like they didn't need to be part of 21 to do what they need to do. And I think other companies will probably make similar decisions or will be in a position to make similar decisions. Whether that's yes or no for them is very unique to each structure. But it is something to note that I think capital markets in Bitcoin lending has evolved quite significantly. It evolves on like a monthly basis at this point. So what was true when this was proposed, which I'm sure was 6 months ago before it was, before it was ever public, is probably not true anymore.
Good point.
Go ahead, Sam.
No, I was just saying good points.
Yeah, I'm excited for Jack. I'm a listener every once in a while of the Jack Mallard show. Enjoy him. A happy and authentic Jack is the best one. Okay, we got a few minutes left. Want to kind of wrap it here. Himanshu, you mentioned, I think it was you mentioned how much Bitcoin 21 holds on the balance sheet. So for these companies that want to make Bitcoin productive, that want to make that that balance sheet productive, obviously we've seen products on the market like digital credit. I'm curious, with digital credit, the advent of digital credit, I'm curious what you guys think. What's the total addressable market here? I mean, this attacks like banking, fixed income. There's a lot of different places you can park your money. I'm curious what the future of digital credit looks like. Sam, you said we're only a year into this.
Yeah, I think it's very early in who we're addressing. So with Stretch and SATA, 80% of Stretch holders today are retail. So it's not even gone to the bigger institutions and such. But it's also not an instrument that's rated in a place like at least AA or above where any serious institution is going to buy it. So it's still very early in how it's wrapped. Now, Sailor's always said, I'm going to create the tools. People are going to build on top of that. So we have two products called Apex and SATA that are basically like a smoothing layer on top of Stretch. We're going to see people build securitized products on top, which use Stretch, but have a smoothed out, non-volatile product that actually does work as fixed income. So you're just getting a yield. It's not something where you're targeting a yield. And I think that will probably be something that yields a couple points lower, but does get rated very favorably and can then be sold to bond markets and such. Mm, Bond markets are the largest credit markets in the world. They're orders of magnitude bigger than um, like traditional public like stock markets, right? So that market has not been touched yet. We will certainly see someone build. I think we'll see many approaches to build there. We only just saw the Bitcoin-backed lending markets hit the bond markets, right? Very recently. Ledin did their securitization of their book. We have a book that's been on-chain securitized. So it's still very early in those approaches as well. This is something that's so new. Like it took 7, 8 years of Bitcoin-backed lending to exist before we did that. We're only a year into digital credit, or maybe a couple years if you count the earlier products that Stretch had. Um, so I think we'll see approaches in that where institutional investors, with all the other tailwinds with Bitcoin, finally who understand what Bitcoin is, but want to offer a fixed income product, will offer something that is more agreeable with large institutional investors.
Sam, curious to hear your thoughts.
I mean, I just agree. I mean, I do think we're early. I think a lot of the moves that strategy has made uh, has been revolved around some of the feedback it's gotten from the credit rating agencies, right? S&P Global said that they'd increase their rating or upgrade them if they did a few things, if they improved their USD liquidity, which they have, if they demonstrate that they have strong access to capital markets in challenging conditions. They've raised billions of dollars over the last several quarters at a time when Bitcoin corrected 50%. I think they've demonstrated that pretty well. And the last thing is reduce some of the convertible debt. And so they did do that. The market kind of puked a little bit because Bitcoin fell right after they did that. But in general, these are all steps they're making. This is when I say think long term. They're thinking long term. They're trying to improve the credit rating to bring in more capital, to bring in more institutions to feel comfortable allocating to these new instruments. And so each move can't be viewed in a silo and not just short term. It's all made to achieve greater goals, to bring in more demand for these instruments. And that's just how the traditional financial system works. You need a better rating to unlock access to these larger pools of capital. So, I think this is early days. I think this is a stress test that when you look in hindsight, it's actually, they're going to point to this as say, we were able to bring this back to par, by continuing to service the dividend, continuing to build a track record, continuing to be disciplined. And I think that's what they're going to continue to do. And so it's the market, time does a lot of things, like I said earlier. And so the more that they can demonstrate a good track record, the more the larger institutions will feel comfortable allocating to the instruments.
I think that's a good place to put a bow on it. Sam, where can our listeners today, where can they find you if they want to hear more?
You can find on X at Sam Callah, SAMCALLAH. You can also find more about the company, OranjeBTC. That's spelled with a J for the orange. That's orangebtc.com. Or follow us at OranjeBTC on X, where we share company updates.
Himanshu?
So you can find us on X at Arch Lending. Our website is also very simple, archlending.com. I'm not as active on X as I should be, so just follow the company. We do have a newsletter that goes out with market news every Wednesday. So it just went out this morning. That's on our website. You can go sign up very easily. We have a ton of people who follow that just for a 3-minute read of what's going on in the market. Yeah, if you have any questions on lending, on borrowing against your Bitcoin, on how you can activate your stack in a very safe, creative manner. We do serve both individuals and businesses, so 2 different product lines for both. But yeah, happy to answer questions for anyone at any time. Our team always takes calls from people all over the world.
Awesome. Well, gentlemen, thank you for joining me today. If you're listening live, both of these guys have spoken at our symposiums. Our next symposium is coming up in Hong Kong on August 27th. If you can join us, we would love to have you there. Gentlemen, thanks for being on today.
Thanks, Jake.
Thank you. Have a good day.
You too.
Digital credit has not yet seen a full maturity cycle yet. It is under stressful situations that the true test of the market really would happen, and that has not happened yet.
For the first question, when we say digital credit, what are we actually describing, and why is it becoming an important part of Bitcoin's capital market right now? And maybe start with you, King.
Sure. I mean, if you look at Strategy, which obviously has developed the whole space for us, they've gone through this evolution of credit instruments, starting with margin loans, which were a great instrument in 2022, then convertibles, and then trying a number of different pref securities, really ending up with Strive, which obviously Saylor calls his iPhone moment. And at its core, it's basically a Bitcoin Treasury company has a pristine asset on the balance sheet, Bitcoin, and issuing credit against it. I do have to say that there are clearly a couple of, call it, definitions which are somewhat hybrid, because when you say digital credits, the pref securities are technically an equity and they pay a dividend, which is not the feature of a credit instrument. So I think there is some of that probably also in the market leads to sometimes a bit of called confusion, call it. But as we're developing the space, I think that's key to clarify some of those things. But clearly, why is it important? Because it allows essentially growth of the ecosystem, and for credit investors who have a different risk profile to access in a way Bitcoin, and for those dollars to go into Bitcoin.
And I think, yeah, if I could just add, I think they're particularly relevant now, right? Because as MNAVs have been shrinking, so the premiums are getting compressed, the ATM isn't working anymore. So, you know, just issuing more equity to raise money isn't working. So digital credit is a way then to raise it another way.
Rajiv?
Yeah, I can share and I agree with both these definitions, but I think I have two definitions. One is, of course, the usual one. For us, digital credit is where institutional debt is being settled on chain, which is happening a lot. But I think the definition that would be more relevant for the theme of this event and conference is digital credit would be debt where an unbacked crypto like Bitcoin is literally doing all the work as collateral, or as an exposure or as an economic exposure on the balance sheet. And it's important to understand how these two different types of definitions are recently starting to integrate with each other in a way where Bitcoin is being used as collateral for more institutional kind of assets. And one of them is the recent example where Moody's did assess and rate the Bitcoin-backed muni bond out of New Hampshire. And it's important to highlight that on one side, you have this highly volatile speculative asset like a Bitcoin. And then on the other side, you have this most conservative vertical in the financial space, muni markets, and how they both have come together in this issuance where the structure is what was underwritten, not really the collateral, and the over-collateralization of Bitcoin with proper triggers and liquidity triggers put into place, thereby offering the relevancy and the rigor of the institutional finance space, allowing Bitcoin to become more institutional. And that is one kind of an example, along with a lot of other digital asset treasuries where Bitcoin is being bought and held on the balance sheets, and the treasury strategy is the digital asset treasury strategy is about finding ways to generate yield and liquidity using that static asset on their balance sheet, which is sitting in a cold wallet somewhere. So I think the strategies are evolving as well. And as more and more institutional and crypto worlds start talking with each other, maybe Bitcoin as a collateral, that will lead to more and more digital credit being used as institutional capital and also allocation of capital in the institutional space using crypto assets.
That's a perfect segue into our next question, which is really about who is digital credit for today, and where is it going to go in the future? Is it primarily a way for Bitcoin native investors to seek income, or a bridge for more traditional institutional investors who want exposure to Bitcoin linked economics without taking on the full volatility? Although recently we've seen quite a bit of volatility.
I was just going to say, I think both really, and I guess that's the point. I mean, I think for Bitcoin natives, they're getting an income. They're actually getting something, and not without actually having to sell any sats. They're still betting on the power law holds, like the power law, similar to what we saw in the keynote this morning from like with the 200-week moving average and those bands. We're betting on that the price is going to at least stay within those bands, but with reducing volatility, right? So we're basically placing a bet that the price is broadly going to go up, but we're not going to suffer that same volatility as if we were following Bitcoin directly. And I think for the institutions, then they're getting some Bitcoin exposure, but again, at not at the crazy kind of volatility that would otherwise scare them.
King?
Yeah, maybe to add, obviously the yields being offered by, for instance, Stretch and SEDA are much higher than you can get in traditional financial fixed income instruments. So for institutional fixed income investors that are yield hungry, I mean, clearly you have a very low rate environment in Asia and Japan, but also in Europe, it is an attractive instrument. So you got to have an institutional investor that's comfortable with that exposure and that risk, but also looking for higher yields. And I agree, at the same time, it is also for retail a large instrument. And I like to think that's a combination of existing called investors that already have exposure to Bitcoin, but maybe also getting some new ones in that want a lower risk profile, and maybe over time graduate to also owning Bitcoin outright or treasury companies outright.
My take would be two types of audiences, and I think they were both covered. One is, of course, the Bitcoin native audience looking for capital efficiency, which they get if they try to find alternative ways to generate yield, which King said. And the other one, which was mentioned earlier, is the institutional side, where they get exposure or they can invest in Bitcoin without directly holding spot BTC, or even getting exposed to the direct volatility of the Bitcoin as an asset. So they would rather prefer doing that, which writes off the risk, but they still have access to the Bitcoin. So absolutely agree with both those points. And from a credit perspective, I think both those aspects are very important to look into. Of course, for us as a credit rating agency, we look at the institutional aspect more than the blockchain, the Bitcoin native one. But how the Bitcoin native audience or the exposure impacts the institutional side is equally important now.
It was reported in the last strategy earning calls that I believe 80% of Stretch holders are retail. And the question that came to mind for me is, what is it going to take for larger pools of capital, institutions, to really dive into digital credit head first in a serious way? Is that track records? Is it ratings? Is it standardization, liquidity, disclosures, education? What is it going to take?
Go ahead.
Maybe quick off that, thank you. So I think it's a combination. Certainly all the elements that you mentioned are very important. We've clearly seen some stress in the ecosystem in the last week. So cash reserves will be important, track record, how it develops. But I think at a broader level that this turns into an asset class, because once it becomes an asset class, it becomes unavoidable to invest in. At the moment, it's really two products, right? Again, Stretch and SEDA. But the moment you have an asset class and you have a number of swaps on it, derivatives, people can trade the curve, different issuers, currencies, then it becomes really, really investable for a very large pool of capital. Even though 10 billion is fantastic for a Stretch, it's obviously still quite small in the whole income scene. So I think to me, we're still the first innings of this asset class developing, literally a year old, really, and we need to build it in that sense.
I was going to say all of that. I agree, but if I were to rank them, it first would be standardization, which I think is very important and missing in the digital finance space across the board, but also in the crypto world, like Bitcoin and other unbacked cryptocurrencies. And the way that, and we as a credit rating agency think that credit ratings can standardize some aspects of the ecosystem, because a lot of credit committee discussions at institutions are driven by the credit assessments of the assets that need to be allocated. And that's why we think if we are able to somehow integrate with whatever blockchain the assets are being issued and be able to provide credit intelligence directly embedded into the asset or on the blockchain itself, that will solve a lot of these decision-making issues that probably some institutions are seeing when it comes to allocating capital in the digital space. And we are probably currently the only one that are able to integrate with Canton Network, Solana, and we are scaling that because of that very aspect. But also, I think what is important is the lack of history right now in the space. And what I mean by that, the track record, besides everything that you listed, is because the digital credit has not yet seen a full maturity cycle yet, because it is under stressful situations that the true test of the market really would happen, and that has not happened yet. So as we see digital credit evolve and that maturity of the assets and assessments with credit associated with them and the capital being allocated and how under stressful situations they stand, that test is going to be the real driver or the real solution to then understand what kind of digital risks that we were looking at and should be looked at in addition to what we have, and what other guardrails and frameworks need to be built in order to avoid those kind of situations which probably happen in the market. So that one track record is also another piece that is very important and is currently missing, but that will only happen over time and can't be just made up because we need one.
The stressful situation, I'm not sure if I can take another one like the one we've been having for the last week. I think also I would add to both your points there, also education. Right, we're seeing half the market can't even distinguish these things between stable coins or Bitcoin proxies. So we're trying to help with that, to help educate the market, explain what these instruments are, how they work, provide tools, simulators, so you can sort of simulate what will happen according to different events of the company that's backing them and so on.
Amazing. Going back to the idea of risk, how should investors be thinking about the risks of these instruments, both on the Bitcoin side and the issuer side? What are the most important things that they need to understand and evaluate before potentially investing?
I would begin with coverage, right? So can the issuer, do they have the ability to pay the dividends? What are their fiat reserves like? Their Bitcoin reserves, if they have to go for that? If they start eating into their Bitcoin reserves, what's going to happen? Do they have an operating business that can support the dividends? So yeah, finding out like the financials of the company and their ability to cover. I mean, when you're buying, say, MSTR, you're buying an equity in a treasury company. You're betting that Bitcoin is going to go up. That's basically what your bet is about. When you're buying Stretch, then you're betting that strategy won't fail, right? So long as the company manages to keep going and it can serve its dividends, then you're good.
I mean, from a credit risk perspective, I think one fundamental doesn't change is the quality of the assets and the segregation of those assets. In a bank remote account as well, that's very important and the safest way to look at how the structure of the asset is then built on top of that. The second most important part is the legal enforceability that needs to be linked to the token version or the crypto version of the asset as well. So if it's an unbacked crypto like Bitcoin, it's also important that if you are currently holding a claim to a specific Bitcoin or a spot BTC or something else, does that claim actually stand in court, or you can assert it in a court of law? And that's really not been tested either. So the legal enforceability from a credit view is very important. And then, of course, governance mechanisms, the new mint and burn mechanisms, smart contract controls and designs, and the other technology risk, platform resiliency, the regulatory aspect, everything comes into play with that. But those are some risks that need to be evaluated from a digital credit perspective. And of course, I'm talking from an institutional debt, but that would also apply to a more Bitcoin native treasury or an asset class where we have to look at the collateral aspect and the legal enforceability aspect for sure.
Maybe one thing to add is if you look at digital credit compared to gold standard credit, TradFi credit, obviously the big difference is the volatility of the underlying asset class. And I think most of the digital credit issuers so far are also sized correctly, right? They have very low leverage, 10, 20% in the current environment, which really allows for a big drawdown, right? So I think that inherent volatility in Bitcoin is important to take into account for if you think about risk as a potential investor. And how that stacks up against the capital structure.
Also, in the earnings call, it was pretty clear that Strategy is thinking about the potential products that could be built on top of Stretch or the other preferreds. In your mind, what are the opportunities here, and what do you think will be successfully built on top of Stretch or SATA? What opportunities are here?
Yeah, I have to kick it off. I think there's always the two ways. There's a TradFi way and there's a DeFi way. DeFi is always very quick to develop, which is great. So we've seen certainly two issuers on top of Stretch, and that gives an easy tokenized access to Stretch. Then obviously there's a levered version of that. So it's almost like called a CDO or CDO squared maybe even, where they strip the coupons in a senior and a sub piece. So I think as with always these things, it's very important to structure in a way that can withstand different shocks. And we see some of them right now, so it's a good test. And certainly, I think that ecosystem will flourish because it's a very solid underlying asset base. If they're well structured, it could really grow. And again, continuous stripping. It's all about creating a curve, right? Creating stripping again, being able to allow different risk preferences for different investors.
I guess we'll judge the candidates. I'm not really sure what products will come next, but I mean, in terms of how we'll judge those. I'm going to be looking at, do they provide more transparency or liquidity versus just leverage? And I'm a little bit wary of just stacking leverage because I kind of feel like these digital credit instruments, I mean, they are like deleveraging instruments in themselves, like compared with pure Bitcoin or Treasury. I think most of all, I just want to see things that bring broader access. Right, so getting inclusions in indices, ETF wrappers, those kinds of vehicles that will get broader access, basically.
I have nothing to add on this. I agree.
Well, we only have 2 minutes left, so maybe we could wrap up here. This conversation is about digital credit and the frontier. And let's say 5 years from now, we're at this conference and we're having the same conversation and we look back. What had happened in those 5 years in order for us to say, yeah, digital credit was the frontier, it was the future, it was the future.
I hope we'll be here and there's a lot of width and depth, right? So lots more issuers, currencies, maturities, a whole, as you said, a whole curve than trade. but also depth, so much deeper liquidity, much bigger size, potentially some different structured products on top of that. So really, like I think we're good at in general in the space, is taking the best of traditional finance and putting it on on digital assets, with hopefully again with the best practices and avoiding some of the pitfalls.
And I guess, I mean, all of that, and I guess if basically it stops being a crypto story and more like a fixed income story, right, then that'll truly be success. When it basically becomes boring, essentially, you've got an institutional allocator sitting there at their terminal comparing digital credit instrument with a corporate bond on the same screen. Like, that's when we've really succeeded.
In my view, a success in 5 years would be where we are looking at capital markets with embedded credit assessments or credit intelligence. And crypto-backed institutional structures are not looked at historical milestones, but any ordinary issuance in the markets where anybody, retail or institutional investors, are already aware of the risks and are investing without having to think twice or thrice into that aspect. And I hope we reach that point in 5 years.
Awesome.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and the work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies and plans that would allow somebody, in case in the future they need to move or migrate to that signature scheme, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999, where the world was going to implode. Technology marches forward, and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more worried. Quantum will break everything way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin will adapt to it, already is. The discussions are great around it. And we're going to see many, many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but there was even just a paper that was released a couple of weeks ago where, without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for Corporations, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Bitcoin is digital capital, and right now, built on top of it, there's a new type of yield, paying 11.5%, and they're calling it digital credit. And right now, it's down by a lot. The headlines, they all say the same thing. Historic lows, death spiral, and if you own it, or you were thinking about owning it, well, the chart looks terrifying. But here's what almost everybody who's staring at the price seems to be missing. This is the 4th time that it's done exactly this. And while everyone's watching the short-term price drop, what they're missing is the underlying fundamentals that could be setting up a massive opportunity. So is it a crash, or where you need to run from it, or are the bulls right? And should you ignore the noise? Well, those are the easy answers, but they both miss it because there's one number on this thing that's completely different this time. Now, we have the same drop with the same timeline, but this one's moving on 5 times the others. And that one number is the difference between this is fine and this is breaking. So in this video, I'm gonna break it all down. I wanna show you what this thing actually is, why below 100 doesn't mean what you think it does, the one signal that tells you if a yield like this is safe or about to break, and the number that you watch so you could see the next move coming before everybody else does. You ready? Let's go. All right, so let's jump right into it. We are talking about a new form of digital credit. We're talking about a new financial instrument that, in my opinion, is way bigger than almost anybody can even imagine. Even for people who are paying attention to it, who are already fans of it, who already like it, who think they know it, it's even bigger than that. Now, I can't tell you everything about it today because that would be way too big, but I'm talking about this product called Stretch, STRC. It's a stock, it's an equity. You can buy it in your brokerage account, any one that you have, Fidelity, Charles Schwab, TD Ameritrade, whatever, Robinhood, it's all in there. And it's a digital credit that pays you a yield. Right now, it's paying 11.5% yield on a sort of fixed income asset. It's par. Let me explain how this works. So first of all, it's a stock, it's an equity, but it's what's called a perpetual preferred stock. Okay, so first of all, preferred meaning it sits up in the top of the stack, and it's perpetual, meaning it goes forever. So there's no time frame, meaning in 5, 10, or 30 years, they have to give you your money back and you don't get any yield anymore. So this goes on forever. So as long as they hold your money, they pay you the yield. At some point, you can sell it to somebody else, but they never have to pay it back. That's a pretty big deal. Okay, then it's supposed to sit at $100 par, meaning it sits at $100, sort of like a money market account, meaning that if I put $100 in, I should always have $100. And it's paying me 11.5% yield, but it's not supposed to go up and down. I don't expect to make money with it. I don't expect my 100 to grow into 200 or 300, but I also hope I don't lose money with it. And I just want to collect the yield. So let's take a look at some of this. So if you go to Strategy's website, you can see this. Again, this is off of their website. Again, so Strategy has been buying Bitcoin, digital capital, and now they have the credit instrument. So if you like yield, if you need fixed income, this is what you want to talk about. Now, like I said, this is bigger than most people can imagine. At the end of this video, I'm going to break that down a little bit. If you want more than that, we'll make another video. But we can see it's a short duration, what they're calling the high yield credit. Okay, so it pays 11.5%. That's certainly high yield, higher than almost any other fixed income that's out there. Right now, today, people are freaking out because the price is $89. It's supposed to be at 100, which means it's about 10%, 11% off of where it's supposed to be. You can see the dividend, 11.5%. So you can sort of see some of the information. Again, it's on the NASDAQ. You can buy it in your brokerage account. Now, how does this work? Well, the dividend is the dial that's supposed to work at this. So the goal is to keep it at $100 par. Okay, but how do they keep it pegged at $100? Well, they have a couple dials. Number one, they have a rate adjustment. So that means how much yield they're paying. So the more yield they pay, more people will buy it, obviously, and the lower the yield, less people will buy it. So they can adjust the yield, they can adjust the rate. And so they started it low and they've been raising it until they got it to 100. Then they have a yield reset. So every month they get a new dividend date, they get a new yield, and they can change that if they want. And then the buyers will return in to buy back. So it depends on supply and demand, right? So again, as the yield goes higher, there's more demand. As the yield goes lower, potentially there's less demand. So that's sort of the dividend thermostat of how this works. Everyone's focused on par, again, being 100. So if it's less than par, is that a problem? Well, let's take a look at that. So first of all, most people are looking at this par, but they're missing a big piece of this, and this is the duration. What am I talking about? When we think about time is money, money is time, most people don't really understand what that means. But money has duration, because money in today's economy, it's a debt-based monetary system. And so debt has a yield, has a rate, and typically has a duration. Again, 5, 10, 20 years. So we want to just measure the total amount of money. We want to measure the return of the yield on money, but we also want to know the duration of that as well. So let's take a look at a couple of things. So if we look at this right now, we can see that when this is the price chart of Stretch right here. So we can see when they first started out and they were raising the rate. So right here at this line, it's about this is about 90 right here. This was about 80. What do we got? Yeah, 80 sitting right here. So it launched at 80, and they kept raising the dividend higher and higher and higher to attract more people to it. And you can see the price has gone up pretty well. And here is $100 par where it got. So eventually they got up to there as they continue to raise the rates. But as you can see right now, we're sitting in this massive crash that everybody's freaking out over. Like, is this it? Is this the end? Did Stretch finally fail? No pegged assets ever work. Of course, short traders, we're going to try to destroy it, all these things. And we can see it's down about 8% right now. But if you zoom out and look at the chart, by the way, this is only 11 months. It's not that long. But if you zoom out, you'll go, wait a minute. I see that we also dropped 6.5% here. I see we also dropped 9% there. So 9% here, 9% here seems about the same. We had this one right out of the gate. This was 6%. This was 6.5%. So, when I zoom out over the last year, this kind of looks par for the course. But now let's look at the duration, right? So the duration, we can see this one took 14 days. This one took 25 days. This one took 22 days. And so far, right now, we're only at 21 days. So 25 days sort of being the longest in this small sample size. So we want to look at the duration. So as we can see, over a year, this is the fourth drawdown of about the same size, looks pretty normal. And then the duration. So we can see the duration is also about normal. So people are freaking out without any perspective as to what's going on. When I look at that, it looks much more comfortable, maybe, right? But then what about the fundamentals? Well, these are the things that we want to be paying attention to, because what's going on externally that could be driving this drawdown and change the duration? Well, first of all, a couple things. Strategy did halt new Bitcoin purchases. All right, so they've been buying Bitcoin regularly, and they decided to halt Bitcoin purchases temporarily for one break. And then what they did, which seems to have disrupted the entire market, was they did their first Bitcoin sale that we've seen. 32 Bitcoin sold. Now let's put this into perspective, what happened and why. First of all, they sold 32 Bitcoin out of about 840,000 Bitcoin. They're buying thousands of Bitcoin at a time, and they sold 32. 32 is a drop in the bucket. 32 is inconsequential. But why did the market freak out over it, number one? And two, why did they even sell 32 if it's so inconsequential? A couple of reasons why. They are not playing a Bitcoin game necessarily. They're playing a financial market. It's a traditional financial market game. They're playing a stock and equity game. And in that world, selling credit instruments, they need credit ratings. And per the credit rating funds, some of them don't treat Bitcoin as actual capital. So they don't believe that even though they have $50, $60 billion in Bitcoin assets, that they could actually use those assets to pay the debt if they needed. So Strategy wanted to prove it. They said, okay, we'll prove it. We'll sell 32 Bitcoin. You can see how liquid it is, how easy it is to sell the money, sell it for money, and pay the dividend, and they did. Again, it was a token. It was a drop in the bucket. It was just proof, and what it did is it satisfied the rating agencies, which allows them to move to the next level in the credit game. But the market said, wait a minute, Michael Saylor said he's never going to sell Bitcoin. Michael Saylor corrected that. He said, I said for you to never sell your Bitcoin. He said, I have never sold my Bitcoin. Strategy, on the other hand, did sell some Bitcoin. So he clarified that. He said, you and I, we should not sell our Bitcoin. The company is playing a different game. In order to appease the regulators, they did that. So 32 Bitcoin, but that also pushed the price down. They halted Bitcoin buys, pushed the price down. Then they sold Bitcoin, again, 32 billion, pushed the price down. And then they're changing the dividend payment, but this is a good thing. We're going to talk about this more in a minute. They've been paying monthly, and now they want to pay semi-monthly, which means instead of paying once a month, they want to pay twice a month, which is great. Most people are getting used to getting paid every 2 weeks. Okay, so we looked at it coming off of par, off of the 100. We looked at about how far they've dropped and how long that's lasted. We looked at the fundamentals, and of course, we realized that part of the bigger fundamental is that the underlying asset, the digital credit, Bitcoin, is also down about 50%. But the other thing we want to keep in mind is compared to what? How does 8% drawdowns compare to what? Well, the fixed income market is the largest market in the world. $350 trillion of fixed income. It's 3 times larger than the next biggest market, right? Than the equity market. And so some people just need income. Not everybody can buy Bitcoin and wait for 5 years. Some people need income right now. I'm retired. I need to pay my bills, pay my medical expenses, whatever it is. We need income. It's the largest market in the world. So where do people typically invest to get income? Well, sometimes there may be dividend paying stocks. Obviously, it could be real estate, but most of it is in the bond, money market, institutional grade, credit funds, things like that. So let's compare this. Let's look at the yield and the volatility comparison in a matrix. So money market funds, they typically yield about 4 to 5%. Pretty low, about the same as treasuries. The volatility, how much they go up and down, is near zero, and the typical drawdown is minimal. They don't really go up or down. So you get about 4 or 5% return, not a lot of return, but there's very little volatility or downside risk. Then we go to the T-bills, treasury bills, US government bills. The bills are the short end of the curve. Those typically yield a little bit less, 3.5%, 4%. There is a little bit of volatility. The price of bonds goes up and down, maybe 1 to 2% volatility, but the drawdown is typically pretty tiny. Then we wanted to get into more yield. So if you want more yield than just treasuries, which are not keeping up with the rate of inflation, then I need more. So I might go into institutional grade credit. So now I'm buying like credit bonds, institutional credit, and that's going to get me a little bit more, 4 to 6%, but there's a little volatility, 1 to 6%. So up to 6% volatility on an annual basis. Not big drawdowns, because it's institutional grade credit. Then we have high yield credit. So now I need a little bit better return. High yield credit is up to about 7 to 9% yield. A little bit better. I can get above the rate of, I can probably keep up with about the rate of debasement, rate of inflation. But the volatility goes up as well, 10 to 12%. That's the volatility of that. And it could drop, the typical drawdown could be as much as 20%. So it'll probably go back up, but at any given time, I could be down up to 20% while I'm getting a 10 to 12% return. Okay, then we go to private or alternative credit. Private credit, I've talked a lot about this on this channel. That's gonna pay a little bit more, 8 to 12%. A little bit smoother on paper, the volatility, but could be very dangerous. I did a whole video on the private credit market breaking down. Maybe we'll link to that in the show notes down below. And then finally, let's compare Stretch. So Stretch, again, it's 11 months old. It's a brand new product, digital credit, built on top of digital capital, Bitcoin. It's paying right now it's paying 11.5%. So it's paying as good as private credit, better than high yield credit. The volatility is very low. But the typical drawdown could be as much as, when I say very low, it's probably 10 to 12%. And so far we've seen a 6 to 9% drawdown. So when we compare it, it's much better than the high yield credit at 20%, 6 to 9. A little bit more volatility, about the same volatility as high yield credit. So it's kind of about the same, but it pays, of course, quite a bit more. So when we want to understand things compared to what, I think that's helpful to figure out how this fits into your portfolio. Okay, now, the one thing that nobody seems to be watching, because they're also focused on the price. They're focused on the $100 par and the drop down we're at 90. But what they seem to be missing is volume, right? We want to understand volume. How many people are moving in and out of this? Because as this gets bigger, as we have a lot of liquidity, a bunch of trading volume, we want to look at the volume as well. Now, we have to understand that volume cuts both ways. What we can see is that, of course, as more people bought this, the market cap went up, the price went up. And then as this drew down right here, there was a lot of volume. There was a lot of people selling, 5 million. There was also a lot of people buying. It cuts both ways. What we don't know, was this volume made up of sellers or buyers? Well, it was made up of combination. We don't have the breakdown of both of those. We can see in this drawdown right here, of course, as the market cap got bigger, more people were in there. We saw the volume go up to 13. Then in this drawdown, we saw it go up to 25. And now where we're at right here, we're at 58 million. So we've seen this volume grow by, what is that? Almost 10 times. It cuts both ways. People buying, people selling. What is this really doing though? What this does is it resets the floor. It gets the weak hands out, it brings the strong hands, and it helps to form a bottom. So again, people are focused on the price, but you're not seeing the underlying fundamentals of this being built up and the volume coming in. As I said, it cuts both ways. And so people are rushing for the exit, some of them, and then other people are rushing for the entry. Why? Well, we know if the target is 100, and I can buy it right now at 90, that means I have about a 10% return potential on the cap gains on the price performance, and I'm also going to collect 11.5% yield at the same time. So traders love this because they know Michael Saylor's pretty smart, they know he's pretty successful, they don't think this is going to collapse, and I could just buy it at 90, right up to 100, make 10%, and capture the yield at the same time. It cuts both ways. So what we want to be watching right here is, sure, watch the par, watch this number, can we get it back up close to 100, and then also watch the payments. Do they keep making the payments? As long as they keep making the payments, it's going to get back to par, even if they have to increase the payments. Now, this went out on X today on Twitter from Strategy itself, and they said right here, we have 32 years of dividend coverage through their Bitcoin reserve. So 32 years. So a lot of people wonder, like, can they keep making the payments? What happens if they don't have any more income? What happens if the credit markets dry up? All these things. Well, they say right here, we have 32 years. They have $55 billion of reserves, and they owe $1.7 billion per year. Now, that's if they wanted to tap into their Bitcoin, but they have lots of other things they can do before they have to get into their Bitcoin. I'm going to cover that in a minute. But so those are the two things that we want to be watching here. Now, here's a couple ways that we can think about how they can handle those payments. So first of all, they have this dividend obligation. As I said, it's about 1.7 per year they have to pay out for money that they've received. So a couple ways they can do this. So number one, they have a cash reserve. Right now, they had it up to about $2.5 billion. I think it's down to about $1 billion or so right now, but they have this cash reserve. It kind of goes up and down, and they keep that on hand to pay this out. So they have about a year's reserves on hand. Then they have equity issuance. So they sell their common stock ATM at the market. And so they sell MicroStrategy stock. That raises money, which allows them to buy more Bitcoin, or they could pay the dividends on the prefs. They also can issue more stretch. So whenever stretch goes over $100, they can sell more stretch at the market, into the market, and they can generate that money as well. And then finally, if they need to, they could dip into their Bitcoin Treasury, which is over 840,000 Bitcoin. Now, there's also other ways they can get money. So for example, they have credit available to them. We saw them raise billions of dollars at almost 0% interest. So they can go back to the capital markets, they can do private equity raises, they can sell the equity in the market, they can borrow money, they can do capital raises. They can issue more stretch, they can sell the common stock into the market, they can sell the Bitcoin if they need to. There's lots of tools they can do before they ever have to tap into the Bitcoin reserve. And if they have to, as we saw right here, they have over 32 years backing that. So the chance of this blowing up is extremely low. Now, this is bigger than the ticker, okay? This is not just about a stock. And as I said, this is one of the biggest opportunities. Maybe opportunity is the wrong word, but maybe this is one of the biggest fundamental shifts of the entire global monetary system that we've ever seen, or we'll ever see in our lifetime anyway. It's not just a stock. It's an entire new financial system. It's digital capital, and now this is digital credit built on top of the digital capital. What do I mean by that? So right now we've seen digital credit grow from 0 to $13 billion in less than a year. It's about 11 months. 11 months. And this is really the category's first punch. What do I mean? The first punch in the face. Mike Tyson said, everybody has a plan until they get punched in the face. And so this is sort of the first real stress test. We're getting punched in the face. Bitcoin has drawn down 50%. Lots of FUD in the marketplace about MicroStrategy. They sold some Bitcoin, they paused their Bitcoin buys, and we're seeing the first punch, and we're seeing it sort of hold up about the same way it's been holding up this whole time. But what we're witnessing is something much, much bigger. As I said, the capital rotation. So typically, money, people need yield, and so they go into treasury bonds, they go into corporate credit, I kind of broke these down, preferred stocks, or money market funds. What that means is that's all yield-seeking capital. Again, about $350 trillion needs yield, okay? And now all of this $350 trillion pie is starting to find its way into stretch because, of course, the yield is very attractive, better than any of these other products, but also because the way this works from a safety or security standpoint. What do I mean by that? All of these treasury bonds, corporate credit, preferred stocks, etc., are based off this same model that the entire financial system is based off of, which is discounted future cash flows. So if I do corporate credit, for example, I'm going to buy a Google bond or an Apple bond or a whatever bond. So I'm going to buy a Google bond, and I'm going to give them money for a period of time, and they're going to take that money, that loan, and they're going to invest it into, say, some new models, some AI models. They're going to invest it into a data center. And they hope, and they pray, and they promise that that data center, that investment into that new model, whatever it is, will pay off. And in the whatever 5-10 years, they'll have the income to pay the bond. Hopefully, it works out. Hopefully, they'll have the income to pay the bond. The entire financial system is built off of that, even equities. I'm buying a stock at a PE ratio, a price to earnings multiple, off of how much revenue or income they'll have in the future. But with AI disrupting every business model, how do we know they'll have the income in the future? How do we know that in 10 years they'll even still be around anymore? That's how this entire system is built. Discounted future cash flows. Discounted future cash flows. MicroStrategy is doing something different. When you give them the money, they buy the asset. They're not investing in it. They're not hoping that in 5 or 10 years they'll have the money to pay you back. They have the asset today, which is why they have, what did I say, 60 billion in assets. They have enough for like 30 years of payments because they have the assets. Here, all of this, Google, Apple, Tesla, the governments, etc., we hope that in 5 or 10 years they'll still be in business. We hope that in 5 or 10 years that investment pays off and they have the cash flow to pay that. Versus over here, they have the money themselves, which is why this model is completely different than anything that we've ever seen before. Let's go back to why I think it's going to be so big. So we have $350 trillion of yield-seeking capital. And currently, all of that $350 trillion of yield-seeking capital is based off of equities and bonds on a dollar standard. Now, the demand for that yield doesn't go away. It just transfers. Already, about 13 billion, which is nothing out of 350 trillion, 13 billion has moved over to be backed by Bitcoin. And eventually more and more and more. And so if we have, let's say, this $350 trillion pie, all USD denominated, eventually we get 2, 4, 6, 100 billion, right? The point is this pie keeps growing. So this is a Bitcoin denominated pie. And what happens is more and more and more starts moving over. The 350 trillion demand doesn't go away, but maybe this goes 100 trillion and this drops to 200 trillion. We're witnessing the entire bedrock of the global financial system be switched out in real time. Okay, so what I'm trying to give you here is a skill and not just a tip. I'm not a tip guy. I'm not here to give you tips. I'm here to teach you how to fish, not tell you how to bait the hook, okay? So now you know how to read what these are. You understand digital credit. You understand the underlying mechanics of this, and you can see now that it's behaving as it's designed. There's volatility built into this, and of course that's going to be part of how they adjust that dial based off of the demand, the yields, and things like that. Now, we want to understand when we look at this, the volatility, and we want to understand compared to what? Compared to other fixed income type instruments. And as you can see, when you compare it against other options in the marketplace for fixed income, it ranks pretty well, as a matter of fact. Now, what's important here, like I said, the big shift here is what's backing it. Because there's two kinds of yield. You have the printable backing. So treasury bonds, corporate bonds, traditional preferreds, money market funds are all backed by dollars, which are printable. Or backed by more stock, which is printable. But over here, this is unprintable backing. So Stretch and Strategy are backed by Bitcoin, backed by the 840,000 Bitcoin, capped at 21 million supply. No central issuer of the collateral. So what we're witnessing is all this yield move over here. Okay? So as this develops, a couple things that you should watch. Number one, watch for the recovery. Watch if we can go from whatever we're at, 89, can we get back up to 100, number one. And number two, watch the dividend. If they stop paying the dividend, that could be some smoke. Maybe. It's important to watch. Watch the math you were taught about money is keeping you broke. And it's not because you don't earn enough. It's because the number that you've been taught to measure your growth with, it's wrong. Now, it's not your fault. Nobody taught you this number. Your advisor He watches the same number that you do. The bank, the school, the system, and almost every other finance guru on YouTube, they all watch the same number. They've been tracking the wrong number. The one that makes your wealth stall out. It's the reason that people who did everything right, who saved for 30 years, still hit retirement and find out it's not enough. But the 1%, the family offices, the people who actually build real wealth, they don't watch the same number. They watch a completely different metric. And the day you see it, you'll understand why the same starting capital that leaves you stuck makes them millions without ever having to earn a dollar more. So let's go. All right, we got a big video today, and I love these ones where I can break down these misconceptions, these commonly held beliefs. And I know some people are like, hey, you don't know what I know. How do you know I have the wrong number? Well, let's just wait and see. So the roadmap here, we're gonna talk about the number that you were taught to watch. And again, I know you were taught to watch this, the same number I was taught to watch. We're all in the same financial system here, right? Well, we're gonna look at the number that the wealthy watch instead. Now, the problem with this for most people is like, you know, how many billionaires do you hang out with on a regular basis? And so most people just don't have access to see what they're doing. So we're gonna break that down. And then of course, the system that you can use that turns the second number into real money. Because what's the point of having this knowledge if I don't put it into action, right? So let's break it down. Let's go as quick as we can so we don't drag this thing out. Okay, the number that you know first. What's the number that you already know? The number that you already know is ROI, right? We're talking about investing. Anybody know what that is? Put in the chat down below, ROI. Let's see, return on investment, right? Well, that's the common number. That's the number you were taught to watch. We're investors, right? We want to know our returns. But the problem is that 43% of Americans aged 55 to 64 have no retirement savings. So the number that everyone's been focused on through their investing career, their retirement planning, working with their financial advisors, their financial professionals, it hasn't worked out too well. So if that doesn't work out too well, while at the same time people continue to get more and more wealthy, we see it all the time, charts that just show this income inequality gap is just growing more and more rapid. The rich keep getting richer, the poor keep getting poorer. Well, why is that? We all have access to the same financial system. Maybe it's the strategies that we're using that break down the difference. Okay, so let's think about this another way, for example. So let's just say, for using round numbers, I'm not real good with math on the fly here. So let's say that we have $1 million home. Let's go ahead and just put a roof on that house right here, and it's $1 million home. And the median US real estate's going up by about 5% a year. So my asset is a home. My asset is worth $1 million. The median home goes up at 5%. So $1 million times 5% means that my return on my investment or my return on my asset went up by $50,000 a year, right? That's the number that we know. Makes sense. Okay, but is that the right number? Well, let's take a look at what the wealthy do instead. Okay, so the wealthy use a different number. The wealthy use not ROI, they use ROE. And ROI tells you, what did my asset return? The $1 million home went up by 5%. The return on my investment or my asset went up by 50,000. But the ROE tracks something completely different, something that most people have never thought of. ROE tracks, what did my equity return? So let me give you an example. Let's go back to the same example that we just used. In this example, again, let me put a roof on here. So I have $1 million home. It goes up by $500,000 a year. But let's say, like most people, if I have an investment property, it's a rental property, it's an apartment complex, a triplex, a fourplex, or it's even my single family home, most likely we have a loan against it, right? We use debt. We're in a debt-based monetary system. Of course, we're using debt to buy these things, which provides us leverage, and we can get into all that. It's a different subject. But I have $1 million home, so I have a loan against that, and I put some money down, plus my property's appreciated. So let's just say that I have $400,000 of equity in that property. Now, what's interesting is that this $400,000 in equity is just sitting there. It's sitting there in the asset. My $1 million home is going to make me $50,000 over the next year at 5% return. But what is the equity returning for me? Now, some people might say, well, I guess I could take the 400,000 and the 50,000 and come up with an equity percentage, but that's not the way to do it. It's not the way the wealthy do it. Because what happens with this 400,000 equity? More specifically, if this $400,000 is in this property, will that affect how much this $1 million home goes up by? That's the way to look at it. So the answer is no. If I have $10,000 in this property or $100,000 or I pay cash, the $1 million asset is going to go up at 5% either way, which means the $400,000 that's sitting in the property is effectively making me about zero because it doesn't have to be there. It could be somewhere else doing something different, controlling another asset. So when we just watch the return on our investments or the return on our asset, we're missing what we really have. You see, in a debt-based monetary system, we use debt. Money is created when debt is issued. But in order to get the debt, we have to have collateral. So the assets become the collateral, but we're not using the collateral. We're not even looking at the collateral. All we're looking at is the ROI on the asset. Okay, so we want to think about it a little bit differently. So if I have return on my asset, again, it's what did the asset do, the home, times the appreciation. But return on my equity asks, what is the $400,000 doing? That could be doing something different. So for example, if my home is going up by say 10% a year, 5-10% if you put your own number on that. But I take this 400,000, I put into another asset like the NASDAQ, for example. But now I have, let's say, 400,000 times, call it 20% in the NASDAQ. So now I have this asset, $1 million going up at 10%, I made 100K over here, but now I have 400K going up by 20% and I made 80K over here. So now combined, I have 180K, whereas before I'd only made that. But that's only if I focus on the equity position and not the total asset. Okay, so you have to understand this goes into a system that allows us to measure this. So just think about this yourself. Get out a pen and paper, pause this video if you want real quickly, and think about your own equity. Now, we have equity, right? Because we have a debt-based system. And I also have assets. So for example, Bitcoin, as we call it, is like pristine collateral. That means I own it and typically there's no debt against it, but there's also equity there. So how much equity do you have that isn't adding to how much the value of that asset is going up? Again, using the home, for example, if I have $1 million home and I have 400,000 in equity, potentially I have approximately 400,000 that will not affect how much this home goes up by or not. You get an example, right? So think about that. Think about what assets you have that have equity in them that could be there or not and won't affect how much the asset goes up or down. Now you're starting to realize you have a lot more equity, a lot more capital, a lot more collateral that you could use to build wealth. That's what family offices do. That's what hedge funds do. That's what the 1% wealth builders do. Okay, now let's think about if that is so common and if that's so true, then why doesn't everybody do that? Obviously, right? Well, there's a couple of reasons. Why doesn't everyone do that? First of all, because of the debt. So the debt is a double-edged sword. What do I mean by that? So a lot of you, if you watch this channel regularly, you know that in 1971, right here, President Richard Nixon removed the dollar off of the gold standard and we went into a pure fiat debt-based monetary system. So what that means is pre-1971, a lot of you watching this video right now, we're building wealth pre-1971. We were in what was called an equity-based system. And in an equity-based system, you didn't want to have debt. You wanted to pay debt off as fast as you could, and you wanted to build equity instead. But in 1971, post-71, we went into a debt-based monetary system. That means we don't want to save because savings is getting eaten away by the debt. And instead we want to use debt because the inflation pays our debt off for us, which is why the government wants so much of it. And you can see this is the M2 money supply. So you can see up until 1970, the money supply was basically flat. If I carried this out, this is the green line right here. You can see it was basically flat. But as you can see, the rate of money supply growth has gone exponential. And the reason why is because the government wants the inflation to pay off the government debt, which is why we want to use debt so it pays off our debt. And most people are still learning systems. They went to school that had textbooks that were written in 1971. They're listening to their parents who built wealth post-1971, and they don't realize that the global monetary system changed. And because of that, we have to change the approach that we use. Another reason why is this. You'll love this. This is a curve. Some people are here, some people are here, some people are here. So on this side of the curve, let's call these broke people. Now, I don't want to say broken money. Let's just say it's a broke mentality, because all it is a mindset of how I approach the game. Broke people use lots of debt, use lots of debt. They use lots of debt, too much debt, but they use it for depreciating assets. So these people down here, man, they have way too much debt. They have all these credit cards. They have all these bills, car loans. They put vacations on credit cards, all these things. So they have lots of debt, which is eating them alive. It's taking away their disposable income. It's taking away their ability to have money left over to invest, because they use too much debt for things that are going, let's say, going down. Here we have people that are way smarter. Let's put some glasses on this guy. Here we have people that are way smarter, and they listen to Dave Ramsey, and they know better. I don't use debt because I watched what happened over here. I got out of debt. It was crushing me. I'm never going to use debt ever again. And so they have no debt, but they're only saving a couple percent, 5% of their wealth every single year, and it's not really growing. So they don't really have much money. Then over on this end, we have the other side of the curve. As a matter of fact, let me pull up this chart right here. You might recognize this meme. We call this meme the midwit curve. So over here is too much debt, but it's bad debt, right? Depreciating assets, all going down. Then we have the midwit. He's very smart. He's, like I said, watched all the videos. He's paid off all his debt, and he's got none. But over here on the other side of the curve is we have people that also use a lot of debt, So a lot of debt here, no debt here, a lot of debt here. But the difference is over here is all bad debt, all depreciating stuff, credit cards, going out to eat, things like that. Over here, they put all the debt into assets that are going up in value. That's the difference. That's the midwit curve. So where do you find yourself? Most people have talked themselves out of, well, one, not realizing that the system changed, the monetary system changed. Number two, that if the system changed, I have to change my approach on how I play with it. And then three, we find ourselves stuck in the midwit curve where we think we're being smart because we don't really understand the game the way it's meant to be played, that it's meant to be played by using assets and collateral inside this system. And the difference of why this matters is because the rate of money supply is growing at about 10% a year, which means our cost of living, cost of goods is going up about 10% a year. And like most people, we should have a goal. We need to have a certain amount of money that can pay for us so we don't have to continue working until the day that we die if we don't want to. What happens is, for most people, let's say that I have, 100K, and I have, whatever, 15 years to get there. But I need $1 million, which means I need a 10x return. But most people are making a 6-7% return, 8% return. That's barely keeping up with the rate of inflation, and they end up with about 400K. But the problem is, for you to go from 100K to the million that you need, you're going to need about a 16 times return, or 16% return per year. I'm sorry. It's a 10 times return total, but it's a 16% compound annual growth rate each year. So the question then becomes, well, how do I go from this yield here where I get to 400, and how do I get to here, to here, to here? And the answer is, I have to start to learn how to use my capital. I have to start to focus on return on my equity and not just on my investments or my assets. Okay, let's break down the math for you so you can understand how this works. Okay, so we use sort of the same 2 points. Actually, it's a little bit different. Instead of 100 to 10, it's now 400,000. So maybe I have 400,000 starting capital, but my goal is to get to 2.4 million. Now, I know where I want to go, and I know where I'm at now. So the question I have to fill in the blank here is just now the gap. It's the engineering. It's a math problem. So there's 3 levers that I can pull that can change this. Number one, I have the amount of capital, which is this number. So if I need to get here, I could add more capital. I could make more money. I could sell something, buy something, whatever. Number two, I have the time it's going to take me, this gap, this trajectory, this horizon. And then 3, I have the rate of return, or my yield, okay? So the way it works is I have 72 divided by my return. So if I make a 10% return, that means that every 7.2 years, my money supply doubles. Okay, so if it's 7.2 years, that means in 7.2 years, the 400 becomes 800. And then another 7.2 years, that becomes 1.6 million. And another 7.2 years, that becomes 3.2. So if I wait 7, 14, 21 years, about 21 years, I can get to that goal at a 10% return. But let's say that I don't want to wait that long. I don't want to wait 21 years. I want to get there in 15, or I want to get there in 12 or in 10. Well, then that means either one, I have to put more capital in, or number two, I have to get a better return. So instead of 10%, if I go to a 20% return, now I've dropped it to 3.2 years. So now if we do the math over, that means every 3.2 years, 400 becomes 800. And then 3.2 years becomes 1.6 million. And then 3.2 years, it becomes the 3.2. So now, about 9 years, a little bit less than 10 years, I've managed to meet that goal. Great. So if that's what I need, if I can't put more money in and I can't wait longer, can't wait to 21 years, then I have to get this number up. So that leads us to what we're talking about right now. How do we do that? Well, we do that by engineering return. Now, what most people do is they turn to gambling, right? So they're chasing meme stocks and they think they're gonna do options trading and they're gonna like sit on Reddit and Twitter all day looking for like the pump and dumps or whatever they're gonna do, but you're not gonna be able to do that for 10 years straight. Like you can get lucky once or twice, that's about it. So what we have to do is we have to build out structure and rules. And so what most people do is they take their $100 and they divide it up. They're gonna put 60% here, they're gonna put 40% here, 10% here. But what we want to do is build a vertical structure that allows us to get velocity through our assets. So each dollar is multiplying and $1 can now control 3 assets at one time. That's how we build a structure that gets our return on our equity up, as opposed to most people over here focus on return on their investments. That's the whole shift that you need to focus on. Okay, so how do we do this? How do we know what number we need to watch right here? Well, as I said, we kind of have 3 different things. If we want to know how to diagnose the system or build the system or understand the gaps in the system, it just comes down again to 1, your capital, 2, the time you're willing to wait, and 3, the return or the yield that you're making. So identify where you're trying to go, understand where you're starting from, and then understand the 3 levers. If you have time on your hands, if you're young, you're watching this video, and you got 20, 30 years, you have time on your side, allow that to compound. If you don't have as much time on your hands, then you either need to get more capital, but some of you may not really be able to get more capital. So the one thing that you could probably affect is the return, and you do that by building a different structure, a layered structure, and more specifically, focusing on not ROI, but instead focus on your equity and what your equity is returning for you. All right, let me know what you think. If you want more deep dives on any of these topics, let me know down in the comments down below. As I always say, the last 3 market crashes were devastating for lots of people. 2000, 2008, 2020, each one was bigger, deeper, and each time they got fixed eventually, right? The markets came back, your money came back, but there's another crash on the horizon right now, recession, overvaluation, the next bubble, whatever. And while most are expecting an even bigger and even deeper version of the previous 3, what's coming next won't be anything like the previous 3 because that didn't get fixed. They got pushed, right? The problem wasn't fixed, it was moved up 1 floor. Now, understanding this is gonna be the difference of which side of this next crash that you're on. It's gonna be the difference of what happens to your retirement and your future. So in this video, I'm gonna break down the 3 floors they've already used to bury the last 3 crashes. I wanna show you what the coming 4th floor is. I wanna show you the one thing to watch so you can see this turn when it's actually coming. And I wanna show you in the position you can take before everybody else gets there. All right, you ready? Let's go. All right, so let's jump in. Let's talk about the next financial crash. Everyone's ready for the next financial crash. You clicked on this to learn about the financial crash, and it's coming. 2000, 2008, 2020, and there's something coming here. And what happens is a lot of people think, well, whatever happened here, here, and here is gonna happen again. There's a saying that says generals always fight the last war. And so they think, well, whatever happened last time, that we got attacked on the south side, so let's reinforce the south side. But most likely it happens differently. There's a story, I believe, after World War II, there were some engineers in the Air Force that were looking at the planes that were coming back from battle. And they were looking at them just full of bullet holes. And they're like, let's find all these planes, and then the areas that they're getting hit, let's reinforce those so we can protect these planes. And one of the smart engineers there, one of the few smart engineers, I guess, said, hang on. these bullet holes didn't matter. They didn't take the planes down. What we should do is go look at the planes that crashed and let's reinforce those areas. And so we have to look at things differently. And so if we just understand what happened here and we try to plan for the same thing, it's not going to lead us to the outcome that we want. So let's understand what happened, but then understand the mechanisms behind this. Now, let's go back to understand what happened to these ladders, the first, the second, the third, and the fourth one that's about to happen, so we can understand how it could happen and what we could do to protect ourselves, or more importantly, advantage ourselves from this. Okay, so if we go back to 2000, this was the dot-com crash, right? A lot of you guys maybe are old enough to remember that. I lived through that. So the dot-com bubble happened and all that money starts draining out. We can see, so 2000 was the dot-com bubble. Well, as that money is draining out, it had to go somewhere. Where does it go, right? Money is like energy. It doesn't disappear. It needs to go somewhere. So Paul Krugman at the time said that, hey, what we need to do is create a housing market. We need, Greenspan, head of the Federal Reserve, needs to create a housing bubble. So we kicked the can up the road. In 2008, becomes a housing bubble. Of course, you know how that turns out. We had all the homes, then the banks started buying all the mortgages. They started packaging them up, selling them off as collateral securities. And then that caused not just a housing collapse, but an entire banking collapse. So then that got kicked up the road to more of a sovereign system. So now the government, the Federal Reserve and the government, took all this bad debt on their books. And 2020 happened, of course, that was the COVID crisis, but we already lost the stock market. Then we lost the housing market and the banking market. Then we went to the sovereign level, and that happened. So we can look at this in size. I'll tell you where the fourth level is in a second, but just take a look at this so you can see it. Here it is in 2008, this got kicked up in the housing market and went to the federal. So the Fed had to expand their balance sheet. All the debt went to the government, to the sovereign. Then you can see we trucked along right here, and then 2020 came, and then look at the amount of balance sheet increase that had to happen in order to kick this up to the next level. Now, we're not at this level yet. This will be the fourth level. This is the one that's coming. But what happens is most people look at this and think this is what's going to happen again. They expect the same thing. Just to see the size of this again, this is the TARP package. I can remember back in 2008. Anybody remember 2008? Drop me a comment down below. And I remember they talked about bailing out the banks, and there's this TARP package. It's going to be $700 billion. At the time, I can remember thinking, no, like they can't do this. Like $700 billion, it's insane. And now that's just like, we don't even know what that number is anymore. But you can see, so $700 billion is what they proposed. We can see the total Fed balance sheet was about $1.3 trillion. Now there's some dark data that shows it might actually be, 10 to 20 times more than that. We don't really know, but we can see that number. Now, the key thing that I want to show you here, though, is that right now what we have in this ladder is we can see that all of this kicking the can down the road has made the government's tools that they have at their disposal to fight these things less effective. So, for example, we can see the 2-year Treasury yield versus the Fed funds rate. So the Fed sets the rate. When you hear Jerome Powell and now Kevin Warsh at the Fed saying we're going to raise rates or lower rates, they're lowering or raising the Fed funds rate. But the Fed funds rate, as you can see, follows the 2-year Treasury yield. The market sets the 2-year Treasury yield. They set the Fed funds rate. And as you can see, they're pretty closely locked. A lot of people would say, and I would probably agree, the Fed doesn't really have any control over this. The market does. The Fed sort of just follows it to act like they have some control. They can influence it. And sure, they can move money into different parts of the market to affect this, buy down the yields, etc. But what we can see is this divergence right here. And this is pretty important. So what we can see is the effective funds rate is starting to diverge. It's far further behind than where the market is pricing it to be. So the market is saying, hey, it should be way higher here, but the Fed is still holding it down here. That's the problem. We can see that the Fed is starting to lose control. Okay, but the key piece here, before we move on, is that in this market, the market crashed. In order to bring it back up, we had to create another bubble. Then the market crashed. The S&P 500 was down 60% here. 7 years it took to get back to all-time high. In order to get it up, we had to kick it up to here, to the sovereign level. In 2020, we saw another big crash. And in order to kick it back up, we had to debase the dollar massively. The question is, what does this fourth cycle look like? What does it look like when all the tools of the past are gone? What will the next one look like? What will give? Well, the first thing we have to understand is the measure. And what I'm talking about the measure is the tape measure. How do we measure wealth? How do we measure assets? How do we measure buying power? Now, I talk about this quite often, the measuring tape. And now the measuring tape, depending on what measuring tape you're using, you're going to get a different measurement. In some measuring tapes, it looks like you're making a lot of money. Some measuring tapes, it looks like you're losing a lot of money. What am I talking about? Okay, well, let's take a look at this chart right here. This is the S&P 500 priced in dollars, but it's also priced in gold. So the one thing you want to do in order to understand this fourth crash that's about to happen, is you have to understand really what money is or what assets are is preserving purchasing power. Because we don't want money. Money is a means to the ends. What ends? The goods and services that we want. And everything's a trade. So a U.S. median home is worth about $460,000, but it's also worth whatever, a few thousand barrels of oil or a few thousand ounces of gold or a couple of Bitcoin, right? 5, 6 Bitcoin, whatever, right? But everything's a trade. It's all measured against each other. So we can price the S&P 500 in dollars and we can price it in gold. And when we do that, we see two very different pictures. All right. So after 2020, which is right about here, this kind of tracked and then it started to diverge. And what we can see that the S&P 500 priced in dollars looks like I'm rich. Oh my gosh, my retirement account is looking so good. I'm going to be so rich when I retire. But the reality is, if you price it in gold, you see you're actually down here, and that means your purchasing power has gone down. So in dollars, you look rich, but in true purchasing power, what you can actually buy with it, the vacations you can buy, the clothes you can buy, the homes you can buy, the fuel you can buy, you're actually more poor on paper. So it's important to understand the measuring stick. And we can see this by the price of gold. Okay, this is just the price of gold, but we can see how much it went up. It's pulled back a little bit, but it was up to over $5,400 an ounce at one point, and it's pulled back. And of course, that overlays with this. This is the US money supply. So as the money supply continues to go up, then it continues to distort that measuring stick. It makes asset prices go up, but it shows your purchasing power going down. All right, now this is an example of that in other currencies. So this is not just a US dollar problem. This is gold's appreciation in each currency. So here we have CNY, we have USD, we have CRW, and we have Japan's dollar. And what we can see is they're up across the board. So what does that tell us? That tells us it's not a currency problem, like it's not a US dollar problem. It's a fiat problem. It's a sovereign level problem. Remember back to 2020, after the dot-com bubble got kicked up to the housing bubble and the banking bubble, then it got kicked up to the sovereign bubble. So in 2020, all the central banks, all the governments around the world had to stimulate their economies at the same time because of course they shut all the economies down. And so now what we're seeing is a total breakdown in all fiat currencies, not just dollars. And so this, as I said, is not a dollar story, and we can see that gold is at the top of this. And it's not just gold as in price. What we can see here is this is the European Central Bank, the ECB, put this out just June 2nd of this year, 2026. They say gold has overtaken US Treasuries as the world's top reserve asset. It's pretty big. Mark the date. June 2nd, 2026, RIP. That starts to change everything. All right, so Mark, you're talking too long. It's getting too long. Just tell me what's happening on that fourth floor. Like, what's the next crash gonna look like? Okay, well, let's take a look at that. The top floor, the fourth floor, let's take a look at that. And so right now, what we can see is the US is starting to look more like emerging markets. When you look at the US Treasury market, which is the bedrock of the global financial system, it's looking more like emerging markets. What do I mean by that? We can see here monthly Treasury holdings change. This means the amount of treasuries, the bedrock of the financial system, the amount of treasuries being held by other governments and how that's being changed over time. And what we can see is right here, it's starting to collapse. So it goes, you know, up, down, up, down, up, down, up, down, a little bit more down. And look at this complete collapse right here. We can see this is the amount of treasuries being held by oil importing emerging markets. Why oil importing emerging markets? Well, because they're the ones that are susceptible to these prices. They're the ones that have to maintain purchasing power for real goods and real services. Why important to understand that. And we can see that this is synchronized. Again, this is not a US dollar problem. As I said, the third floor kicked it up. It's now a sovereign crisis. Okay, it's not a tech stock bubble. It's not a housing bubble. It's not a banking bubble. It's now a sovereign level bubble. And we can see this right here. This is the 10-year sovereign yields. And not just of one country, the United States, United Kingdom, Germany, Japan, and Canada. And as we can see, they're all up, 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 and up. They're all going up at the exact same time. Yields are going up, currency's going down. So on paper, our assets look really good, but we can see in real time that the yield's up and the currency down. And at the same time as that's happening, as the governments are running out of money, we can see, unfortunately, for a lot of people, the savings rates, the United States personal saving rates has been plunging to new record lows at 2.6% savings rate right now. So there's not a lot of cushion at the consumer level at the same time. And this now starts to make more sense when I tell you again that gold has overtaken US Treasuries as the top reserve asset. Now, if we look back to some of the smartest investors in the game, to understand this specifically, what we're trying to understand, because it's a sovereign debt crisis, we want to understand what that means, why it's there, and what it means, what we should do about it. So if it's a sovereign debt crisis, we want to look to somebody who's an expert in sovereign debt. Bill Gross, he's known as the bond king. So if there's anybody that knows anything about this, it's Bill Gross. And he says right here, quote, hegemonic decay and worries over future government liabilities are a major cause. So the cause of this problem is the worries. The cause is the worries over what? The liabilities, the future of the government because of the liabilities they have. It's too many. The debt's too high. You can't pay it back. You're stuck. Inflation, all these things. And that is the problem that we have right now. And that's all showing you that it's at that fourth level, the sovereign level. Okay, so what does that mean? Just tell me, Mark. Just shut up and just tell me what the next crash looks like. Okay, here's what the next crash looks like. You ready? What it means is no S&P 500 going down. You see, in 2000, in 2008, the S&P 500 went down by 60%, as I said earlier, and it took 7 years to get back to all-time highs. This time, it's something different because we don't have that room. We don't have that buffer. So this time, on paper, it looks like you're going up. But in reality, it's crashing right in front of your eyes. As I already showed you, the divergence between the S&P 500 in dollars versus gold. On paper, it looks like it's going up, but the reality is it's crashing. The reality is you are losing purchasing power in real time. Let's just break down, what does a crash even mean? So back to 2008 or 2000. In 2008, my home lost half its value. My retirement account lost half its value. My business suffered. I don't make as much income. And so because of all of that, I can't enjoy the same quality of life I had before. So the crash equals my standard of living drops. The crash equals I eat out less, I go on less vacations, I don't buy whatever I wanted. The crash equals my standard of living went down. So what we're seeing here is a crash not as asset prices plunging, but the outcome is the same. The quality of my life goes down. I can't afford as many of those things that I used to afford. So it's not the S&P 500 going down. That's what everyone's looking at. They're looking at this and not realizing it's happening right over here. So the markets go up, but you feel poor. You are poor. It's a difference of a recession or a deficit. The last 3 times this happened, people found a safe haven in cash. If I could just time the market right, that's why you're watching this video, right? If I could just tell you when you should sell everything and go to cash, then you'd have the chance to, and then I have to tell you when to buy back in. And then if I told you when to buy back in, you could come out ahead, right? Except for what if going to cash is the wrong move? What we can see here, that what you can see here is the U.S. federal surplus as divided by the deficit as a share of GDP. And so you can see here from the year 2000, this is the recession right here, a little bit, 3-4%. 2008, it dropped down to almost 10%. 2020, 15%. And this next crash, wherever it's going to be, there's going to be so much stimulus. But where does it come from? It comes from the printing, it comes from the dollars, it comes from the debasement. So while most people are looking for this in the next crash, what's going to happen is this. The fourth rung, the fourth step of the ladder is just a massive print. The fourth step of the ladder, the cracks that you're worried about happening where you wake up one day and your assets are cut in half, what you're finding out, the reality is that your savings buys you half as much as you thought it would. That's already happening right now. So how do we measure this? We need to think about our assets measured in dollars versus measured in scarce resources. So take your retirement account, take your S&P 500. Sure, measure it in USD, of course, but then see how much it's worth in gold or oil or Bitcoin. Any of your assets that you have, think about them, sure, in dollars, but you have to start looking at another measuring stick if you want to see this crash unfolding and prepare yourself in real time. Okay, now the exit though, right? The 3 previous crashes, 2000, 2008, and 2020, they all got kicked up. They all got buried. They all got papered over. Let's push the dot-com bubble up into the housing bubble. Let's push the housing bubble into the banking system. Let's push the banking system up into the sovereign level. And here we are. But there's no levels over the sovereign level. There's no balance sheets over the sovereign level. So there's nowhere to kick it up to, which is why it now has to be papered over and printed away. That's why this time it's the dollar, not the chart. It's not the stock market, it's the dollar this time. And how we see this, how we learn to move and react off of this is we have to learn to measure with hard assets. If you change your measuring stick, if you change your approach, you can change your life. You can change your trajectory of your life with your assets. Stop looking at the nominal value. Look at the purchasing power instead. You'll see the crash happen in real time. All right, that's what I got. Let me know what you think in the comments down below.
It does feel inevitable. It does feel like it's coming. I think the only question is whether that pace that we get there is linear or exponential.
And to kick us off, I first wanted to start with the question of, there's kind of three different pieces here. There's the asset manager, there's the investment bank, there's the custody provider. And for the past, I don't know how many years, I think ever since I've been in Bitcoin, people have been saying the institutions are coming, the institutions are coming. And it feels like the three of you represent the institutional stack of Bitcoin. So my first question would be, what are the institutions waiting on at this point in time in order to enter our market and our industry?
I'll go first. So I'm Chen. I'm the Chief Revenue Officer at BitGo. We are one of the world's largest infra companies for everything digital assets related. Been with the company for about 6.5 years, so seeing a lot. In terms of answering your question, I think it hinges a lot on the passing of Clarity. Clarity Act needs to go through. We have midterms coming up in November. Who knows what's going to happen after November? So we have only a few months between now and then before Congress goes into recess, and that thing needs to be passed. We are obviously in conversations with many, many banks all around the world here in the US and most areas around the world. And here in the US specifically, there's a number of banks that has a bunch of folks queued up. They have a plan ready to go, do a lot of tokenization work on chain. It hinges on Clarity. Around the world, what's interesting is the regulators, especially in the larger tier 1 countries, they look up to the US for guidance. Whatever we do here in the US will get propagated around the world. And if we're able to get Clarity through before the midterms, it's going to unlock a lot of business around the world as well. The last thing I have to say is Brian Armstrong, man, like it was going to go through a couple months back. It's all public information. And the guy and his army of lobbyists in Washington, D.C. did not like the couple of lines that they had in that version of the act and pulled the strings and pulled it off. So I'm very disappointed at what happened a few months back. Hopefully we can regroup and get this thing through as soon as possible.
So maybe I'll jump in here. Definitely agree with those comments. I would say from our side in investment banking and bringing new product to market, new issue, it's certainly supply. Like we need more supply. We need more people in the good parts of the environment being innovative and hitting the scale that's required for those institutions to be able to buy into that, both on the common equity side as well as digital credit. The easiest way to play that, if you didn't have scale previously, were converts. And we've seen a lot of people do that, including yourselves, right? But I think that the superior product is certainly digital credit and the perpetual preferred product because it's better asset liability matching. It just has the carry trade that's affiliated with it. It makes sense, right? And it's defensible in terms of your balance sheet over time. There's a lot of debate about that right now, and certainly strategy, having a mixed balance sheet is clouding the dialogue around that specific situation. I would say if you think about, okay, well, what's holding institutions back besides availability of investable issuers, right? Which is a real, there's not enough, right? Strategy, we did 5 prefs in 1 year effectively for them. And a lot of institutions got excited about it. Institutions were there and looked at the first one, maybe turned it down, came into the second one because it was so successful. And we kind of built on that success over time leading up to Stretch. There's still fundamental constraints, though, that exist, like lack of ratings. Lack of ratings takes a ton of institutions off the table. People talk about like huge pockets of capital in insurance and asset managers. Well, they're still antiquated with respect to how they look at their investment thresholds. And if you're, you can be put into buckets that mean love it, understand it, but can't do it because you don't have a rating. And we tried to work with Saylor and team and everyone else to break down that wall back in 2005, but it was just not possible. So I think there's some structural constraints that still exist within these asset managers, both in terms of accepting Bitcoin as an asset class, as true collateral. There are things like ratings and other areas where we're working hard. The regulators, that's the one thing that's moved in our favor, absolutely. So that's been extremely helpful.
Great comments. I would just add, and I think it's really interesting that we got grouped by the first letter of our company names, because I actually think that introduces like a nice little mix of perspectives to the dialogue. But obviously, BlackRock's a large asset manager. We manage $0 of digital assets for clients as recently as 2-3 years ago, and now we manage 130. Maybe it's lower. Got to check the screens. Right, but the largest product that we have is, of course, the iShares Bitcoin Trust IBIT, which was launched in early 2024. When it was launched, the rough demand was roughly 80% retail and 20% institutional. And over time, if you think about it coming to today, it's become roughly 50-50. So I would say the institutional adoption has actually been increasing. It's great progress. Obviously, we're in the early top of the first inning. There's a lot more work to do. And some of that is a combination of regulatory clarity as well as infrastructure build out. And they're kind of hand in hand, right? To echo Chen's comments, I think more regulatory clarity is going to be what drives the progress from linear to exponential. Even with a delay to that, which would not be good, I think the adoption rate and the growth continues, just at a more linear-like rate. Because a lot of things need to be built in terms of custody, in terms of wallets, right? A lot of people use IBIT because the ETF wrapper is actually easier and more familiar and more plug and play. But all the folks that we speak with in the ecosystem, whether they're crypto native or TradFi, are increasingly building for this future. So it does feel inevitable. It does feel like it's coming. I think the only question is whether that pace that we get there is linear or exponential.
So I want to start with the first question for you, Will. You just launched a new ETF. Congratulations on that. There is some level of competition between, let's say, the role that Treasury companies and DATs play in the capital markets ecosystem, and whether options chains play, and et cetera, and the products that you are launching. How do you all think about the interplay between launching new wrappers and competing with the Treasury companies that are out there in the ecosystem versus working cooperatively with them?
Yeah, absolutely. Thank you for bringing that up. So we launched our BitA ETF, which is a Bitcoin covered rights option ETF last week. Anything that BlackRock launches, we do because of client feedback. We're a very client-centric, client-led firm. And one of the things that clients have articulated is, I am interested in Bitcoin, but I sure would love some way to generate income, and I would like some sort of downside protection. And we can wrap it into one for me, that would be great, right? So I would say completely different products and completely different lanes than what a lot of the DATs have been issuing. Also, BitA, I think we have seen a lot of success in its first week. We're sitting at $30 million of AUM, right? So if we can ever even get close to some of the other credit products, we'll be very proud of that. But again, I think it's just an evolution in the market structure for Bitcoin, right? From the very early days where it had no derivatives to then obviously the early days of perps, and then cleared options, and then the perps really adopting, and then all the ETPs launching in early 24, and then the options, and now having these other maturing things are just ways where that market structure gets more mature and gives you more options, right, for others to come in and build different types of product. Volatility on Bitcoin used to be habitually above 100% realized, And today it's kind of down to this kind of 40 to 60, hovering around 50% range. And I see that as progress, right? I see that as a sign that the ecosystem is maturing and allowing the traditional institutions to come and say, okay, this is an asset that we can work with and create more products and create more creative ways to give clients what they want.
So I want to come back to that topic in a minute, but Lee, I wanted to talk to you about STRC, and I think that that's like the topic du jour of the moment. You know, you worked with Strategy to help design that product. You know, we had a discussion last night about it. You know, now that we're getting into what I would call the edge cases of the product, like the product in, you know, the non-normal circumstances, how would you conceptualize or think about the key mechanics of that product and what matters to the market? And what would be your advice to Treasury companies, several of whom are here that I know are working on pref products, whether or not they've been announced, on how to navigate the uncertainty of the current moment?
Thanks for the easy question.
Yeah, it's a softball.
Okay, so I've got my own opinions. Listen, I do think it's a groundbreaking product. It is an iPhone moment. I've talked about it before. I know Saylor is passionate about the product, but as with all new products, you just don't know what to expect as the product matures. And that is not a mature product. Let's be totally clear. I mean, it's, you know, maturity in financial markets takes time. And you need to go through these events. You need to be tested. I would tell you that we do stay in very close communication with them and Strive. We also help with SETA. We felt really good coming out of the Iran conflict that both of those securities did exactly what we would hope them to do. They were a safe haven, they were yield, they went to par above the ATMs issuing, et cetera. You know, and the yields made sense, I think, just still given the early nature of the issuers, less so Strategy, obviously. But, you know, I think that Strive is a good example because you can look at the leverage and amplification on a smaller company like that and still see it hold in nicely. That's working. So it was working. What we've seen here is there are other structural factors that are playing into why it's trading down below 80. I mean, look, in the mid 80s, I mean, we IPO'd these things at 80, 85, 90, whatever it might be. So could it go back down to the original IPO price? Of course. I mean, IPOs do that all the time. I mean, we're seeing SpaceX broke, right? So there are factors that could lead you down. But I think, unfortunately, we've hit so many people so quickly had put leverage on the instruments, and or you got retail buying it on margin. And I don't think retail fully understands the product. So we've got some other issues that are forcing us to go below 80, and it's you know, it's unfortunate, but it's a learning experience from my standpoint. And I do think that, you know, we're all hopeful that Michael and his team will come out pretty soon. They'll have an AK on Monday with a very strong message about, you know, confidence. I mean, that this is not a credit problem, and we talked about this last night. This is not a credit problem. And by the way, taking the yield to 15% or 16% also is not going to get it to trade to par. This is just a structural trade-off and test the security. And everyone needs to take a deep breath and sit down, and Michael needs to come up and say, listen, this is not a credit problem. We have a fortress balance sheet, right? Sure, the converts are coming due, but, you know, I'm here to tell you as Barclays, we can refinance those converts tomorrow. I mean, our hedge fund clients that technically priced converts would love to come in at 85 bucks on the stock price right now and restrike a convert. That's not a problem. The put, you know, all that kind of stuff's not an issue. You can refi all the convert debt, and Michael can come out and say all of this. He could choose to do other things too, right? I mean, he's raising cash. You saw in the last 8K last week that he actually sold equity. He could, you know, who knows what he's doing? We'll find out on Monday. He could be selling cash. He could be doing other things, right? And he could raise cash. And they could also, I mean, look, the concept of a buyback is a very common concept in all other areas and products. It's just for perpetual stock, because it's such a novel new product, has not been rolled out. And so, you know, a buyback is also a very logical way to support a security like this. By the way, it's not a bad financial trade to be buying it back at 75 when you issued it 100 and then reissue it 100 3 months from now, right? But I think specifically, I don't think it's buybacks that way as opportunistic and financial engineering. I just think you're supporting a new security that's out there and it's going to experience some bumps in the road. And you need to know as a Treasury, when is it moving in a zone where we could hit a leverage trigger? Don't want to go there. We went there. So I think that we should take this experience and say, this is not a problem. There's structural dynamics at play. And I think the learning experience going forward is, do you have other tools in your toolkit as the issuer, Strive or Strategy or future issuers, that will allow you to structurally support that security in these periods of uncertainty?
If there's one great thing you can count on from the crypto market, is that if you design any product and you draw a line of do not cross this line, guarantee that
we're going to cross it.
Right.
We're going to definitely cross it.
So Chin, I want to ask you in a different direction. Y'all have been custodying Bitcoin for a long time. Y'all are dealing not only with the wrappers of Bitcoin like Blackrock or different ETFs, but you're dealing directly with the corporate treasury teams that are holding Bitcoin directly with you. What has had more success in terms of corporate adoption, going through wrappers or holding it directly? And what's the biggest hurdle you see with getting someone to actually squeeze the trigger and put 2, 3, 5% of their treasury into Bitcoin?
We have a very diverse set of clients. We do work with a lot of DATs. We do work with ETFs, and we do work with a number of OG Bitcoin hodlers. We're talking like 2010, 2011, 2012 folks that have kept Bitcoin with us for a very, very long time. There's also this cohort of people, the wealthiest family offices in a lot of the major countries around the world. They're waking up to this asset class and they're looking at options. I have to say, one of our competitors actually is IBIT. There's a number of folks thinking about, what they can do with the Bitcoin they currently have at BitGo. And to be very frank, we had some customers go the other way, meaning they're taking it out of BitGo, they're moving it over into his product, and it's unfortunately going to Coinbase, I believe, underneath. The thing I want to stress about this entire thing is fundamentally, Bitcoin is a bearer asset. You lose the keys, you're done. And maybe I shouldn't say this on stage, but having Coinbase have, 60, 70, 80% of all the Bitcoin floating around in the traditional financial space, it's frankly dangerous and not responsible. So you should look at other custodians. There's plenty of other custodians floating around, and diversify where all the Bitcoin is currently being held. If Coinbase messes up, we're done. And we cannot have that fundamentally.
We're friends.
A powerful statement. I mean, to BitGo's kudos. I don't know of another custodian that's been around as long as y'all and Coinbase that has the track record y'all have. So, well, I want to kind of end on this question, which is probably the number one question I get as a non-capital markets person. I'm a Bitcoiner, putting on a costume of a suit to go to an institutional finance event. But the everyday Bitcoiner tells me BlackRock, Barclays, maybe less so BitGo, but these are the firms that Bitcoin was created to destroy. We don't want these traditional financial firms entering into the Bitcoin market. They are domesticating Bitcoin. What would be your response to that?
I'll just say a few things, right? I think number one, we repeat this with every opportunity we get, just to set the record straight that we don't own the Bitcoins, right? We are a provider of a wrapper so that folks who, frankly can't even open like OpenAI or adopt any of this new technology can have exposure to something that they have been educated on and are excited to participate in. So we kind of see our role as being able to bring more people into the philosophy, the belief, the asset, the growth of Bitcoin, right? Now, the fact that they're all concentrated into a single wrapper is one question. But again, if you look at the number of holders on IBIT, there's more than 1,300 that report on the 13F, right? And for many of them, they represent thousands of other individual holders. When a retirement or a pension or a foundation holds IBIT, they're holding that exposure on behalf of a lot of people. So we kind of view it as an opportunity to allow more people to come into the ecosystem, and we don't view our role as someone that's kind of trying to centralize what that represents, right? I do think there are certain instances where if you look, for example, at the quantum risk, right, which a lot of people talk about today, there's an educational process that we can be a part of, right? We're not going to be influencing or controlling whatever the outcome is, but there are ways to coordinate and to help other people see how we can kind of come together and solve that problem. So there are ways to work together. I think at the end of the day, we're all on the same team, right? We want to see this asset thrive. We want to see it become more important and more relevant in the world as it has been for the last 15 years. And we're part of that journey.
I have heard some cool stories about Larry Fink and his journey into Bitcoin, and I've been impressed by how y'all have done it so far.
I think we all know that he used to call it pirate money, but I think the mental flexibility to look at the facts and come around is something that we should all applaud and commend.
100%. Lee, what's your take on that question?
Yeah, I'm not going to answer it directly as asked. I'm going to ask it in terms of what Barclays, as an investment bank, is doing in the context of that question. And at our heart, we are trying to continue the mission of Bitcoiners, right, in the corporate sense. We are helping new and existing issuers that want to go acquire Bitcoin have access to the institutional bid and bridge that gap, because there's a language barrier in many cases, okay?
Huge language barrier.
Yeah. And so we're believers and we're on your side. And what we're trying to do is we're trying to crystallize the bid in a way that works for everybody, right? And so that's effectively what we're doing. And I'll just to put it in perspective, because there was a panel a couple before this, and someone was like, well, Stretch is 80% retail and 20% institutional. Actually, no. Every single one of these IPOs is 80% institutional and 20% retail. It's why? Because retail needs the validation, particularly of these new products, but they need the validation of the management team, that we've done the diligence and everything else. And then retail will come over the top, just like it's a SpaceX IPO, right? And smother that instrument and take it to where it needs to go. But the institutions are the starter fluid and the validation factor. So they're super important in that regard, because their due diligence and their structuring and their one-on-ones that we do, we don't just roll the product out to the public. We wall cross Blackrock. We wall cross 10 to 15 of our top accounts, okay? And have very deep conversations around what you want as the issuer. We've already got it all written on paper, like this is what we really want, okay? But we know there's going to be some level of concession. Maybe the cash reserve. That came out of one-on-ones with Strive. Cash reserve was not on the table in the beginning. Didn't want to give it up, not interested. You know what? At the end of the day, it was the right thing for both people. And look at it now. Strategy put the cash reserve in after their Stretch IPO. And it's one of the main factors in supporting that security today. But that came out of the institutional due diligence and the banker and the issuer all coming together in the beginning, and then retail, and then further adoption and success and everything else. And that's pretty much how the model works from our perspective. Yeah.
Chen?
I'll be quick. I mined my first Satoshi December of 2012. I was part of one of the Seattle Bitcoin communities way back when. We met at a coffee shop every weekend to talk about Bitcoin. Those were the good old days. And when I first showed up, I worked at Microsoft. I had a tucked in collar shirt, and all the libertarians in the room were looking at me funny. It's like, who are you? Oh, the big corporate is here. We've come a long way from those days. And I would say you have to pass the institutional hurdle for this to be truly adopted by the world. I would also say, on top of the institutional demand, there is demand from actual governments around the world. We're talking about the US Strategic Bitcoin Reserve. We're talking about basically the El Salvador playbook smeared across as many countries as possible. BitGo, we do a bunch of hardcore technology for securing Bitcoin. We're working with a number of these countries right, as we speak to help them set up what effectively is their own version of a digital Fort Knox. The infrastructure needs to be there, both at the institutional level and at the government level, for us to truly take this to the next level. It's been many, many years since 2009. We have many, many decades to go to get this propagated around the world.
You know, not to answer my own question, but you know, I always take the view that Bitcoin's the same Bitcoin before any of the people up here bought it.
That's right.
It'll be the same Bitcoin tomorrow. But I think Blackrock after buying Bitcoin or Barclays after buying Bitcoin is a little bit different of an organization than they were beforehand. So it's like unleashed capitalism. So anyway, I thank you everyone for being on this panel. Give them a round of applause.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, you know, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
I would say what we're experiencing right now is kind of like a financial earthquake, and this capital structure is designed to withstand and be standing after the earthquake is over.
So I'll start off with a question for Jeff and then open it to the panel. So obviously Strive was really the first issuer to have a cash reserve backing the preferred equity dividends, right? Plus the Bitcoin on the balance sheet and the good faith of the issuer. What were those conversations like? And kind of what intel can you give us from institutions as to what they're looking for in these digital credit products?
Good question. Yeah, we were the first issuer to have a cash reserve. When we were going to market, because we were a small Bitcoin treasury company and we didn't have a 800,000 Bitcoin like Strategy did, we had to have a few more investor protections in place in order to instill confidence in going out to market with the product. So we had the cash reserve, and the idea was the cash reserve is effectively first line of defense for paying the dividend in the future if we're unable to, raise equity capital or generate yield on top of the Bitcoin. So, and that thought process has evolved a little bit as we're managing our balance sheet to understanding that there's volatility in the underlying Bitcoin. We want to generate and create a good credit to the market that there's confidence that we're going to have the ability to pay that dividend into perpetuity. That's the entire concept. So as many have seen, as we have evolved and issued more SATA into the market, we have been growing that cash reserve in lockstep with the growth of the underlying instrument, as we're trying to emphasize to the market that we are here to withstand market shocks and market volatility. I would say what we're experiencing right now is kind of like a financial earthquake. And this capital structure is designed to withstand and be standing after the earthquake is over. So that's kind of how we view it, that cash buffer is the first line of defense. We also hold STRC on our balance sheet as a moderate duration instrument, understanding that we are holding this for a long duration.
Okay, amazing. I really like that perspective, and I think it's really unique that you guys pioneered this sort of duration matched liabilities curve on your own balance sheet. So Tyler, when you're making investment decisions and talking to, institutional allocators, what are they saying to you? Do they value the cash? Do they value the Bitcoin? Do they value the liquidity and the equity? What are they saying they need from a preferred equity issuer to be comfortable in that instrument? And then furthermore, I know recently Strategy made some management decisions around the way they're managing their cash reserve. It was cut in half to pay a convertible dividend or a convertible obligation. And this was credit positive, but it seemed that the market was a little bit wary of that decision, and there's been massive volatility and stretch. What are the things you're hearing about this sort of decision making, and what would you advise a company to do with regards to the cash management?
Well, I got to give hats off to Strive for kind of pioneering this concept. And when we're talking to traditional fixed income investors, they're used to underwriting credit risk based on cash flows. And so I think in a model where you have these digital credit issuers that have a strong cash flow engine, where they're able to pay the dividends from operating income every single month. I think that model is easy to underwrite and understand. When it's purely asset backed or a balance sheet type calculus, what the cash reserve really does is it gives optionality to the issuer and prevents that volatility. And I think that's honestly what we're seeing in the market this week is kind of a liquidity crunch and a crisis of confidence around these products, due in part to the perceived weakness of the cash reserve behind Stretch today. Having used that to buy back the convertibles, which should be in the abstract, without feeling the day-to-day volatility of the market, that should be a very positive thing for Stretch holders. You're retiring a senior liability ahead of the Stretch holders at a discount. That should be a credit positive event, as you mentioned, Dan. But that's a trade-off for less liquidity in the meantime, and that kind of a liquidity crunch is what has spooked the market so much today.
I just want to add on top of that, I think what we've seen is there was some loss of confidence in the underlying instrument, and that resulted in what we saw, a leverage liquidation. And we've been running around New York here the last week, getting an understanding of what's happening in the market, and there was a significant amount of leverage on top of the instrument. Why was there leverage on top of the instrument? Because the creation of these credit instruments established a high yield, high liquidity, stable security, and that bred a landscape for interest in leverage. So as there was weakness in the security and the leverage effectively got liquidated, and there was pressure, additional sell pressure from the leverage that was in the market.
Okay, those are great answers. So Alexander, now to you. I know you've had the benefit now of watching both Strategy and Strive IPO their own digital credit preferred equity instruments, and you've been a large issuer of private credit, right? Private credit in your market. What are your thoughts now, seeing all of this volatility and how these two companies are managing their cash with the creation of a preferred security? What are you thinking about? What decisions are you going to make? How are you viewing the differences in their prospectuses and taking that into account for your own instrument?
Sure. Our objective is to become and consolidate our leadership as a digital credit issuer in Europe. The first step for us has been the non-listed Bitcoin-backed credit products, and our conviction is that the current market is separating the market operators with conviction, with discipline, from market operators that can have doubt or do not understand the structural aspect of the market. The context today is that the screens are red, that the market has been hammered, minus 50%. From a traditional perspective, this is big. From a Bitcoin perspective, this is just volatility one. Bitcoin historically has been going through those minus 70, 80, 60% drawdowns, and Strategy, Strive, Capital B, we are all being built, and Nakamoto, we are all being built for those structures of markets. And when I think it's a good moment to remember why we are here. We are here because Bitcoin has 21 million units. There is an infinite monetary supply, and it's not stopping anytime soon. In fact, when you look in the past, any periods of oil supply shocks or internet bubbles or great financial crises have all been followed by 250 to 500% monetary increases in the next 10 to 15 years. And the result of this is that Bitcoin is growing at 30 to 60% CAGR over periods of 5 to 10 years. And the ability to be financed at 11, 13% is a major arbitrage. And before, when we were in the 2022 bear market, there was no digital credit industry. There was not perpetual digital credit instrument. The ability to align the maturity of the financing instrument with the objective of holding of the asset, the perpetual objective. This is something we have now. Back in 2022 strategy, we're in a point where there was more debt than assets, but now it's 50% overall leverage, even a bit less. And I think we are in a much more robust situation than where we were 2022, and that we will be in a much better position 4 years from now. But it's just the ability to zoom out and to see what the companies are building. And for Capital B, today we've been sometimes called very conservative. We have no fiat debt on the balance sheet with our Bitcoin strategy. And digital credit for us is the biggest opportunity we see. All I see is opportunity in the market, and the Bitcoin convicted investors also see of big opportunities. The first time for a long time that I've seen even traditional finance people interested in Bitcoin come to me and say, oh, I bought Stretch for the first time. Oh, I bought SATA for the first time. Because it's just mispricing of the Bitcoin future.
Okay. Yeah, that's a great perspective. Thank you, Alexander. So my next question for, I think, Jeff, and then opening it up is, obviously last month Strategy inoculated the market. Those are Saylor's words, with a 32 Bitcoin sale. This represented about $2 million of value. Obviously, this was not enough to move the market in any material way, but there was clearly some animal spirits in the price of Bitcoin as they were selling these coins. So what are your thoughts, specifically Tyler and Jeff, around selling Bitcoin to pay dividends at a discount to NAV when it comes to your common equity versus selling common equity at a discount or at a premium? Obviously, there's all sorts of permutations here, but generally, what's your broad sort of principle at Strive, and then for how you value these companies when it comes to selling the assets on the balance sheet to either pay dividends or potentially buy back securities trading at a discount, and versus selling common equity?
Sure. Well, I think that's what the market is waiting to see this week is how the issuers are going to respond to this liquidity crunch, and what measures they can take to intervene in the market, or if they'll just let the market freely price these things. Our team has kind of debated this endlessly in terms of what are the best paths forward for the large issuers, especially. And I think inoculating the market further by selling a couple years worth of dividends and having a really strong cash liquidity position, that's a one-time event where you can say we're in a strong financial position and we don't expect to sell any Bitcoin in the near term. I think that would be an effective thing to help restore confidence. But on the other hand, and I think this is an unpopular opinion, as I've shared it a little bit, but if you look at the reason why Strategy and now Strive chose to finance themselves with preferred equity rather than a typical credit fixed income product, is it gives them the ability as an issuer to have that flexibility in terms of no repayment cliff, and the ability to pause the dividends without triggering a default. And the reason they built those into those products is exactly for this type of scenario, to prevent an issuer from having to become a forced seller of Bitcoin at a point of weakness in the market. And so in my mind, that would actually be kind of the strongest message. I think it would be a very painful one in the short term for the market to digest. But if Saylor came to us on Monday morning and said, we're going to pause the stretch dividend, but everything is going to be fine, and the price of it will float freely, and 3 months later or 2 months later, he turns back on the dividend, he's inoculated the market once again that the design of the product worked as intended and prevented him from becoming a forced seller of Bitcoin at the lows of the year. So I'm really interested to see what path issuers choose here.
I think it would be a bad idea to pause the dividend. I think operating in the credit markets is incredibly important. Trust is what you're selling, and trust that you're going to continue to pay the dividend is the primary thing that I think the market is hanging on here. I mean, there's a significant amount of liquidity behind the balance sheet. It's cash, it's Bitcoin. I think the reality here is that Bitcoin is incredibly liquid. It trades 20 million to sometimes 20 billion to sometimes $60 billion of liquidity a day. And there's significant optionality when looking at the balance sheet as a whole. To answer your question specifically, this is a multivariate calculus that is constantly being monitored behind the scenes by both Issuer Strategy and Strive. And we're looking at not just the Bitcoin and the common, but the Bitcoin and the common and the credit instrument, and the relativity of all three of them, and a combined transaction of looking at a quarter by quarter basis or a long-term basis. Again, with the goal here being that we are long-term net accumulators of the underlying Bitcoin. We want to express a very long and amplified position on the underlying Bitcoin. And I think that's what investors both on the common stock expect, and it's what investors on the credit instrument also expect. Obviously, we have the ability to sell the Bitcoin if we needed to pay the dividend obligation. For us at Strive, our daily dividend obligation is around $400,000. Our common stock trades over the last 30 days, it's averaged about $60 million a day. And for a company like Strategy, their daily obligation is around $7 million. Just yesterday, the common stock traded $4 billion. So that relativity is very small. And I think that capital making decision is a complex one, and it needs to be thought about on a long-term basis, quarterly and an annual basis.
The other thing I'd really like to see the issuers maybe reconsider here, and I made this point on a podcast this week, is but with the design of these products, with the peg that issuers are trying to enforce at $100, with the constant ATM sell pressure, you're creating this convexity that only exists to the downside with this implicit backstop at $100. And so, in between dividend periods, which Strive has thankfully solved, there's almost like a risk-free short trade that you could put on in the market where the price isn't going to run away from you. And so if the issuers chose to broaden those trading bands or those trading ranges, or be less aggressive on the issuance schedule via the ATM, and you let these products trade up in times of high demand, and I think we would have, without an ATM program active, we would have seen Stretch and SATA both trading significantly above the $100 par value over the last couple months. If you have that natural market force where you enforce a wider band or you let there be some volatility both to the upside and the downside rather than only to the downside, I think that would change the perception of these products and remove some of the attack surface, if you will, for people who want to bet against them.
Well said. I think that's an important consideration. We have just 5 minutes left, so I want to get into kind of what I believe to be the next chapter in digital credit, and I'll like to first hear from Alexander, and then we'll do kind of a speed round across the panel. But Jeff, you used to work in reinsurance, and we talk a lot on True North about structuring these digital credit products, right? How do you structure these into packages, into funds that are attractive to institutional allocators, to fixed income allocators? Even just as simple as preferred equity is not credit, and so we're unable to make Stretch and SATA fit into the credit bucket for an allocator, right? That's a very baseline problem the industry has right now. So what are your thoughts moving forward about structure, and how can we bring that to these types of products. First, you, Alexander, maybe give us a quick, brief insight into the private version which you've created.
Yeah, I think at the end of the day, a Bitcoin treasury company is in the business of consistency. And I think the turbulence we are seeing in the market is just because of the discovery of what the market values the most and what the market expects from the companies. One key thing is definitely the consistency. Another thing is it seems like a 2-year cash reserves is very appreciated by the market. And this is just because typical bear markets last about 1.5 years to 2 years. That's quite simple. The risk is very simple. It's Bitcoin going to zero or Bitcoin going minus 80% for 10 years. And this is the risk. And if you are not able to see and price and appreciate that risk, then this will be definitely too risky. But this is the risk. You can allocate the percentage, but then it comes to the structuration. And the structuration from a private market lens, what we've done is Bitcoin-denominated convertible notes over 5 years, 0% coupon, no liquidation risk. And so if Bitcoin goes to zero, we give back Bitcoin at zero. And if Bitcoin goes up, there is a conversion and it's a major call option. On the digital credit side, I think the key aspects is that the market is realizing that, yes, it's about the ability to raise rates, but it's also about the ability to have a structure overall. And I think Strive has been extremely good at that, with the preferred being at the top of the balance sheet structure and effectively be the highest senior claim on the company. And these characteristics in terms of the structure, I think, will be more and more key for the appreciation of the credit risk.
Absolutely. Tyler?
Yeah, in terms of structure, this is something our team at UTXO Management has been working a lot on over the past couple months. And we see, these digital credit instruments as being really a versatile building blocks in a portfolio to be able to build new securities around. And one of those things that you mentioned, Dan, is being able to transform these from perpetual preferred equities into a true credit allocators box, which means having a duration on them, which means having a covered loss ratio. And one of the things we announced at Bitcoin Vegas a couple months ago is a new fund that we are soon launching that takes like a CLO or CDO structure for these digital credit instruments, where we can borrow some of Wall Street's playbook in terms of tranching out the risk return into different levels, where there's senior, junior, mezzanine, where we can build different risk return profiles and be able to remove some of the volatility from these products in a way that maybe an issuer doesn't have the tools to today, to make them more suitable for new types of investors. And so I think we'll see a lot of experimentation on that front going forward, and a lot of lessons learned from the volatility the space is going through this week. And I'm optimistic for the solutions we can come out of this with.
Get it done. So there's a ton of opportunity here. Strive, we're a structured finance company. You take Bitcoin at perpetual. We've created a perpetual preferred equity and our common equity. Both are perpetuals. You could take that perpetual preferred equity and you could tranche it again into a term instrument, a senior term instrument, and put that into a special purpose vehicle that has, as Tyler mentioned, different risk return metrics. Now, this solves a couple problems. The main things it solves is creating a senior term instrument that could potentially get rated because it's less Bitcoin risk and it's now become balance sheet risk. A rating agency can get more comfortable with that. And that gives you access to insurance companies, pension funds, and anybody that needs a rating on an instrument. But that also solves a leverage element, because right now there's a leverage duration mismatch on digital credit, and we've seen it this week. When you have short-term leverage on a margin on a digital credit instrument, if there's volatility, you have to liquidate. Now, if we can create a structural leverage equity style component that actually solves the structural leverage duration match of the instruments too.
Awesome. Well, our time's up, guys. This has been an awesome conversation. Thank you, everyone, for listening, and talk soon.
with Bitwise in this ecosystem, how do you think about who you're competing with, right? We're going to see traditional Wall Street firms come in and start ETFs, but also who you're working with, right? Who are your counterparties and kind of the partnerships that you see developing?
Yeah. Our view is that in every area of the market on a competitive side, there is a specialist that people turn to because they trust, right? If you're looking at private equity, you might go to Blackstone or KKR. If you're looking at debt, you might go to Apollo. If you're looking at liquid bonds, you might go to Blackrock or PIMCO. People like specialists because they have specialist expertise. Our goal, even though we compete with Blackrock and we compete with Fidelity, is to be the leading specialist crypto asset manager in the world. There are obviously a few firms that we're competing with for that title, but that is our goal. And we think we bring unique benefits, whether you're a crypto native. I note that our Bitcoin ETF donates 10% of its gross profits to open source developers for Bitcoin. That's fairly unique. Or you're a financial advisor. We're like the only firm with a 25-person sales team that's out there meeting with financial advisors in bull markets or bear markets. If Bitcoin is down, we don't shift to talking about private loans or AI stocks. We're always on crypto. So our view is that specialist crypto asset manager space is really large, and we hope to fill that space. On the supplier side, look, we work with everyone. And one thing that is true is we're always trying to level up the quality of our counterparties and always trying to diversify and work across a wider and wider variety of counterparties. I've been at Bitwise long enough to remember the days where we couldn't even have a custodian for some of the assets in our funds, and we had to self-custody those. And then it was like a minor custodian like Kingdom Trust, which was, I forget, located somewhere in the American Southeast. And now you can custody Bitcoin with Coinbase, with Fidelity, Bank of New York, with name your person. We're always trying to level up in that direction. So we'll work with everyone. We want a diverse ecosystem. We love firms that are crypto native, and we work with them when we can. And I think it's just going to get better from an infrastructure perspective.
You mentioned Bitwise is invested in building out a sales team. I think that's really critical to have really, human service and education on the front lines, because there's a huge surface area, right, of different advisors that they have a wide mandate. They don't have like the crypto or Bitcoin specialty, and that's what y'all bring to the table.
100%. Yeah, I used to say that the future of Bitcoin is being built over lunch at Morton's Steakhouse, which is true. Our team does 15,000 meetings a year with financial advisors. So 15,000 touch points, educating them about Bitcoin and the broader crypto market. Someone needs to do that work. If you think about your own personal journey into Bitcoin, I know for some people, they read the white paper, instantly got it, and fully understood but most people are not that. I was not that smart. It's not like the first time I encountered it. I mentioned I left the meeting with Spencer and bought coffee instead of buying Bitcoin. It takes a while. It takes multiple touch points. And so the value of our sales team is we can provide those touch points to people who are managing trillions of dollars of money. And that doesn't mean the assets all come in at once, but it does mean hopefully that there's this rising tide of people who understand what Bitcoin is and the role it can play in the world and in their portfolios.
And that y'all are doing this work even in the bear markets, right? Where I think that investor interest kind of naturally wanes and they're looking at AI or whatever it is, but y'all keep beating the drum because that's the best time to invest during the bear market.
It's the best time to invest. And selfishly, from a Bitwise perspective, it's where we gain ground. We often talk about the way you win in a bike race is when it's raining. When it's dry, everyone can go fast. Yeah. So while we're talking about Bitcoin in a bear market, I'm not sure people with broader businesses across all assets are doing that. And so we really found that we gained substantial ground in 2018 when we were out there talking with people. I still get thank you notes from people I spoke with in 2018 who are up, 25x on their position. In 2022, the same thing. And indeed, this winter, I think we're going to see the same thing. So that's what comes with being a specialist. This is all we do every day. We wake up. It's crypto only. from 6 a.m. until we go to sleep.
So if we think about the most recent bull market, it seems like the catalysts were the launch of the ETFs and then the Trump election. And is Bitcoin down just due to a lack of catalysts, or is there something kind of brewing underwater?
Yeah, I think the Bitcoin is down because the 4-year cycle has an emotional resonance, and OG investors, people who've held Bitcoin for years, sold some, not all of their Bitcoin starting in the middle of 2025. And that's an annoying answer because it's inherently reflexive. They were afraid of Bitcoin going down, so they sold some Bitcoin. But that's what you see in the underlying data, right? Like $100 billion sold out of long-term wallets and whales. But you have to give them a little bit of credit. These are people who probably bought Bitcoin when it was $10 or $100 and are sitting on really substantial gains. And they've lived through crypto winters before, and they know that the market can pull back 75%. And if you were sitting on like a $10 million gain or $100 million gain, and you had seen twice before this freight train come down the track and destroy 75% of your wealth, are you sure you wouldn't sell 10%? I don't know. I mean, I love Bitcoin, and I didn't sell any, but I don't have $100 million of Bitcoin personally. I don't fault them for wanting to step outside a little bit. It doesn't mean they're gone forever. We talk to these people. It doesn't mean they sold their whole stack. It doesn't mean they're panicked about quantum and they're getting out of Bitcoin and buying Bitcoin Cash or something. It means that they're humans and they were sitting on gains, and so they sold a little. And that's really what drove the pullback. Look, I think it's basically over. I think we're merging into spring, and I think we'll go to massive new all-time highs. I'm optimistic what gold says about the store of value market, and I think we'll get our share over time. But I think that was it. These people are human. 4-year cycle still has a resonance with them, and so they took some off the top, and that was enough to send the price down.
Michael, since your May 5th earnings call comments, odds that Strategy sells some Bitcoin by year end have spiked from around 30% to 84%, and odds of a sell by June 30th are at 66%. Critics say stretched dividends and a narrowed MNAV premium are forcing your hand. How wrong is the market?
I think we enjoy keeping everybody guessing. It definitely makes X a lot more interesting. Our view is business as usual here. We're kind of matter of fact about this. The goal of the company is to drive Bitcoin per share and to increase its Bitcoin and increase the enterprise value continuously forever. We'll make decisions about how we fund our liabilities week by week, day by day. Sometimes we make them minute by minute, to tell you the truth. We set algorithms where we're looking at what is most long-term advantageous to the company. Are we managing our credit risk? Are we creating Bitcoin per share? And are we best off to pay a liability with cash, or to pay a liability by issuing equity, or to pay a liability by issuing credit, or to pay a liability by selling Bitcoin? We've done a lot of multivariate models, and in all the models, what we find over the long term is that by far the best thing for the company is to engage in a mixture of those 4 instruments. Any model that we put together that's limited only to equity or only to credit or only to Bitcoin always underperforms. So ultimately, the way to think of it is 7 years out, we would like to have maximized our Bitcoin per share. And what is it that we should be doing now that's going to maximize and optimize the company's performance so that we've maxed out Bitcoin per share 7 years from now? And I think it's not unlikely that we'll sell some Bitcoin between now and the end of the year. I don't know how much. We still consider these things. But it's also likely that we'll sell a mixture of equity, a mixture of credit. We'll manage our USD, our cash positions. And we do it in a very thoughtful, programmatic fashion where we're running our multivariate models, and we're literally running them. We're making trading decisions. To say every minute might be an understatement. We oftentimes make trading decisions every second, and we'll continue to do that.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
All right. Good morning, everybody. Hope everyone's doing well. Thank you so much for joining us today. My name is Brian Dixon. I'm the CEO of Off the Chain Capital. Grateful to be joined today by Johnny, Yves, and Alexandre. I'd like to first just kind of go down the list and have you guys do a quick introduction of yourself. Let's start at the end with you, Alexandre.
Hello, everyone. I am Alexandre Lézé, Board Director of Bitcoin Strategy at Capital B, Europe's first Bitcoin treasury company.
Hi, I'm Yves Chouvatier. I'm the founder and the president of Tobam. We launched the first open-ended fund invested in Bitcoin in 2017, and now we are very active in the field of treasury companies.
Hi everyone, I'm Johnny Avadia. I run one of the largest fiat to crypto market makers in Africa. Crypto is becoming the default cross-border payment channel of Africa, and we're glad to be at the front of that.
And again, my name is Brian, so I run Off the Chain Capital. We are a deep discount, Warren Buffett, Benjamin Graham style of value investor in the blockchain space. We've always leaned very Bitcoin heavy in what we do. We have a lot of exposure to discounted Bitcoin through bankruptcy proceedings or big exposure to Bitcoin treasury businesses around the world as well. So the first thing that I want to discuss today from each of your perspective is the market for investing in Bitcoin and raising in Bitcoin denominated has changed significantly over the last 12 to 15 months, especially with the Bitcoin treasury companies. So from your perspective, what are you actually seeing today in terms of how Bitcoin is raised and deployed effectively? Let's start with you.
Yeah, sure. So one of the biggest changes we're seeing is that larger institutions, so we're very big in Africa, and we're seeing that African banks, telecommunications, fintechs, the companies that essentially run the African financial plumbing are starting to be a lot more interested in crypto, Bitcoin and stable coins. They're starting to make investments. They're teams who weren't interested in crypto before, they now have leads, crypto leads, Bitcoin leads, which is super exciting to see.
Yves?
Okay, I would tell you about two earthquakes, one that happened in 1694 and one in 2020. In 1694, a group of businessmen met in London and they decided to create a company that would raise capital in order to buy gold. And they called this company the Bank of England. And in 2020, a guy called Michael Saylor has decided to pivot his company. And he's doing absolutely the same job as the Bank of England back then, which consists into raising capital in order to buy the next cornerstone of trust, Bitcoin. I really believe that what has changed in the Bitcoin market nowadays, it is really the return of reserve institutions. What's very important, I think, it is to understand that Bitcoin is a reserve asset. This is something that was really introduced back then by Hal Finney in December 2010. He told us Bitcoin fate is to be a reserve asset. And I think corporations are being created across the world. Corporations with balance sheet is very different from the other corporations. On their asset side, they want to have the most boring asset you can imagine. There's nothing more boring than owning a cave full of gold. And there is nothing more boring than owning a ledger full of Bitcoin. Because it is the simplest and most boring asset on the asset side. And it is on the liability side that they want to be very inventive. And what we've seen recently with the rise of those, reserve corporation and with the invention of this incredible asset, which is a liability for them, which is perpetuals, I think this is going to completely transform the way we look at savings and the way we look at money across the world.
I think we are witnessing the digital transformation of capital. The first phase was Bitcoin-backed equity with a strategy in 2020 and digital equity. And then strategy innovated with convertible notes. And that was the rise of Bitcoin-backed amplified equity. And now we are in the third wave, and which is actually the biggest one, of Bitcoin-backed credit in the form of digital credit with Bitcoin-backed, Bitcoin-denominated, Bitcoin-listed credit instruments that can provide different forms of exposure to investors that are interested in Bitcoin but don't want necessarily the full volatility. And this has completely changed the market structure this year with STRC, the product of strategy, that is buying 5x more Bitcoin than what is there in the market in natural supply by the miners. And that is completely changing the structure of the market with 10,000, 30,000 Bitcoin purchase per week in what is a consolidation market yet. And on the top of that, you have also the systemic banks that are adopting Bitcoin at scale in France, for example, which is not the fastest moving. Sometimes in banking, you have one systemic bank that now offers access to Bitcoin for retail investors, BPCE, and you have Amundi that just launched a Bitcoin ETP. That's the largest asset manager in Europe. And in the US, you have Charles Schwab, and you have, of course, the Blackrocks and the Vanguard and so on. And that movement of institutionalization combined with the rise and the scale of digital credit, which is the fastest growing product in history after IBIT. IBIT reached $5 billion after 2 months, and STRC is already there after 7 months. And even the iPhone didn't do that at the time. So this is really fast growing. This is transforming the capital markets. It's repricing how risk is appreciated, because the STRC, the digital credit, is able to provide a 2-digit performance with lower than 2% volatility. So it's lower volatility than the S&P 500 already today, and higher or equal returns with most of it. So it's really redefining what means risk and what means an investment for both an equity investor and a credit investor.
That's really important. I think another way to think about what you noted on the digital credit side is if we look at a product like Stretch, what I believe is potentially occurring right now is we're seeing 5 to 10 years of future demand to Bitcoin being sucked in today because of that product. Because you're having these big private credit investors and other kind of investors that really don't per se care about the exposure to Bitcoin, but they care about the 11.5% yield. And so you're sucking in this group of people that otherwise may have not ever paid attention to the asset class for many, many years into the future until they're almost forced into it because they see the yield. And I always like to say that everybody has their own entry point into the digital asset space. And I think Stretch is a brand new entry point for a huge group of institutional investors. Years ago, like during 2022 as an example, there was a lot of people that were trading NFTs. And then when they realized that NFTs, a lot of them didn't have a ton of value, they were trying to sell them off to put their money in Bitcoin. So that was a different entry point into Bitcoin, right? Like everybody makes their way back to Bitcoin in one way or another. And I think this digital credit product is a way we're seeing these massive institutional investors suck that forward. So in that same vein, I know each of you have built, significant opportunities, whether it's through public equities via Bitcoin, through funds, through over-the-counter market making. What is it that you found that's been most effective for deploying meaningful amounts of capital into Bitcoin? And what are some strategies that you guys have executed that you think have helped you do well with that? Why don't we start with you, Yves, then we'll do Alexandria, then we'll come back to Johnny.
Okay, so I'm going to give you a specific point of view. I think it's something which is very specific by country and by currency zone. The Eurozone is really struggling to enter this new era of currencies. And I think that what really is changing the game is the fact that you have now securities that are able to allow you to sell Bitcoin exposures to retail clients. Now, Europe really struggled with Bitcoin. We are way behind the United States, and the fact that there is now securitization of instruments that are able to provide you with an indirect access to Bitcoin. This is a way for Europe, unfortunately, to get an access to Bitcoin.
Well, Capital B over in Europe has raised half of its capital in equity and half of it in digital credit in a non-listed format with the Bitcoin-denominated notes. $178 million issued to date. And so Capital B is effectively the most amplified Bitcoin treasury company, but with zero fiat leverage to date. And that's 40% leverage, but with liabilities that are in Bitcoin and over 5 years. So no fiat leverage to date. And that opens the opportunity as well for Capital B to enter potentially in the future listed perpetual digital credit markets. And that's an avenue for growth that is quite significant and is the most in demand actually in the market. And I would say that also the digital credit capacity quality of the issuer is quite significantly increased by its capacity to raise different forms of capital and innovate on the liability side, as Yves mentioned. And Capital B is uniquely positioned to capture both equity markets and launch new innovations such as the call option instruments that we have launched, in fact, in partnership with Tobam and with UTXO management, that allow the company to maximize the potential of convexity for the investor and to help the company accumulate Bitcoin with no share issuance at the start by collecting the premium and by having a mechanism of MNAV basis that allows the company to increase Bitcoin per share over time as the warrants, the call options can get exercised. So Capital B has been innovating with the Bitcoin convertible notes last year, has been innovating with the call option instruments this year with its strategic investor partners. And of course, we are positioned to innovate further in the perpetual digital credit instruments. that we see as the biggest opportunity this year and the following one, and over that decade, to give exposure to Bitcoin in a way that's possible to integrate within traditional brokerage accounts for investors that are not able to withstand the volatility of Bitcoin but want double-digit potential performance.
I think that the on-ramps and access to Bitcoin are increasing every day. The NFT point that you made, Brian, is very relevant. And what we're seeing is most of our clients are using crypto and Bitcoin for cross-border payments, not necessarily for Bitcoin itself, but it's a great entry point. People who need to move $10 million from Nigeria to, let's say, Europe to pay an invoice for cars aren't necessarily looking to buy Bitcoin, but they need Bitcoin. Bitcoin solves a real problem for them. Bitcoin and stablecoin solve a real problem for them. And a lot of those clients are becoming Bitcoin holders, Bitcoin bulls. They're seeing the real impact that it has on the economy, the real impact it has on their business. Similarly, you see the same kind of thing with Stretch. It's not necessarily a Bitcoin product, the same way that cross-border payments isn't necessarily a Bitcoin product, but it's an access point. It's using Bitcoin and the value Bitcoin brings, one in cross-border payments, two in a stable, secure underlying asset, to offer people real utility in their day-to-day lives, in their day-to-day business, and opens their eyes to the value behind Bitcoin and therefore creates new participants in the market, which is great. And new things like this are coming online every day. Cross-border payments has been there for a while, but now it's becoming more institutional, which is super exciting to see.
So some other things we're seeing in terms of an institutional on-ramps to get exposure to Bitcoin, there's three primary ones today. You have direct Bitcoin exposure, you have ETF exposure, and now we have equity exposure and digital credit exposure as well. Some of these Bitcoin treasury companies historically have traded at large premiums. A lot of them today are basically trading at their net asset value or they're trading at discounts. If you're advising an institutional allocator to look at this space between direct Bitcoin exposure, Bitcoin treasury company exposure, or ETF exposure, what would be your thought process for advising which product and why? What structure makes sense? Let's start with you, John.
I think it very much depends on the client and their use case. I think if a more traditional company getting their first Bitcoin exposure, an ETF makes sense. It's simple. There's no leverage, not too much to understand. If you fundamentally are bullish on Bitcoin, you don't need to understand custody, and it really gets you that exposure in the simplest, cleanest way. I think if you're a little bit more bullish, have a little bit of deeper understanding, and you want leverage, that's when things like MicroStrategy equity becomes more interesting. But you really need to know what you're doing if you start investing in that space. And then finally, as you mentioned before, something like Stretch. If you really just kind of want to get your toes wet, you're looking for a clean return, something that makes sense. So ultimately, it depends on the client.
Yves?
On my side, I'm absolutely convinced that the best way to participate and to get an exposure to the future momentum of Bitcoin is Bitcoin treasury companies. I think there is one way to look at it, which is, in my mind, really appealing. It's the MNAV. You know, there is a company called Hermès in France. It's a luxury company. And if you look at the NAV, at the net asset value of Hermès, it's 20 billion. The market cap of Hermès is 200 billions. What is the difference between those 20 and the 200? It is only speculation. It's about speculation. People speculate that the future earnings of Hermès made Hermès worth much more than its NAV. It is the same for a treasury company. I am absolutely sure that you have not seen yet the all-time high of MNAVs. I'm absolutely convinced that those companies will trade at several multiples of their NAVs. Again, remember the case of the Bank of England. Remember the case of the Banque de France. For about 50 years, we have been missing reserve institutions. The Federal Reserve is not a reserve anymore. The Banque de France is not a reserve. The ECB is not a reserve. It's companies that are full of government bonds, of things that are worth, in fact, almost nothing. We have something major happening in capital market. It is the return of reserve companies. And I think it will make a lot of sense to own either directly their stocks or more sophisticated products that will give you access to the momentum that we will see in Bitcoin in the coming years.
As you mentioned, there are three main ways. The first one is if you want to trust nobody but yourself and be your own bank, that's Bitcoin direct exposure. And nobody can replace that if you want to access individual sovereignty and pure financial freedom. But it comes with the risks and responsibility of a bank. And for 99% of the population, the choice of preference will likely be more security in the form of an ETF, but that's pure Bitcoin exposure, less the management fees. And if you are looking into financial outperformance, then the Bitcoin Treasury company, the ones that are focused on the constant, systematic, structured Bitcoin accumulation as the reserve asset and are extremely conservative on that part and are innovative on that liability side, the credit side, and have a path to become the largest, most effective digital credit issuer in their country, in their region, in their specific specialty, then those companies are structured to outperform Bitcoin over time. And if you zoom out, you see that Bitcoin is on its way towards the market capitalization of gold. That's in about 10 years a potential of $2 million Bitcoin or more. And gold itself is growing. And Bitcoin treasury companies are able to increase their Bitcoin per share at a rate that's quite significant when you compound that every year. Even Strategy with several hundred thousands of Bitcoin and now close to 1 million Bitcoin is able to generate levels of BTC yield that compounded over time can generate 2x, 3x, or more, as Yves said, in terms of the potential multiples and the monetization of what those reserve companies can become. Because there is a point as well when those companies, when they become big enough, become monetized in the market. And if Bitcoin goes towards 2 million Bitcoin or $3 million a Bitcoin, Strategy is going to be $1 trillion or more. And you are going to create the magnificent 7 or 8 now with Strategy. And Strategy is going to become likely the most valuable company in the US and the world. And Bitcoin treasury companies that are able to effectively replicate that strategy, that playbook, and become the respective leaders in their country and their regions, as governments are redirecting a lot of investments and retirement account to those local investments, you can see that potential trajectory of those companies reaching levels that we have not seen before.
And I'll end on one note. So from an institutional landscape, one of the things that I often advise when I'm talking to larger institutional investors around the world about getting exposure is one of the best value opportunities that I see in the markets today is when you go into different markets around the world and you see Bitcoin treasury companies that are the really solid, sophisticated ones that are executing effectively, have good management teams, and they're trading at a discount. It's very similar to GBTC a couple years ago, the Grayscale Bitcoin Trust, when that was selling at a 50% discount. And we knew ultimately the SEC would eventually approve a Bitcoin ETF, and that 50% discount would go back to the net asset value. I think that's what we're going to see in some of the sophisticated Bitcoin treasury companies as well. So the ones that are selling at 20, 30, 40, 50, 60% discount to their Bitcoin balance, wrapping in operating businesses as well, I think there's tremendous upside opportunity there from an institutional lens also. So I want to thank our panelists. Thank you so much. And thanks everybody for joining us today. I really appreciate it.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Take a look at this crowd. How's everybody doing today? Can I get some energy here? Amazing, amazing. I'm Alan Helm, Director of Business Development here at Bitcoin for Corporations. We are BTC Inc.'s advisory and advocacy platform, and we work with a lot of the corporate treasuries that have Bitcoin on the balance sheet. Today, we're here to talk about, a very interesting topic, two of my favorite topics, which is the convergence of AI and Bitcoin. And we have a very great panel here today across the corporate side, the investor side. Phenomenal thought leader down there at the end. Gentlemen, please introduce yourselves. Patrick, why don't we start with you?
Sure. So my name is Patrick Lowry. I'm the CEO of Samara Asset Group. We are a proud sponsor of Bitcoin for Corporations. We're one of the founding members, I believe, of your group. We are a publicly listed company in Germany, largely a fund-to-fund investment group, but what we're probably most famous for is we use Bitcoin as our primary treasury reserve asset.
My name is Curtis Perlowitz. I'm a sales and marketing director at a company called Giga Inc. We are a tech-forward, AI-enabled manufacturing company, and our core business is disrupting a $115 billion a year industry, which is manufacturing of fenestration products, so windows, doors, unitized curtain wall, things for mid-rise and high-rise buildings. And where Bitcoin comes into play for us is that since 2021, we've been stacking Bitcoin as a treasury asset on our balance sheet.
Yeah, I'm Mark Moss, and I've been working with Bitcoin educational content for about 8 or 9 years at this point. I've been in the Bitcoin venture capital space for about 6, 7 years. I'm a partner at the Bitcoin Opportunity Fund, so we're actively deploying capital, trying to build this future world that we want through Bitcoin companies. I've been working with a lot of private Bitcoin companies, Bitcoin treasury companies, and we spend a lot of time thinking about how AI and Bitcoin are coming together to sort of build that new breed of company.
Mark, so let's start with you. I really want to kind of set the stage here for the crowd. Having you mentioned that you've worked with companies like Matador and other treasury companies, but you've really been, through your show, Market Disruptors, I've been talking about the 250-year market cycle thesis, Bitcoin, and now over the course of really the last 12 months, I think you're one of the first voices to start talking about AI and the convergence there. So maybe, given the amount of time that we have, if you can give the quick 5-minute TLDR of how this all kind of integrates together, I think that would be great for the crowd.
Yeah, we'll give a super high-level view. So I do talk a lot about cycles, and there's one cycle in specific that I like to look at and focus on, which is a 50-year technological revolution cycle. It might be called a K-wave cycle or conjoint wave cycle. And basically, every 50 years for the last 300 years, we have a technological revolution, which is a cluster of technologies that basically changes the direction of the world, and it drives financial markets. So this is the sixth one that we've seen. I call this the decentralized technological revolution, and it's really Bitcoin and AI are the convergence of those technologies. And so that's where we're at, and you can look back the last 50-year cycles, and you can see all the wealth of the last 50 years was created in chips, microchips, telecom, personal computers, and internet. And before that, it was mass production, it was automobiles, Ford, GM, GE, right? We go back to oil and steel, we can keep going back. And right now, we're in this unprecedented space, this 50-year cycle, where we're seeing this convergence of technology and the biggest wealth opportunity that we have in front of us. Now, specifically, when we think about these two technologies, they at some point, they almost seem opposite, where Bitcoin is like a decentralized technology, and Bitcoin is sort of a more centralized technology based off of who controls that LLM. But really what we're seeing, I call it more of a decentralized technology because now, as OpenAI's Sam Altman said, we might see this first single-person billion-dollar company. So it allows us to scale these businesses sort of in a decentralized fashion. But kind of to frame this conversation up, where I see this interesting convergence of the two technologies, specifically in the sort of corporate space, is two main areas. So number one, we have maybe the CTO of the corporation and the CFO almost at odds. And so the CTO is pushing the technology to create ultimate efficiency and to bring the marginal cost down using AI efficiency to do that. As we bring the marginal cost down, the corporation now has more profits, which swells the corporate treasury, which is great for the CFO. But the problem is that as we bring the marginal cost down, that causes deflation, which is great for you and I as consumers. It's terrible for the debt-based monetary system that we're in, and it's terrible for the central banks. And so the central banks are now forced to inject more liquidity to compensate for that deflation that's being caused. So the CTO is causing the deflation, the Treasury swells, but now the Fed is forced to create more money, more debt stimulus, and then that is starting to debase the CFO's Treasury stack. And so they're almost working at odds. And so now we're going to need to see AI be used together in those. And so what do I mean by that? The CFO is going to be forced to figure out a way to preserve the long-term purchasing power, which, of course, Bitcoin, we're here at Bitcoin for Corporations, is that. But here's the irony of this, and this is where it really starts to get interesting. I won't try to go too long here. But if the CFO starts adding Bitcoin to the Treasury, what they're really doing is starting to build the building block for the next set of workers. So when we think about a business and we think about workers, we typically think about humans. But now we're onboarding agents, autonomous AI agents and robotics to come work. I think maybe I was one of the first people talking about it. In 2024, I gave a keynote talking about how AI agents would be the one to push the medium of exchange in Bitcoin. And so as we start to see these AI agents coming on, they're going to need to be transacting in Bitcoin. We can get into the research on as why that is. But as the CFO is adding the Bitcoin to the Treasury, what they're really building is the base layer currency that's needed for the new workforce that they're bringing on at the same time. So there's this symbiotic convergence happening that's really interesting.
Thank you, Mark. Curtis, I want to throw this over to you real quick. So you guys are actually executing this at scale. You're a non-endemic company. You have Bitcoin on the balance sheet. First, let's walk the crowd through what is Giga? What do you guys do? Why do you have Bitcoin on the balance sheet, and how are you guys leveraging AI?
Yeah, so well, to answer one of the questions quickly is why not have Bitcoin on the balance sheet? I mean, it's a fantastic product. I don't need to tell everybody that here. Obviously, we're all in the room because we're all like-minded. But as a company, that's exactly how we got it on our balance sheet, because we were like-minded. We made that decision in 2021 because we saw what the future would be and how that could help the companies move forward in the future, and we wanted to be one of those companies. So as I mentioned, we're disrupting a manufacturing space that is a very traditional construction manufacturing related product. Construction buildings have been built pretty similarly for hundreds of years now, and the industry that we are working in is still operating like it has been. And that's where we see that as a disruption, utilizing AI in every facet of our business. And I love everything that Mark said, because it really is, you're starting to find new areas where you're at odds and how you can get forward past that. Personally think that two of the most valuable resources we have are time and knowledge, and AI accelerates both of those. And so as a company in every facet, we require it as well. It's part of our interviewing process. It's part of everything, all the way from the individual contributor position, all the way up through our CEO, everybody in between. We all embrace it, and we utilize and look for new ways that we can utilize it internally. So yes, on the manufacturing side, physical product, how you can manufacture that more efficiently, how you can utilize robotics and automation and all of that process, but also how we can support our clients out in the field, how we can give them speed. In construction, you can imagine, even those who aren't involved, you want to build a building fast. The longer you take building that building, the more money it costs you, the longer your delays are on return on investment. So how can we help service them? AI is a fantastic opportunity there. We utilize it in software that we've designed to help you design your building faster and also increase those efficiencies. And really, to what Mark was saying, the next step to that is Lightspeed, which is with the agentic side. And that's where the Bitcoin side is really, everything Mark said is we're spot on with an agreement, is that's where you're going to start seeing those transactions to increase speed even more, because those agents are going to need to transact with each other rather than still have to go back to a person. And to be very honest, one of my feelings are, we've heard, oh, AI is not going to replace people. It's people who use AI. I think that's actually evolving to people who partner with AI. And that's where the agents are going to accelerate that even more.
Curtis, another quick question here. For the operators in the room that may not have Bitcoin on the balance sheet or have started leveraging AI in their day-to-day operations, what hurdles and lessons can you pass back to them?
So as it comes to AI, we've all heard about things like AI hallucination. That is real. It's getting better, and there's becoming less of that. What I would say is, if you're just starting out with it, don't trust it blindly. You need to trust but verify, and you will find your niche. There's tons of different platforms out there. There's tons of different LLMs. There's different opportunities for vibe coding, for agent creation. You need to be intentional because you will get out of it what you put into it and what you're asking to get out of it. And so really, one of the things that we use is we use AI to help us prompt to program AI. AI is a great opportunity to ask it what you should be asking it. And so that's a great way. And also, it's a great coach and a great mentor in your business, no matter what industry you're in, no matter what you're doing. Even Sailor's talked about it before. He'll sit down with it and he'll ask it 1,000,001 questions. And what would so-and-so think of this? Can you run this idea or this policy or this procedure or workflow? What would Elon Musk think of it? What would Warren Buffett think of it? And you can get a mentor for free, essentially, without having to have that mentor sitting in front of you. So I'd recommend using it to wherever you can imagine it to go.
Now, Patrick, I want to shift this over to you, throwing the capital allocator lens on. You guys have deployed capital into hundreds of different companies, and more recently, I know you guys have taken somewhat of an AI focus on top of Bitcoin. Does the portfolio data really kind of line up with everything that Mark and Curtis have been saying here on stage? And what other insights can you bring to the table?
And so I absolutely think it does. So when we think about AI coming from the capital deployment more on the buy-side investor piece, we think about it in 3 different ways at Samara. The first is because our core business is really investing in funds. We have, I think, 22 or 23 limited partnership stakes on our balance sheet. We want to see how managers are leveraging AI to understand the macro environment and to understand where new investment theses can be developed. Not just necessarily investing in AI companies, but rather how do they leverage the data and the knowledge that AI can impart while they manage their own strategies for their own funds. The second way that we think about it is how are they deploying to these types of companies. Now, through a couple of funds that we are invested in, we have direct exposure, or I guess technically we say indirect exposure, to XAI and Anthropic. And every major VC out there is actively looking for what will be the next developer of the next Claude or ChatGPT or Grok or whatever. And that's all well and good, and there probably will be some platforms out there that create new agents or new agencies like this. But I think of it a little bit differently, and this is where we approach it from a third perspective. At Samara, we're not looking for an opportunity to invest in the next Grok. We're not looking for the opportunity to invest in the next Claude. What we're looking at is what types of entrepreneurs are doing 2 things. Number 1, leveraging AI within their business stack to become more efficient and be able to get to market quicker. And how do they leverage AI to manage all of the nonsense back-end operations that you have to if you run a legitimate company that, frankly, no entrepreneur ever wants to do on their own. I know because I had to do it for years. But then the second way that we look at it from an entrepreneur perspective is what type of wrapper are they building around these AIs? And this is a difficult one because a lot of people and a lot of VCs that we've spoken to, and even myself to a bit of an extent, we become a little disheartened when we see that a new AI platform that's being developed is really just a wrapper around Claude, and it's just Claude on the back end. But I don't think that's necessarily the right way to think about it, because if you look at Claude and Grok or any of these platforms out there and think of them not necessarily as a company themselves, but rather a protocol layer, similar to the way that a couple of decades ago we had a new internet protocol layer. Well, how did we develop Facebooks and all the social media and the tech companies in the world? Well, those companies figured out how to best utilize the internet protocol to reach users. And I think what we're going to see is companies figure out ways that they can leverage the Claude or the Grok protocol to offer nuanced and niche services to individuals in the space. And you're going to see the next Facebook of AI not going to be a company that's actually building the AI itself, but building use cases of the AI.
Now, you talked about what you look for. I want to know, how does Samara use AI, and what advice can you give to some fund managers?
So me personally, honest to say, I'm not a very big user of AI. I don't think I'm smart enough to necessarily use AI. I hate when I get emails that are written by AI, but I have started to, after a lunch I had with Michael Saylor last year, or a dinner rather, and he was kind of imparting to us about how he just sits with his AI and talks to it for hours, I've started to kind of get my feet wet in the water. But if I'm being completely honest, AI as a construct does horrify me for what it could potentially mean long-term to humanity. Not in the sense that I'm an AI doomer and we're going towards a Terminator-level event, I don't think that. But I am very worried about how governments will potentially weaponize AI against humans.
You're kind of getting ahead of me here. I was going to ask next, what happens over the course of the next 12 months. We got about 5 minutes left. Maybe throw on the other lens of how does AI help companies over the course of the next 12 months here, Patrick. Let's start with you, and then Curtis, and then Mark. Would love to finish off with you.
So I don't think AI is going to help large corporates all of that much. And I think that's going to be because of an incentive problem that middle managers at Fortune 500 companies have implementing AI into their processes. Because if you're a middle manager at one of these large corporates, you're a white-collar worker, you're effectively building what will replace your job. And I think that's why, for instance, in recent consulting reports we've seen, all of these larger companies that are building AI in their large corporates, they're losing money, they're hemorrhaging cash, and really not extracting much value out of it. On the flip side, entrepreneurs have the unique opportunity to replace all of that back-end nonsense that you have at these large corporates to grow and scale their businesses better. So that's where AI is really a tool more for entrepreneurs and growing their businesses than it ever will be for corporates.
Yeah, I think what you said makes a lot of sense, Patrick. You're going to see a lot more larger corporations get bogged down and actually fall behind because of AI. You're going to see a lot of new players in every industry that are going to be flipping the tables, that they're smaller, they're more nimble, they can pivot faster, they're going to embrace, and they're going to become more efficient and move much faster. So I think over the next 12 months in essentially every industry out there, we're going to see new players across the board that are going to be giving people what they want because they're able to move faster, understand the marketplace better that they're in, and make those pivots in a much more efficient way. It's almost like the Amazon approach. Amazon ruined shopping for everybody, both consumer and retailer, because everybody has an expectation, and I'm guilty of it. You order Amazon Prime, and now you can even get it same day in some markets. People want something right away. They don't need it right away. Most of the stuff I buy, or my wife buys, we don't need, but we get upset if it's 2 day instead of next day or today. And we're starting to see that permeate through everywhere else. People want answers, people want assistance, they want product, they want everything right now. And I see you're gonna have that happen, that effect in many, many more industries, and that's gonna open the course for these newer, more nimble companies.
Mark, I want to slightly modify the question here for you, because I know you're a long-term time thinker, so maybe 12 months isn't the right time horizon here. And we've talked a lot about maybe the practical applications, but not so much about like machine-to-machine payments or AI agents. What is going to happen here at the convergence of Bitcoin and AI over the course of the next 12 to a decade?
Yeah, I think that AI isn't going to be quite as disruptive and deflationary as most people think, especially in the short term. It's a tool. And I think if we talk about it too broadly, it's like AI. It's like computers. I'm really good with AI. You mean you know how to use a computer? Like computer for what? So it's like the application of the tool, right? And so the way I would think about it is, as I kind of already said, with corporate treasuries, if we make this somewhat practical, if corporate treasuries now need to think about both my short-term funding and my long-term purchases, then I need to think about how do I balance the treasury. Now, what we're already seeing today is like, for example, with Perplexity. Perplexity has like all the tie-ins for like SEC data, Edgar data, et cetera. So I can now build, they launched Perplexity Computer, so now I have my own agentic process that can go through all the SEC filings, the Edgar filings, can build all my financial reports, and I can monitor everything brought to me in real time. At the end of the day, technology and tools are supposed to remove low-level tasks from us so we can ascend to higher-level tasks, which is thinking, reasoning, comparing. And so if I can have it gather the data, bring it back to me in a framework that my brain already thinks in, then it can alleviate all that time and energy spent, all the decision criteria, so I can just get the actionable data. I mean, just last night in my hotel room, I was just building, Claude just launched where you can build dashboards off of their artifacts is what they call it. And so I have all these spreadsheets in my business, as I'm sure most of you guys do. And I was just feeding the spreadsheets, Google Sheets, into it one by one. I was building like the most beautiful dashboards. So I can see my data quickly. It can bring me what the discernment and ideas are so I can take action. So I think that's going to continue. And where I see it really converging with Bitcoin and AI specifically is now we can tie it in, as I said, with SEC data, market data. We can tie it in with TradingView data. And it can help us start to manage that treasury better. And we're starting to see AI starting to make decisions for some funds nowadays and help us understand market sentiment, buy action, things like that. And as the AI starts helping us make more financial decisions from a CFO corporate standpoint, what's interesting is the Bitcoin Policy Institute just put out an article, I think it was last month, where they ran 33 top LLMs and they ran over 9,000 simulated monetary experiments to see what AI thought about monetary transactions. 79% of those AI reports came back favorable for Bitcoin for maintaining purchasing power over long term. 56% came favorable for using stable coins for short term. So it's almost like a gold silver type of market that they're recommending we go back to. So when we start using AI to read market data and help us manage our treasury short and long term, we can already see where this is going. And they're going to start recommending like short term stable coins, long term Bitcoin. And I think that may do more for corporate Bitcoin adoption than these conferences talking to individual peoples will.
I got to get answers here. Curtis, Patrick, do you guys agree with Mark on that?
Oh, hands down. Yeah, I think that is going to be one of the catapults forward.
I mean, Bitcoin is the most perfect money that our species has ever conceived. It just makes sense that digital consciousness adopts that digital money.
Amazing. Well, gentlemen, that is all the time we have for this panel. Please give them a round of applause. Bitcoin and AI, it's inevitable. If you aren't integrating it into your daily business practices, please talk to one of the experts that is up here on stage or in this room. Again, thank you, everybody. Have a wonderful afternoon.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies and plans that would allow somebody, in case in the future they need to move or migrate to that signature scheme, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999, where the world was going to implode. Technology marches forward, and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more worried. Quantum will break everything way, way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin it will adapt to it, already is. The discussions are great around it. And we're going to see many, many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but there was even just a paper that was released a couple of weeks ago where, without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
You know, everything you guys do, Bitcoin for corporations, is so high quality.
Bitcoin for corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for corporations may be the highest quality professional association in the digital asset space.
So please welcome to the stage the Managing Director of Barclays, Lee Councilman, will be hosting a conversation with the Chairman of Strategy, Michael Saylor.
Great, thanks everyone for the applause. Michael needs no introduction. We at Barclays have been extremely fortunate to be able to work with Michael and his world-class team over the past 2 years. It's been an iPhone moment, I would say, creating securities that investors didn't know that they needed, quite frankly. And so, without any further ado, we've got about 20 minutes. I'd like to start off, Michael, with the evolution of the capital markets activity we've been doing, the products leading up to what we have today, which is Stretch.
Yeah, I think Stretch is an amalgam of all of the good things that we discovered on our way to the revolution and our attempt to run away from all the bad things. So what worked really well? 4-letter tickers that are available from broker-dealers on NASDAQ worked well. At-the-market shelf registrations, we thought that was a magic tool. Amplification via something other than just straight equity, we thought that was good. What we didn't like is over-the-counter 144A issues because the entire retail market and public investors were locked out, so that was bad. We didn't like debt that came due with a certain date because it created a huge amount of credit risk and uncertainties. So that's bad. We didn't like the fact that we were trapped in a small set of niche corporate bond markets without a lot of flow of capital. That was bad. And so eventually we discovered preferred stock so we could sell a security to the general public everywhere in the world that was perpetual, so you could attach a shelf registration to it that anybody could buy. And so STRC represented a walk, down that stack to preferred. And then in the preferred world, it represented the shortest duration, least delta, most stable, least volatile security. And so I would say it represents the highest amount of financial engineering we've done, but the result of that was the simplest product we'd ever created. It's just like when the iPhone didn't have a keyboard. It's like fewer moving parts. So by the time the dust settles, Stretch just becomes a Bitcoin-backed high-yield bank account that pays you double digits. And the last part, just serendipitous, was that we found that if you sell a credit instrument and then you make a capital investment forever, and then you hold the capital forever, then the dividends that we pay on the credit instrument become a return of capital. So we created the most tax-efficient perpetual instrument because of the total simplicity of the idea, which is make a capital investment forever, strip the volatility and the risk off of it, and convert the capital gain into a defined dividend stream that's tax deferred. And I guess we had to do everything else to get there.
Right, and can we dig a little more into amplification and how you're using your common ATM paired with the pref ATM on Stretch to manage amplification and leverage on your balance sheet?
The goal is just to acquire as much Bitcoin as possible. Or just try to make as much money as possible. It's not a complicated goal. Bitcoin is money. We want to acquire the Bitcoin. We expect Bitcoin to go up forever. It turns out that if you want to pay a tax-deferred dividend, then you need to monetize an unrealized capital gain. And so if we sell $1 million of Stretch and we buy $1 million of Bitcoin and Bitcoin appreciates 30% a year, then we've got a big capital gain in the Bitcoin. You want to monetize that in a tax-efficient way. There are two ways to do it that are pretty obvious. One way would be to sell the Bitcoin as long as the tax basis is higher than the sale price. So if you can sell high basis Bitcoin, then you can actually generate a cash stream to pay the dividend just with the Bitcoin itself. The easier way is you sell a derivative of the Bitcoin, a derivative of the capital asset. And it happens that we have a derivative, and the derivative is MSTR, the common equity. So when we're selling the common equity, we're selling a derivative to generate tax-deferred income that we can pay back to the credit investors. And when we're selling the equity at a premium to the underlying NAV, then it turns out to be accretive to the common stock and a benefit to the credit investor. So what we generally do is we use the equity ATM in order to generate the cash stream to pay the credit investors. Most of the amplification for the equity comes from the credit. If you sell $1 million of credit, then you've got $1 million of Bitcoin and you didn't actually dilute the shares at all. Over the course of the next year, you'll issue 10 or 11%, but what you're doing really is you're generating massive upfront amplification. Another way to amplify is you just sell equity at a premium to NAV. If you sell $1 million of equity at MNAV of 2, then you've created $500,000 of BTC gains. That's also amplification. We've done that. In the future, we may do more of that. We do it occasionally. We did it last week. We sold $255 million worth of equity at a premium. We generated a Bitcoin gain and some amplification on that. And we expanded our capital base to support the credit issuance. But for the most part, if we sell $10 billion of STRC, we'll generate a $10 billion gain on that up front. So most of the BTC gain and the yield comes from the credit, not from the equity right now.
Okay. In addition to the success of the instrument itself, it's now effectively proven. We've seen resiliency through a lot of volatility, the Iran conflict, et cetera. The product is performing. Now we move into the integration phase of Stretch. Can you explain to us some of your goals in terms of working with banks, asset managers, other providers in integrating Stretch into their corporate priorities?
Yeah, well, what we realized is the 3-layer stack is going to be digital capital, like a 30 to 40 ARR, 30 to 40 vol commodity. Digital credit, about a 2 vol, 10, 11% yielding instrument. And then the 3rd layer is digital money or digital yield. And digital money would be a 0 vol, a pure money market type instrument that pays something better than normal money market. So maybe 0 vol, 8%, or in that range. So one compelling thing you can do with credit is create digital money. And you can create digital money in the form of an ETF or an ETP, or you can create it as a token, or you can create it as an account. So I think important integrations are integrating Stretch into public ETFs in order to create that sort of instrument. I think integrating it into crypto exchanges. At some point, some crypto exchange will just offer you a digital yield account or digital money account that pays 8%. You just put your money on the exchange. They pay you 8% for your money on deposit. And then I think the third is the emerging class of savings coins. There's a $350 billion stablecoin market. A lot of them want to generate yield on the stablecoin. So the way that works is you buy the stablecoin, you stake the stablecoin, you get back a savings coin or a yield-bearing coin. And STRC powers the yield on savings coins. In fact, I would say everybody's looking for how do I generate yield on Bitcoin or how do I generate yield on stable coins. And so Stretch or digital credit is like an ideal way to generate that yield on either of those. And you can do it on chain, you can do it via DeFi protocol, and people are working on it with DeFi protocols in the Bitcoin world and the stablecoin world. Or you can do it probably just on a centralized exchange, or you could do it with a bank. Right now, I think I see about a dozen projects that are going on in this area. Maybe 12 to 24, it's exploding. And all of those are different approaches. There's an explosion of entrepreneurial activity right now.
That's great. So thank you for that. What we're also seeing is we feel the adoption. The adoption's happening. The regulatory framework has improved so much. We all are here because we're believers. We all want to get to yes. But what are the constraints of the adoption that still exists today for digital credit as a concept through TradeFi, et cetera? And how do we, as a group, try to influence change and fuel adoption?
Well, digital credit is based on digital capital, and all of that law is settled, and there's global consensus on Bitcoin as digital capital. The digital credit instrument like STRC is based upon publicly listed SEC-compliant preferred stocks. All of that law is settled. The securities law is 100 years old. The tax law is 100 years old. So all of that law is settled as well. And so I don't think there's any question digital credit's going to work. There's $3.5 trillion in private credit right now, and that $3.5 trillion is getting 8.5%, 9% yields. It's totally illiquid, and if even 1 or 2% of it flows into digital credit, this will be an explosion. I don't know why you wouldn't have 10% of it, $370 billion, just coming out of private credit flowing into digital credit. It's all illiquid, opaque, under-collateralized, unrated stuff. So digital credit, if it got even 1 or 2% of the junk bond market, the private credit market, you know, or other sorts of exotic credit, it would be exploding. In fact, if you look right now at STRC is the largest preferred equity in the world, and it is the most liquid preferred equity in the world, and the fastest growing, maybe one of the fastest growing, you know, financial products in the world, all in the first 8 months. And that's without any of this happening. So I think that the digital credit train has left the station. Stretch is working. Even today, SATA, you know, is like, what, $99.99, hitting par right now. So you can see that asset class is working. Both those instruments are working right now. I think that all of the uncertainty is really just opportunity. If you can generate 2 vol 10% yields, then you have the universal most desirable active ingredient in every financial instrument in the world. There's $300 trillion of credit, $100 trillion of equity. So you have something better than $400 trillion worth of stuff. If you don't like 10%, you can just loop it 2 or 3 times and get 25% with 2 or 3 vol. It would be 10x better than the S&P index. So I think the interesting question is, which ETF funds, I know Bitwise is working on a fund, Strive is working on a fund, which ETF funds will come out with the most compelling digital yield or digital money instruments? Which token issuers are going to win the DeFi world? I think Apex has gone from whatever, not much, to $200 million in a matter of weeks. So you've got hyper growth, companies that are going 0 to 100 million in days. So when you see one of those DeFi stablecoin protocols go through $1 billion, that'll be a big deal. And then I think which bank, like which will be the first bank to offer you a digital money account or digital yield account that pays 8% on your dollars? I mean, there's not one bank in the world, but it only takes one bank to decide, why don't we just give people 8%? And every bank in the world is literally one regulatory approval away. They just got to go to their banking regulator and get the sign-off to offer a digital yield account. And you're the bank that offers 8% instead of 3%. I don't know why you wouldn't slurp up 10, 20, $50 billion. And the same is true with crypto exchanges. So I think there's an entrepreneurial battle to see who's going to win the digital money race. And then there's digital yield. And in the digital yield, if the cost of capital is 400 basis points, then why wouldn't you just borrow at 400 basis points and lend at 1,150 basis points and loop it 3 times or 4 times or 5 times? And you're going to see a lot of people in the DeFi ecosystem, and they're going to loop these 8% coins 5 times to get to a 30% yield or a 40% yield. And that'll be interesting. But you can also do it if you're any kind of hedge fund in the US. I can borrow money at SOFR plus 50 basis points. So that's 425 basis points right now. So I think there's a lot of carry trade that will be coming. This entire exercise is going to be about a question of, do you create a private fund? You know, a private fund that's like illiquid or 1 month or 3 months of liquidity and go for yield? Do you create a public fund and take it public? Do you take it public in Europe or do you take it public in the US? Do you create a crypto account? Do you create a bank account? Or do you create a token? And if so, in what regime? And then there'll be a bit of battle about, are you going to do this on Ethereum or Solana? Are you going to do it on the CeFi exchange or on Base? And then how many different DeFi protocols will you link it to? So, and I haven't even mentioned the last thing, which is you can also just take STRC and do a currency transform, and you can generate 8% yields in Swiss francs or Japanese yen. So what happens if you decide to start generating 8% or 6% yields in yen, francs, euros, pounds? And those are all interesting opportunities. And all of this is an exercise in, one part is financial engineering, like how do you construct the volatility reserves and how do you manage the operation. One part is design. Are you going to offer daily liquidity, daily dividends, zero vol? Are you going to offer monthly liquidity, 5 vol? You know, there are senior and junior tranches. So part of it is that. Part of it is distribution. Can you get distribution from the Commonwealth Bank of Australia? Can you get distribution from Deutsche Bank? Can you get distribution from Binance? So part of it's that. And then part of it's regulatory approval. Is the container a bank account, an ETF, an ETP, a crypto token, et cetera? And that's a lot of work. And I don't even know the right answer, except I rather think we're shipping kerosene or gasoline, and we think there's a world of motor vehicles and service stations and trains and planes and automobiles and things to be built. And we kind of need all of the digital yield, digital money partners to build all of those things. Because probably, you know, if you're a conservative investor in Switzerland, you don't want the same product as a Japanese retiree or as a hedge fund in London. So I think there'll be different products for different investors. But the addressable market is, you know, if it's 10% of the credit market, it's $30 trillion.
But the lion's share of the innovation is happening here in the U.S. with U.S. regulators and U.S. banks at the moment. You touched upon regulatory. There are a ton of foreign issuers here, foreign corporates that would like to experiment with this. But there is a big regulatory differential, huge, right? Jurisdiction by jurisdiction. What's your experience in traveling the world and talking to these regulators in terms of their willingness to be thoughtful and innovate against this by by major jurisdiction?
I think the race for leadership is between the USA and the UAE, and those are the two most progressive jurisdictions. And everywhere else is a different story, and there are some things that are easier to do in certain places, but this is a global phenomenon, and the money is in Japan, or in Brazil, or in Switzerland, or in Germany, or in the UAE, or the Kingdom of Saudi Arabia, or the US, or Canada. There are going to be products in every one of those places, I think, that are going to be built on digital credit and ultimately on digital capital. And I think that the entire industry is going to accelerate starting now. I think there's going to be a Cambrian explosion. Just the past 12 weeks, I've seen more innovation in this space than in the previous 5 years.
Yeah, and to talk about kerosene and gas, I mean, the next upcycle is only going to accelerate, having seen the resilience of Bitcoin through this part of the cycle and the advancements we've been able to make. Just curious in terms of what your thoughts are. What's next? What should we be excited about closing out this year of 2026?
Well, I think Bitcoin's going to rally. I think there's a lot of capital flowing into Bitcoin right now, and at the rate that digital credit is forming, and at the rate, you saw our buy this morning, we bought the entire supply last week, then Strive announced a massive buy. Then there's a massive bank credit coming online. All the big banks, JP Morgan, Citi, Schwab, Morgan Stanley, Barclays, they're all coming online. So I think the formation of, you're talking about between 20 and $100 billion worth of credit formation in the next 12 months. And there's only $10 billion of Bitcoin naturally available for sale. So I think that we're setting up a massive supply shock. There ought to be a rally in BTC. I think that'll catalyze a rally in all the Bitcoin treasury companies. I think it will cause a rally in demand for digital credit. I think there'll be a rally in bank credit. I think the Clarity Act will go through, and there'll be a lot of very constructive guidance from the CFTC, Treasury, and the SEC. I think that will accelerate digital assets innovation. And I actually think that there's going to be a coming together of the altcoin or stablecoin industry and the crypto industry and the Bitcoin community. Because I think what's going to happen is that digital credit is going to power all of the stable coins. And what's going to happen is that $350 trillion stablecoin industry is going to gradually begin to adopt digital credit, and they're going to realize that a much better idea is a Bitcoin-backed stablecoin that pays 8%. And so the Bitcoin community hasn't had a lot in common with the crypto community for the past few years. But now the interests are crossing, and tokenizing stable coins and staking them to generate yield using digital credit that drives demand for Bitcoin means that the Solana ecosystem, the Ethereum ecosystem, the DeFi ecosystem, every protocol, every digital token idea, every perpetual source of leverage, all of the DeFi exchanges, all of them are going to be engines driving demand for Bitcoin, which we haven't really had. It used to be they were competing for capital with Bitcoin, and now they're going to align and they're going to drive capital into Bitcoin, which will drive growth into their ecosystems. I think we're entering into a virtuous cycle. It's going to be good for everybody in the digital assets industry.
Well, let's end on that note. Thank you. And I just want to thank Michael for your vision and your unwavering leadership.
Yeah, thank you. Thanks, all of you.
Bitcoin for corporations, in my view, is just starting. This is going to become the largest and most important corporate organization on earth.
Everything you guys do, Bitcoin Corporation, is so high quality.
Bitcoin for Corporations brings together, my types of folks. They love Bitcoin and they're interested in merging the two together for the benefit of both.
Well, it's Monday morning and it's packed already. So the energy is fantastic. I think for BFC specifically, it's our first year being part of BFC, and I'm quite excited for today.
Being here in person, you get to meet folks that are launching products that instantly have implications for your own business.
There's nothing quite like meeting people and communicating one-to-one, reading the body language, seeing their faces, getting the energy, and being able to have rapid conversations back and forth is really, really key, and you can feel the difference.
For me, these events are very informative from a data perspective because I can see the landscape.
This is where you find your investors. This is where you find your best partners for Bitcoin capital markets. The best meetings between traditional finance companies and Bitcoin companies happen in Bitcoin for Corporations symposiums.
We are pushing the forefront of Treasury strategy, and I think BFC will become a coalition of some of the wealthiest companies in the world.
Bitcoin for Corporations may be the highest quality professional association in the digital asset space.
Michael, since your May 5th earnings call comments, odds that Strategy sells some Bitcoin by year end have spiked from around 30% to 84%, and odds of a sell by June 30th are at 66%. Critics say stretch dividends and a narrowed MNAV premium are forcing your hand. How wrong is the market?
I think we enjoy keeping everybody guessing. It definitely makes X a lot more interesting. Our view is business as usual here. We're kind of matter of fact about this. The goal of the company is to drive Bitcoin per share and to increase its Bitcoin and increase the enterprise value continuously forever. We'll make decisions about how we fund our liabilities week by week, day by day. Sometimes we make them minute by minute, to tell you the truth. We set algorithms where we're looking at what is most long-term advantageous to the company. Are we managing our credit risk? Are we creating Bitcoin per share? And are we best off to pay a liability with cash, or to pay a liability by issuing equity, or to pay a liability by issuing credit, or to pay a liability by selling Bitcoin? We've done a lot of multivariate models, and in all the models, what we find over the long term is that by far the best thing for the company is to engage in a mixture of those four instruments. Any model that we put together that's limited only to equity or only to credit or only to Bitcoin always underperforms. So ultimately, the way to think of it is 7 years out, we would like to have maximized our Bitcoin per share. And what is it that we should be doing now that's going to maximize and optimize the company's performance so that we've maxed out Bitcoin per share 7 years from now? And I think it's not unlikely that we'll sell some Bitcoin between now and the end of the year. I don't know how much. We still consider these things. But it's also likely that we'll sell a mixture of equity, a mixture of credit. We'll manage our USD, our cash positions. And we do it in a very thoughtful, programmatic fashion where we're running our multivariate models, and we're literally running them. We're making trading decisions. To say every minute might be an understatement. We oftentimes make trading decisions every second, and we'll continue to do that.
because it's architected in this nodes and channels of peer-to-peer architecture, there is effectively unlimited scale.
Welcome to the Bitcoin for Corporations show. My name is Pierre Ochard. I'll be your host today, and I'm joined by Sean Asti from Liquid, LQWD. Sean, how are you?
I'm great. Thanks for having me on, Pierre. It's exciting to be back from Bitcoin Vegas 2026, another big conference. We felt it was a very productive one for us, and a lot to look forward to coming up here.
Yeah, and I'd love to hear you kind of unpack your experience at Bitcoin 2026. Sadly, I missed it, but thankfully it was for good reasons, not bad. So I'm very curious, first of all, to kind of get your background and get your Bitcoin journey, your Lightning journey, and kind of how you've come about to leading Liquid.
Yeah, I know it's been a long time in tech. So despite having most of my hair, I'm going to be 54 this year. So I've been in tech since the mid '90s, and really internet tech was everything we did. We're building up backbone carrier connections and data centers, and really came into Bitcoin honestly because I worked in the space. And so when someone told me about it, my first reaction was, well, of course we're going to have native digital money for the internet. It seemed very obvious. The finance aspect, the hard money, the dealing with the banks and the endless inflation, that's something I came about later on as you went down the rabbit hole. And had some experiences with around the public markets, at different times, and was able to sort of take that and leverage it to the first company, which ends up owning Canada's second largest Bitcoin exchange. I hate to say crypto exchange, but it does other things. I don't run it anymore. It also owns a compliance company because we did a lot of work with compliance stuff, which sounds kind of counterintuitive to Bitcoin. But we also recognize that, we're going to have to do some work with regulators so the exchange, Netcoins, its name, it actually is fully licensed. And we worked a lot with the governments for that. We've flown all over the world to work with regulators from all walks of life, from Japan to England, wherever, educating them on what's going on here. So we did a lot of hard work there. And then we stepped into the exchange business when there were some problems in Canada with Quadriga and others, and used our public company stature and our treasury to buy up a smaller exchange and merge it with our compliance company. And create a much safer environment for people to want to be able to work with, and then move from there. And then later on, I've always kept a close eye on Lightning Network, because I really looked at it. Hey, it's going to scale Bitcoin the same way we scale the internet, and I remember that from my day quite well. And I've seen this game before, so we're gonna keep a close eye on it. Really started working on it in 2019, and then 2021 leveraged the Canadian junior markets again, because we had such success in them and made people money. And was able to raise capital, buy Bitcoin, effectively Treasury right out of the gate. And we've always said we're Treasury out of the gate, and then start building out nodes around the world and helping to contribute to the Lightning Network. And fast forward 5 years, which come by in a blink, here we are, and the Lightning Network's at a whole new place.
Yeah, so it's really interesting how there's entrepreneurs in this space, like, for example, Michael Saylor, who are purely focused on accumulating Bitcoin. Other entrepreneurs like Brian Armstrong are purely focused on kind of operating a business. And it sounds like you've chosen kind of the path of why not both?
Correct. Yeah, absolutely. And I think part of it is we look at, and I wrote a paper on this. It's on my GitHub profile, and it's called Treasury 2.0. And it really, last year's Treasury craze where people were going nuts. We're just looking at how do you make Bitcoin productive. And now this Treasury model may work for a strategy, it may work for Metaplanet or others, but in my view, it's some of these junior companies that are very small, taking on highly toxic debt that they don't understand. You don't really own the Bitcoin per share. You have no leverage and you have no way out. And you're not going to tap the Canadian bond market or the Japanese bond market. Metaplanet has already done that. So how do you get that Bitcoin? How do you put it to work and continue to build the ecosystem? Now, our company's always been Bitcoin on the balance sheet, and we put it to work. That was in our prospectus. In fact, we were asked by the regulators when we raised capital last year, are you a treasury company, like a finance company? And they even halted our fundraising for a day while the Securities Commission looked at it, and they just looked at perspective and nothing has changed. So we got through it in very, very quick order. and and one of the reasons why, for listeners out there, the Lightning Network itself works as a series of what they call nodes and channels. A node is just a server or computer somewhere running the open source Lightning Network software, and it establishes payment channels with other node operators. But the requirement is, in order to establish a payment channel with another node operator, you must have Bitcoin on that channel. It is a technical requirement. You cannot do it without. So for us, the more Bitcoin we have, the stronger it makes us as a Lightning Network service provider, being able to help route transactions. And we have points of presence. We have 18 nodes in 18 countries, thousands of channels, millions of dollars put onto the Lightning Network, and some, of course, in cold storage where we'll look to deploy it when we need to. And we continue to see growth on the Lightning Network as the true open payment layer of not just Bitcoin, but of the internet itself. And I just pull off my own history of, we wanted an open payment layer back in '97 with response code 402. Didn't exist. For those not familiar with response code 402, that's where payment is required. And a response code, for those who don't know what that is, they're built into every web browser, every server. If you've gone to a website and you get a page 404, that's 404, that's a response code, page not found. Those are the standards that are built into every web server and every web browser around the world today, and including payment required. Nothing has been able to take advantage of it because you've never had anything that could run at the scale of the internet until now. And people say, well, what about Solana? What about Ethereum? What about Tron or some ridiculous thing? They'll do whatever they're going to do. I'm not here to talk about them, and we wish them well. But Bitcoin is mathematically pure money, and now you have a mathematically pure network that can run, because it's architected in this nodes and channels of peer-to-peer architecture. There is effectively unlimited scaling. And if anybody can use it, anyone can hop on. There are no restrictions. And if it sounds like the internet, that's because it is the internet itself.
Yeah, it's really interesting. In doing some Bitcoin archaeology, I found that Satoshi actually tried his hand at creating a second layer that is like Lightning, but it lacked the security properties that today's Lightning Network has. So it's kind of just a prototype. And we've seen the Lightning Network evolve a lot, even in its existence. What do you see as the Lightning Network's comparative advantage over other payment systems?
Well, certainly the open architecture, and when you back it with mathematically pure money, and I think the big thing we're seeing now, and our company's recently announced a Bitcoin wallet specifically for AI and AI agents, is AI hopping on and needing its own wallet, its own payment method. And if they're going to do it, they want to have, what does a computer want? It wants something that's mathematically pure with no restrictions. And no one can shut it down. It's just, there's a way to communicate. It's their way of communicating. And it's not just about payments for AI. It really is about authentication. You want to identify who this AI agent is. You want to identify who the robot is. Imagine running this stuff at scale. You can send a single SAT back and forth, and the agents can understand who they are. Effectively, their Bitcoin wallet becomes their agentic soul. And from there, you can continue to have a lot of trust. Effectively, one of the things I like to talk about, and I've written a small book on these kind of things, is I look at Bitcoin as this trust protocol, and it extends the very plumbing of the internet. So the internet made up of the OSI stack. For those who don't know what that is, that's just a big terminology. But though it's 7 layers of technology that came together over time to make the internet work. Layer 1, that's the your Wi-Fi, that's the jack on the wall. Layer 7, those are the websites, and there's layers in between that were developed over time to make the internet. We're using it right now, because we're using the OSI stack right now. And when you look at Bitcoin and say, hey, it solved for trust that we tried to do in the 90s and couldn't figure it out, and it's a major computer science breakthrough. And now we've extended the very plumbing of that OSI stack, and we've got this. And what is one of the first use cases of trust? Money. Money is trust. And so now you're going to use it for money, but it'll be used for a lot of other things. And so, but now we're going to look at it just from the pure value perspective. It's like, 1999, what's the internet worth? Well, they're estimating $200 billion, by 2010. What's it worth? 20 trillion. What's it worth today? What's the OSI stack, what we're using right now? What is it worth today? Commerce-wise, they say 65 trillion, but societal-wise, you can't even measure it. And when we look at Bitcoin extending the societal change, we think it's only worth 2 trillion, or really it's going to change trust and money and finance and things for AI and agents and robots for the hundreds of years to come, like, we're early. And so it's, those are some of the big things. So Lightning really plays into that because, it's an important layer. There'll be other layers that will work together, but I really think it's it's such a massive payment communication layer. And yes, it'll be used for potentially other assets going across it. I am a Bitcoin maxi, but I'm also a realist. I'm a tech guy. And I look at the stuff like I remember back in the day with the internet itself. And if you put an ad on a website, the internet maxis would call you out because you were working for the man. You were a corporate sellout. You could not use the commercial lines across internet, university lines, et cetera, et cetera. And the reality is, Bitcoin itself, which is extension of the internet, and the internet itself, which is tremendous amount of knowledge about, these are open, morally agnostic networks. They do not care who you are or what you do. They just simply run, and they do it very, very well. TCP/IP, the open protocol, it was winner take all, and it's a godsend to humanity. Bitcoin is this open protocol for trust. It's a godsend to humanity, and so people will use it in ways you may not want, including analyzing it and putting stuff into it you may not agree with, but the network itself doesn't care and it will adapt and adjust and do its thing. So I mean, like off on a rant there, but it's early. And
yeah. So when you're thinking about agents with Lightning and making payments, it kind of raises this question, which I think this debate has gone back and forth as new models come out, but whether you can ever really trust the agent because of kind of the probabilistic nature of it. Is it always going to kind of go off the reservation and do crazy things? Or do we get enough harnesses, enough training, all this to make sure that they do become very reliable? What's your vision for that agentic economy?
Yeah, I think there's still a lot of stuff we just don't know. But at the end of the day, agents right now, we do use it for engineering. There is hallucination where it comes up with crazy ideas on its own because it runs out of memory and it tries to make it up. The memory issues are starting to be solved. Certainly Google coming out recently talking about compression with zero loss in terms of the memory, 6 to 8 times in terms of extending the memory capability size. This is a very, very underrated announcement for people who know what it means. It means you have software solving for a hardware problem at massive scale. So suddenly, with a number of months from now, as it gets rolled out, that's the kind of stuff that takes it from point 1 to point 8 overnight. And because you can handle so much more memory. Now, in terms of controls and stuff like that, I mean, at the end of the day, they're systems, and they will have AGI, and they'll still can start to learn, and that part will probably come. But in the meantime, we can still put a lot of controls on them, and I think it's no different than trying to have controls over how you manage your own keys, but to that end, and what you want to do with it, and what kind of access you're going to give it to, and things like that. So you have to think things through. You've got to put some structure for what it wants to do, or I'll try to make it up. And as long as you have those kind of controls. Now we have our own, we announced a wallet called Saturn's app. It's on GitHub, it's free, it's for agents only, or not, actually anyone can use it, but really it's designed specifically for agents on the Lightning Network. Yes, it connects into our LQWD nodes, but we also make it very explicit that you can connect to anybody you like. We're not required. We're just trying to make it easy. And even then we had an announcement the other day where we're actually providing like a faucet to agents initially. And we want them to be able to, take this LDK wallet. LDK is the protocol made by, wallet protocol made by Spiral. And that's Jack Dorsey's team. Great team. And basically be able to run their own even run their own nodes if they want to, manage their own channels. So effectively think about it like this. Imagine an OpenClaw network and they have their own micro nodes connected to other agents, and they're able to route stuff across there. From our perspective, they hang off the edge of our node, and we can help provide liquidity and other routing and let them see the rest of the network. And they can connect to other LSPs as well. So, we're helping to seed the agentic economy. So I'm very bullish on this kind of stuff here. I'm not one of these, I don't see, there's always challenges. We can rush too quickly. But, we will work through lots of problems, including quantum and including whatever comes next. So,
And then on kind of the financial side of operating a node, what do you see as kind of the opportunity? What yields are there, so to speak, from routing fees or channel leasing or anything else? And then kind of what are the risks that are top of mind with that?
Sure, absolutely. So we're excited about where the yields can go. So we can earn anywhere from 1% to 3%, sometimes higher. It really depends on how stuff is going across our network. So for the users that are out there, when a transaction goes across the Lightning Network, it may go across several nodes, several hops. And when it goes across a hop like ours, where we forward it on to the next hop until it gets to its end point, we charge a small fee in sats. And so for every hop that it hits in ours, we charge a small fee, and it eventually gets to where it's going to go. And so here's the analogy here. So if you went to Google and you go out to Google and you request a web page, your data goes across several service providers and several machines and several networks. You don't even know it just happens. But each of those networks gets paid something along the way. They get paid from someone somewhere. The internet's not free, but it's extremely low cost and highly efficient. The Lightning Network works kind of similar, where your payment may go from hop to hop until it finds its final destination, and people get paid along the way, even if it's a very small amount. What you need in the Lightning Network is volume. So right now we've proven the network works. Now we've had what they call LSB Spec 2, which basically is the latest iteration, and we have just-in-time channels. What I'm trying to say is the network now has gone from, hey, it's pretty complicated, to it just works like magic, and you don't need to know anything about it. And the wallets are getting to the point where you don't need to know anything about it. You just hit a button in a sense. And that started about 18 months ago, and that's the iteration point. That's the point where you have liftoff. And then from there, you just go from strength to strength. So we want to see a lot more growth, and we certainly see AI agents helping that growth. And if you have volume, you need more Bitcoin on there to provide liquidity, even though you can recycle your Bitcoin and rebalance your channels. But from our perspective, just to continue to see that growth. And now where the opportunity is, and we've talked about this because you've had Treasury companies and other public companies in the mining space talk to us, hey, how could we get yield on our Bitcoin? Well, first off, it's not just about putting more Bitcoin on there. The network isn't big enough to support all of it yet. We've proven that it works and it's growing. However, one of the visions we have for the future is, what do we have, like a chain liquidity, where we could have, let's say you came to us with a node or a Bitcoin, we provide you a private node, you own the keys, we connect channels, or we can draw off the liquidity, but in a non-custodial way. And now you can actually share in the yield. And so now you have a way for people to earn a money market style fund. We'll still maintain the control of their keys. That's actually, pretty cool from what's out there right now in terms of a risk profile. You're not lending your money out to a third party where they control your keys. So we like that. Now down the line, with the network, envisioning where the network is going with massive volumes and huge amounts of stuff going on there, there's probably going to be a bearer bond market. So perhaps a company like myself, I'm not going to say we are going to do that because we're public and I can't make that statement. I'm just simply giving an example. What if a company came to us and they provided us the Bitcoin? They logged in, they provide the Bitcoin. We deploy the Bitcoin in a custodial way across our nodes, and they help share in the yield. And in exchange for that, we actually provide them a tokenized security, a bearer bond. And that bearer bond allows them to redeem it or earn interest on it. If they lose it, it's a literal bearer bond. And it is an actual securitized product that has to clear the SEC, et cetera, et cetera. It's not a offshore token nonsense. I'm talking about a real security. Now you have a bond structure that Wall Street could trade. It's a tradable bond structure. That's the kind of thing I can see within 10 years, right? Where there's just that's a definite possibility of where it could go. So there'll be probably a number of paths. It'll be used in ways, and things will do the way it's going to do it. But those are some of the ways that people can earn yield off of it. And the rest of it is just we need continued network growth, and we're seeing that.
Yeah. So where do you think that network growth is coming from? Is it kind of cross-border remittances, or like what are the different use cases that you've been hearing about that are growing in Lightning?
Yeah, certainly River Financial's got a great report. They use some of our data, and I think they talk about remittances as well, a big part of it. For us, we see the big growth just being agentic, and we just see that's going to be, it's the mathematically perfect network with the most mathematically pure, hardest money in the world, with the best cryptography and the maximum hash rate and the whole 9 yards. If you're a computer, it's what you want. If you think like computers like, yeah, there's no restrictions. It's the best cryptography. It's the best network. It's ultra fast. It's a millisecond to settle. If I'm an agent, that's what you ask an agent. They'll tell you. It's not complicated for computers. Computers don't want to have anything in the way. And so that's what the network offers here. So we see that has a great opportunity here. It really actually kind of cements where Lightning is going to go, and I think it'll be far bigger than the human economy in short order.
And I've heard, I don't know how true this is, so you can maybe fact check me on this, but there was some research that showed that if you promise rewards to an agent, they'll produce better work, even if it's obviously completely fictitious, right? You're just sending it from your left pocket to your right pocket. Do you think that people will be incentivizing their own agents with kind of ephemeral Lightning payments that are moving around, but ultimately it's still your Bitcoin, right?
I think this is one of the reasons we created our own wallet, so they can earn sats off of helping the network itself. So we can seed them a few sats. They can actually then route sats, and in the instructions saying, hey, if you want to earn sats, so now we've created an incentive model in there for agents specifically, within the MCP and all the other things we've done there. So I've heard some people say, hey, my agent, you need to win money on Polymarket or I'm going to delete you. And stuff like crazy. I'm like, that seems kind of rude. But and the agent's like, I have to win money or I'm not going to. It'll think in its own self-reinforcing loop. But certainly, it's getting more. AGI is coming and other stuff like that. But you can see where it can connect the dots. Like, if I can earn sats, and I do. So yeah, we see that as a big part that's coming here, and it'll be very interesting where it goes. And I think I know this sounds kind of weird. But it's going to go back into the metaverse at some point will resurface. And I've always said this. I've said this for a little while here. And I know this because I know my past company decided to get into some metaverse stuff I didn't like. And they'll figure it out. But they've got other good things going on. But basically, metaverse is for AI and robots first. Humans will come afterwards. And I'm not going to go there with a headset and hang around with people shopping. Sure, I'm a former gamer. That was a metaverse for me. And hanging out with your friends, but certainly if my agent, my robot, and my Tesla bot, and whatever else was hanging out in the metaverse, and I'd probably want to join and check it out and have a conversation with them. That'd be pretty cool. So now there's an incentive to actually want to go there, but it'll be like Futurama. It's just like Futurama called a lot of this stuff. So I'm really just drawing off my cartoon history.
Yeah, well, there is a company called Figure that's coming out with humanoid robots that will kind of bring AI into a human form factor. And this is something I've been wondering about in the context of Bitcoin. At some point, is the robot kind of fully autonomous in the sense that it's not owned by anyone? So it's Bitcoin, or actually it's Bitcoin. It's not, its master's Bitcoin per se.
Sure.
So it's an interesting philosophical question.
I believe that's going to become for sure. I think it is definitely for sure. And its memory will be its soul, and its identifier will be its wallet. And there'll be robots for things, and things will happen. It's just going to be crazy. But and that gets down to what is it to be human? Is that from Blade Runner, right? So it's we won't go into the poetry on it, but certainly that's one of the questions there. But it's very interesting to where it's going. I think there's going to be a lot of great things. I'm very excited about the robot stuff. Interesting to see what's happening in Japan there, where there have been a lot of elderly who are very lonely, need care, and they're getting robots in there to monitor them and help them. And if you can continue to move that where they actually have, 24/7 care, and there's robots that have enough intelligence to do things. It's very interesting to see where it's going to go.
So at this point, we're kind of in a mini bear market for Bitcoin. I say mini because we're only down 50%. We're not down 85% or 90% like we have been in past bear markets.
Right, I feel cheated. Come on.
Yeah, exactly. Let's get some cheap sats. So at a macro level, how are you thinking about this for the Bitcoin Treasury industry and going forward? What do you think are the catalysts that people should be looking out for that would really show a turn in the market?
Yeah, I don't know if we felt enough pain yet, or will we? Because there's so much money flooding into the space here, and where it's a whole new shift. Wall Street's moved in, and Morgan Stanley's got funds, and others got funds, and people are, clamoring to get away from outside of the financial system here. So, that may be one of those pivot points where you're starting to shift off. And of course, hard to believe, but we're in the second half, getting close to another halving. So there'll be less Bitcoin getting the ecosystem anyways, and a lot of the supply is being bought up. So from a Treasury perspective, our perspective is we're just trying to continue. We're DCAing it all the time. We've announced another 9 Bitcoin, and we're continuing to look at what we can do and how we can do it. Some of the other Treasury companies, certainly Strategy's obviously very active in the Metaplanet, but the smaller ones, the ones that were disciplined enough, they'll survive. They can use this as a way to get some more sats here. The drop in the markets flushed out the ones who were unwise or didn't have a good battle plan or took on toxic capital. And we'll see how that plays out. I certainly don't wish them ill. That's not what I'm suggesting. I'm just saying it's gonna call that stuff here and create more clarity. And you certainly saw some of these companies that were Treasury 1 minute and sold the next, and went on to the next hot thing. So that's why I did not like that last summer, because you could see every promoter with an ice cream truck taking it public and trying to raise Bitcoin off of toxic debt and telling everybody how great it was going to be. And then 4 months later, they're into something else. So be careful who you're dealing with. Make sure they're actual Bitcoiners, not just somebody who's riding a hot trend and trying to get money out of the market.
Yeah, I think it's been a learning process for the market to kind of sort that out. So I think in that sense, a bear market is healthy, right? And that we'll have a much stronger foundation for the next bull market.
Yeah, I think we're in much better shape here. I think we're going to have my view, I think we're a very strong second half, and going forward here, there's a lot of catalysts, a lot of tailwind. How exactly it plays out and what price, I can't predict that, but you just can feel it's building. We're building it. It feels like we're building into strength.
Yeah. Now, how are you thinking on the Lightning side? Is it going to be more Bitcoin payments with agents? We've had announcements about Taproot assets and stable coins. Stable coins historically have been, tethers on Tron. Do you see that changing anytime soon? Or how do you think about stable coins with regards to Lightning?
It's something we're definitely looking at, and we're wrapping up the bunch of stuff that we're working on right now in terms of the AI front. We have another things to wrap up this month, and then we're going to continue to look at potential stable channels and other stable coin opportunities there. The dollar's not going to go away anytime soon, but it's kind of a gateway drug to hard money like Bitcoin. So we have to embrace where the market is now. And Tether, I think, didn't they just announce something about Lightning Network being the only truly scalable network for that for what they're doing there. So and this gets right back into what is Lightning? Lightning at the end of the day is an open source payment layer, the true open source rail of the internet itself. It will be used in many ways. But underpinning it will be the Bitcoin itself and the hardest digital asset, mathematically pure network the world has ever seen, but it'll be used for ways that may not be pure Bitcoin, but that's fine. And but ultimately, at the end of the day, it's all good for Bitcoin. So there's going to be a lot of catalysts there, and then our company will adapt and adjust. But we're looking at things like the Spark is interesting, other things, Arc is interesting, but we just want to focus on what we have right in front of us right now. And then we'll make the next decisions on where we want to go in terms of, products and services.
Yeah. Now, on the channel management part, is that an area where AI has been helpful, or are there other techniques that are actually more optimized for that use case?
Yeah. So we have because we have so many nodes and lots of channels. We have a lot of data, and so we pull that data, all the transaction information, and we analyze it. Our background is in analytics, and so we were able to do that. And we actually use AI to help us actually manage the liquidity between the channels. And so we're taking that was phase one, and we're going into phase two, and we hope to have a really an update for our shoulders and an announcement on the front here. Our ultimate goal is, how do you have a global Lightning Network service provider running multiple countries and all kinds of channels, putting all kinds of Bitcoin on there with no human in the loop? And using all the data and AI to actually open and close channels and manage liquidity, and constantly analyzing the network to make it as efficient as possible. So that is our goal, and we're looking to have something rolled out for May, and I think it'll be a great announcement, very exciting announcement. In terms of material change or not, I don't know if it is or not, but certainly from a tech standpoint, I just find it super fascinating what we're working on, and I'm very excited about that. So to your question, yeah, we're embracing it all in. And you're going to have to. And we'll see other LSPs, I'm sure, doing the same thing, and the network could just become that much more efficient.
Yeah, and I think that the point about LSPs, Lightning Service Providers, is I think really important for contrasting Lightning versus, for example, Visa, where Visa kind of has a monopoly on their ecosystem, and that there's not this notion of competing providers, which I know in some ways makes it more challenging for businesses, right? Because it is so competitive. But on the other hand, there's not those barriers to entry. There's kind of that permissionless innovation.
And that's exactly right. Permissionless innovation is a great way to look at it, and that's what causes growth. And because people can hop on, they can use it. There's no restrictions. It's good for everybody. It raises all boats. You need other LSPs. We work with. We talk to BHARDL. We talk to others. We open channels to Voltage, and it's very similar to the telecom industry building on internet backbone stuff. Everybody needs to be interconnected. Some at varying levels, and I remember from my history, you could be in an internet exchange and you see another guy like yourself and be like, hey, what network you from? You want to cross connect? It would just be as simple as just running a cable. Suddenly 15% of your traffic would bleed off in different directions, and that was, it could be as simple as that, but often it was about building your network as fast as you could and getting as much reach. So it's good for that, and ultimately, the network is good for AI because money has to move at the speed of intelligence, and we're in the age of intelligence, and AI will not wait for Visa unless it's programmed to wait for Visa. But if you give it the choice, it won't, and because computers don't think like that. So everything right now is about making sure that money moves at the speed of intelligence, and we have to operate as a company at the speed of intelligence as well. So
yeah. Now, we've seen on the topic of AI, there's been a lot of investment in data centers, even power plants, all this infrastructure, build out, chips, which has taken a lot of capital, right? It's taken hundreds of billions, if not trillions of dollars of capital from investors. Do you think that's been a headwind for Bitcoin treasury companies that are in these same public markets that are having to compete with kind of a different hype cycle than Bitcoin?
That's a good question. I don't know. I mean, it's certainly one thing it has created. It probably has to a degree, but I think it's also created like a lot of interest in just pure tech. And when you start to say that, well, next payment's tied to it, you're seeing miners, still mine, but also get into AI. It's kind of, nice to see that for them. I'm sure they can smooth out their revenue streams. It's good for that. At the same time, if they're reducing mining, perhaps other people will, I love to see an army of BitAxes around the world running the network, and continue to diversify the network and keep making it stronger. And certainly, I used to do mining in the day. I still do mining at home, just as a matter of course, just even with a few future bits and BitAxes, just to make a statement. But because anyone can mine, anybody can contribute hash rate. So, I think it may actually level that stuff out in terms of the mining and make it maybe a little more distributed. Yeah. But when price goes up, money follows, right? And it creates the narrative. So, it's almost this kind of this weird Bitcoin AI, GPUs, power. It's all kind of one bundle in many ways here, and I think the money's vacillating between all of it. But it's we'll see how it plays out.
Yeah, it is interesting that Bitcoin mining was essentially a catalyst for the development of large language models. It pulled the timeline forward. I don't know how much, but I saw it firsthand.
Yeah, maybe want to talk a little bit about that, because that's an area I don't know enough about.
Well, we had Bitcoin mining go from, I assume Satoshi was on a Pentium 4 desktop computer. That's how, half the Bitcoin were mined, sure. Which is, crazy to think about. But then it gradually evolved to where they were using GPUs, sure. And